Hello and welcome to the course of Blockchain for Finance Professional. It is a deep dive course about how blockchain is evolving the finance industry. Now we are going to discussing the entire course curriculum in details. The complete course is divided into 9 well-organized modules. We'll go through each module and discuss the topics covered in the modules. In the Module 0, we will discuss all prerequisites to take the course, career opportunity, who should take the course along with this course curriculum. Let's move on to the first module. The first module is about Introduction to Blockchain and Cryptocurrency. In this chapter, we'll discuss almost 16 must-know facts about blockchain and cryptocurrency. Basically, we'll start the course with the topic that how financial assets actually relates to the blockchain technology. Then we'll introduce distributed ledger and its advanced concepts, potential for financial applications in distributed ledger technology to you. Next, we'll see how we can develop financial distributed ledger technology or DLT. After that, we'll consider some blockchain principles and blockchain business rules, transaction processing rules in blockchain. Afterwards, we'll get an idea about blockchain technology stack and its different layers. Later, we'll know how we can actually architect a global scalable blockchain. We'll also discuss about the blockchain generation subsequently. Next, we'll have an introduction about the fundamentals of smart contracts. When we've covered all this, it's also imperative to understand that what are the key challenges to blockchain technology. So these all topics will provide you a good grip in blockchain. Next, coming to the introduction to cryptocurrencies. It's a very important part. Then we'll be concluding this module with blockchain financial use cases. Now let's jump to the second module, which is advanced blockchain concepts. Roughly, we have almost 8 topics in this module. Here we'll talk about what blocks fundamentally is. Afterwards, we'll understand the blocks in advanced. Next, we'll discuss about the various consensus mechanism of blockchain. How do we can mine the blockchain, distributed databases, Ethereum, and Ethereum smart contract. Coming to the last of Module 2, you will get an idea of blockchain security aspects also. Next, coming to the Module 3, which is completely about the cryptocurrencies. So in that module, we will start with the first blockchain, which Bitcoin, and later we'll discuss the Bitcoin fundamentals. After that, we'll learn about the evolution of cryptocurrencies, altcoins, and we will understand how to mine altcoins. Finally, we'll end the module with the brief overview of ICOs. The fourth module is all about the blockchain frameworks, mainly Ethereum, Hyperledger, and Bitcoin. These are some of the common frameworks which have been used in blockchain technology. This module covers the enterprise world as well as some of the cryptocurrency and digital currency. Understanding any technology without the implementation is very difficult. On that note, we'll learn blockchain implementation in the 5th module. Firstly, we'll learn how blockchain exists as a financial system. Then, what is blockchain for provenance tracking, which is mainly financial supply chain. Then we'll see how blockchain is used in case of asset keeping as well as how blockchain can be used as multi-party systems. Finally, we'll conclude with blockchain for asset management. Here we'll get an idea about how blockchain is enabling the asset management with trillions of dollars in the assets as a financial use case. In the next module, we'll discuss all the modern and popular use cases of blockchain in financial services. We'll start with financial use cases, then we will dig it deeper with some advanced concepts of financial use cases. Then we'll go and learn each individual use cases like global payments, property and casualty insurance, syndicated loans, trade finance, etc. We'll also cover the COCO bonds, which is one of the popular and very important use case. Next, we'll understand compliance and proxy voting in investment management, especially when it is a large company. We'll also discuss asset rehypothecation. It will be very interesting to see that how blockchain enables it. We will end this module with equity post-trade. It is the most interesting topic for everyone from equity market. We'll also learn about inclusive finance. In this module, we will have almost 10 popular and important use cases so far. Hopefully, it will be very interesting for you to know all the use cases in detail. In the 7th module, we'll exclusively discuss the next generation blockchain technologies like Skyledger, next generation Ethereum, and many other technologies. It will be the extension of the blockchain technologies which we have discussed before. Finally, we'll end this course with the most important and interesting module, which is called Startups in Fintech Space. In this module, we'll talk about how we can enhance the blockchain inside an organization. That's why we call it as a startup story. The next part will be blockchain learnings and challenges, as some of the companies have already started implementing blockchain, so it will be very interesting to talk about this. And the last one is an interesting success story. So there are already lots of existing frameworks, APIs, SDKs, all that stuff like that which we can use. That's why we call it as a startups in fintech space, especially how blockchain is enabling things. So overall, we have 9 standardized modules which are covering all of you the blockchain requirements as a finance professional. Thank a lot, and hope you all will have great learning throughout this course. Hello and welcome to the captivating course Blockchain for a Finance Professional. And in this session, we will discuss what should students know before taking this course. So without wasting any time, let's get started. So there are some basic prerequisites to take the course. Firstly, you should know at least the basic terms of technology, and obviously, you don't need to be an expert. If you at least understand the basic technology terms, you can easily understand the course content. As we use finance each and every day, so it will be good if you are familiar and comfortable with the basic finance terms. And if you have an idea about some basic business workflows like how workflow happens, what are the processes, how do we can enable the process, where it goes on the next steps, what are the sub-processes, a little kind of business process management knowledge will be beneficial. Secondly, if you have a basic idea about blockchain and cryptocurrencies and have an idea about how it works, then it will be great. But don't worry if you don't even know all these things. These will be covered and try to give you a clear vision as possible inside the course. So just refresh all the technology, finance, and business workflow terms to get an extra advantage. So that's all about you should know before taking the course. Hope you understand, and also hope you'll have great learning with us.
Hello and welcome to this captivating course of Updegree, Blockchain for Financial Professionals. Hey, I am talking about financial assets and blockchain. In this session, we will be talking about how financial assets actually led to the blockchain technology. The first module, what we are going to talk is blockchain primer. In this section, we will be dealing with the basics of financial institutions and what are the account practices. This is very important because we will be transforming the journey from a typical legacy financial technologies to the modern technologies, where we will be discussing about how blockchain is actually transforming the whole financial sector. In this journey, I will be sharing the practices and some of the components that is really required for any individual to learn and master the blockchain prima facie for the financial services. So you will be learning certain key accounting practices that is currently prevalent in the market and how blockchain is disrupting the whole space. Before, we need to understand that blockchain is categorically going to be called as Web 3.0, and which will be mainly focusing on the 3 things: immutability, scalability and transparency, and bit security. I'll be touching on in the further modules on how blockchain as a key technology will transform into the financial world. With that, I would like to start this session. So most of you might be understanding that what is business networks, markets or wealth. So if you really look at it now, businesses don't exist in isolation. That means I start a company, I'm not alone. I have to get connected to customers, suppliers, banks, partners through the business network. And this network is also cross-geography, regulatory, and it's also bound by certain rules and regulations. And what do you mean by wealth? We all know that. It's basically some total value of goods and services across business network. And growth alone, constrained if siloed, is not efficient. So basically we need to have what is markets, because markets is essentially flow of goods and services across business network, where there is an open market and where there's a closed market. So this you might be already aware of in the financial world. So the second concept which I would like to bring in is transferring assets and building value. What is asset? Anything that is capable of you own it or control or produce it is considered an asset. So it can be a tangible or it can be an intangible. It can be value or it can be converted into cash. For example, in the right hand side you see a car as an asset, or cash is also an asset. So you have a car, you have a clothes, you have bonds, you have securities, you have patents, you have licenses. Now you have digital assets, music, video, games, patents. These are some of the digital assets that's kind of built. So we need to understand what are assets and we need to build value into the assets. So when we have financial thing, we need to understand who are participants, what are transactions and what are contracts. A participant is a member of business network who may actually be a customer, a supplier, or a government or a regulator. He usually resides in an organization and he has specific identities and roles. So what is transaction? A transaction is an asset transfer between two or more participants. For example, there is a transaction where somebody is buying something or somebody is transferring something. So basically John, for as an example, gives a car to Anthony, or John gives car to Anthony and Anthony gives him the money. Very simple. There is an exchange of goods and services. So transaction is basically a asset transfer between two or more participants. So what are contracts? A contract is a set of conditions under which transaction occurs. For example, if Anthony pays John money, the car passes from John to Anthony. That we are already aware. If car won't start, funds do not pass to John because it should be adjudicated in the sense like if the car is not actually working, then there is no point in having a contract. So this contract is valid only when car is functional and then only Anthony pays money to John. So we have seen what are transactions, what are contracts, what is the basic value of an asset. So this is what we actually anticipate. This is the classic fund distribution. This is a classic fund distribution value chain. You have three layers. Basically, you have a distribution network, you have asset servicing, and you have a portfolio manager. So in terms of what is distribution network? A distribution network is where people they are the people who are like an intermediary. So they can be investors, they can be distributors, there can be companies, they can be promoter, or they can be domiciliary. And there are a lot of asset servicing people. They basically take care of the paying of agents, custody, accounting, and there are typically portfolio managers who actually have auditing, tax. They take all these in the value chain. And on the right side, you will see investment fund and the supervisory environment. So basically, you have a three-layer structure, and this whole chain works. It is end-to-end, and each one is dependent on the other one. So it's a simple one, but at the same time, you have multiple partners to make sure that the value chain is not broken. So what happens? I am an investor. The current transaction process is this. I have an investor, I have a distributor, and I have a transfer agent. What happens is, as an investor, I will apply for AML KYC, that is anti-money laundering or know your customer. And he applies again AML KYC, and an account is created. And typically then the flow starts. That's how your dollar gets processed. So as an investor distributor, make sure that all the documents are clear, and then he will open the investor account, and then he will ensure that all the checks and balances are there. And the current settlement process, similarly, if you need funds, you just have to go to the paying agent, you request him, and there is a custody which is there, which is getting approved, and you get the funds back into your account. So this is the current settlement process. And current financial process, everybody in the system has to be important. You have, whether you are an investor or a distributor or a management company, whoever is promoting, they need to have a complete financial reporting process. That means end to end, whatever the financial transaction happen has to get applied to government bodies and also the financial reporting agencies. So what are we doing as being financial institutions? A very good question. So there are a lot of questions, right? Because ultimately this whole learning is in terms of blockchain and cryptocurrencies and how blockchain helps. So there are a lot of questions. Please explain me how Bitcoin works. What is the role of a typical managers in the blockchain? Somebody is talking about whether we should build a blockchain, and is there anything that has a storage that you require like a RAM, or whether she understands how the trade can get done through blockchain. These are some of the questions. that is going in all our minds. And there is a good opportunity for professional services firms that rely on consulting, accounting, and auditing can actually get changed or transformed and help the clients, using blockchain. In other words, one of the key ways to reduce, there are a lot of research that has shown that financial institution wants to reduce costs. That everybody is aware. So one of the survey according to Deutsche Bank in 2012, they have actually cut down, measured as a percent of the revenues. Financial firms spend more than on IT on any other industry. So the financial companies are spending equivalent to 7.3% of the revenues, otherwise compared to other industries, which is 3.7%. So how much of the dollars gets invested in the IT sector. So it's easy if you have a kind of a balance and then see if the new technologies can actually reduce the cost across various cost centers. Even there is another one from 2015 from Celente that from total bank IT spending across all the regions is put together in $197 or $198 billion, and it's growing at a minimum of 5 to 8% year on year. That's very stupendous. So there is one report from Santander. Santander, as you know, is a leading bank in the UK, and they, according to predict that distributed ledger technology or blockchain could reduce banks' infrastructure costs attributable to only cross-border payments, security trading, and regulatory complaints between 15 to 20 billion. Like for 200 billion, you are cutting the cost by at least 10 to 12%, which is stupendous. So as an accountant, why it is important? Important because accountants are the key guys. They are the people who implement, settle, and store records around blockchain. So accountants will need to know how audit records are shared between, I'll come to you on the permissioned and non-permissioned ledger later. For example, an auditor should, an IT account or a financial accountant should know, the auditor should know how they should audit infrastructures banks and how they can be ready for the future. So this is one of the quote from Huckman Lab, which is one of the good labs. So accountants should need to understand the technologies because they are the line people who actually understands the records on all blockchain and accounts and auditing and reporting. So they have to be very key in this whole value chain. So this is what we have learned in the first section. As icing on the cake is what is finance, what is transaction, what is contract, what is the value of a contract, what is a goods and sales marketplace. We also understood why it is important and why banks or financial services need to be focusing on their part on technology. That's all for the session. So I hope you have enjoyed the first session of the course. In the next session, we will introduce the distributed ledger, that what is distributed ledger, how it works and everything. Thank you. Hello and welcome to this distributed ledger session. As icing on the cake is what is finance, what is transaction, what is contract, what is the value of a contract, what is a goods and sales marketplace. We also understood why it is important and why banks or financial services need to be focusing on their part on technology. So in this current section, we will be deep diving, or we'll be at least discussing what is called as distributed ledger. You have seen a quote from Santander Bank, it saves 10 to 12% of the cost. So here we will be looking at what is distributed ledger and a couple of the distributed ledger related terms. So distributed ledger technology is actually a centralized, decentralized, and distributed databases for data storage. So it's one single term. It's a decentralized and distributed database for data storage. So basically, what is blockchain? Blockchain is a form of distributed ledger technology. So what happens is blockchain is distributed across many nodes. So hence distributed ledger, unlike most databases which are centralized. And the second key point is the blockchain in each node is generated based on the information publicized from the successful mining node. I'll explain. So unlike the traditional centralized databases, there is only one or maybe couple of databases that gets managed centrally. But whereas blockchain is a distributed ledger where you have multiple copies stored in various forms and it's completely decentralized. And it keeps coming only when there is a successful mining happening in the block, and then they will understand, and this is based on the permissions given in the ledger. So it is quite useful for people if say in terms of hacking, right? Most of the databases get hacked, but in terms of blockchain, if somewhere it goes out, first of all, entering this network is little difficult. Second, hacker cannot, even he stores it, he hacks the data, you have multiple copies of the data. So distributed ledger technology is a distributed data store based on each node generated through a permission in the blockchain network. So that is what is distributed ledger technology. So that's it. I hope you got a basic idea of distributed ledger. In the next session we will deep dive into the distributed technology in advanced level. Thank you. Welcome to another session of distributed ledger. In this session we will know more about the distributed ledger technology. We will get an idea about centralized and decentralized ledger. So let's jump to the discussion. So now you see how is the difference between centralized and decentralized. Examples like some of the key things is like the centralized ledgers you have a lot of cost associated with, whereas in terms of distributed ledgers the cost is very less, that is maintenance cost. The intermediate cost, that means like the cost of involved in having the trusted third party is less in dollars in terms of centralized ledgers. In terms of distributed ledgers it's a little high, but then you cut across the intermediary layer. Then transparency, it's centralized ledger anybody can view, but distributed ledger is safe because you have very few people to view the ledger. Security, you can easily have a difficult fraudulent transaction, malfeasance, and example in the centralized ledger, whereas in distributed ledger it's much secure. So overall, like your maintenance cost is less, though your initial investment may be a bit high than the it's equally in compared to the centralized ledgers, but you have a better transparency and security. So why distributed ledgers? There are many reasons. The reasons why organizations and institutions are interested, because the biggest advantage is it is cryptographically verifiable system, and it's globally distributed for resiliency and compliant with various reporting requirements. So distributed ledgers, have you seen, you have multiple copies, it has transparency, it has better scalability and security, and that's why financial institutions want this on a regular basis. So please understand that distributed ledger technology is the future, and it all started with what we call it as a Bitcoin. So this is the cycle. So what happens is there is in terms of technology, you can actually create a distributed virtual machine, and it forms a blockchain. And when the blockchain is happening, if there is a transaction, the network achieves settlement to the transaction, and then finally the assets is transferred through smart contracts. So I'll explain what is smart contracts in a single line. A legal software code between two parties, that is receiver and the sender, through a legal line of code, which is an alphanumeric or a hash characters, is called as smart contracts. And the smart contracts has wide usage. It can be used for assets, any of the assets, for sign off. So it's a very simple thing. You have a distributed virtual machine that gets created. There is a permission algorithm that runs on the distributed virtual machines, and then once you have network it got matured, then you get sign off with the smart contracts. So centralized ledger, we have already discussed, there is a trusted third party, and central authorities certify ownership and clear transactions. Whereas in distributed ledger, it is no need of central authorities. The entire thing is done by network of institutions. So you have 40 banks. You will have to go to a trusted third party. You just have to do the certification through the institutions, and there is no one which is in charge to just go through the thing. So it's going to cut down the whole intermediaries in the process. So that is the biggest advantage. So why distributed ledger technology? It has encryption, it has mutual consensus verification, and it has smart contracts. So encryption, I have already told, it's a two-layer technology where your entire digital assets gets saved. There is a consensus. That means like there is no central party. It's a consensus between the people who are in the network. And smart contracts, a single line of code, single line of software code legally. So it is very easy. That's the first advantage. Second, data efficiencies. you have universal data source. You don't have a particular one single data source or a ledger which is owned to somebody. Unlike you have a distributed databases coming across the whole enterprise or the whole ledger. It has rich data sets because you are using the latest technology. The transaction speed is very fast. The third is you have distributed records. So unlike the records are available with one or two copies, here you have multiple records of copies. And finally, what are the benefits? You have transparent real-time data. Of course, you get real-time data with the legacy technology, but here you have transparent real-time data. So just understand the point, transparent real-time data. And second is it gives you a more efficient settlement of transactions and processing. Please understand that the core, more efficient settlement of processing of transactions. It's faster, it's time, it saves little time and is cost effective. So why distributed ledger technology and why financial organizations have to go? It's a technology innovation. It has data efficiencies and it has better benefits. So again, you have a ledger. You create. We have already seen like the whole ecosystem as a circle diagram. Now you see like once you create a ledger, it creates block 1, block 2, block 3 till block n, and you have this transaction record which is attached to each block, or it can be attached to multiple blocks. So if you really understand distributed ledger technology, basically that is the generic name of technologies pinned by a distributed ledger, where like which Bitcoin and blockchain kind of applications are available. So if you grow the ladder, it is like either blockchain or there are other distributed ledger technologies like Hashgraph, which is coming up in a big way. And the biggest use case of distributed ledger technology is the virtual currencies or the cryptocurrencies. This is actually underpinned by blockchain platform. So you have a lot of virtual currencies or digital currencies. For example, Bitcoin, Ethereum, Ripple, and you also have other altcoins. The coins which are outside of Bitcoins are all called as altcoins. So these currencies are called cryptocurrencies and they are actually pinned by the blockchain. So if you take the real bottom up, distributed ledger technology is the generic name. It has two components, blockchain and other distributed ledger technology, which is Hashgraph. The biggest use case for distributed ledger technology is cryptocurrencies, which is underpinned by blockchain. We have not seen any cryptocurrency based on the Hashgraph as of now. So hope you are understanding why distributed ledger technology is becoming more popular and popular through these slides. So in one of the surveys with the distributed ledger technology in financial systems, they understood that at least in last 2 years, awareness of DLT has actually grown rapidly. Because the reason, like if you see this slide, like it is actually activity oriented. So there is a whole global interest. So that means like more than 25 countries. This is little outdated, but there are more countries investing in DLT. There's a lot of banks which is experimenting distributed ledger technology, and there is a venture capital which is seen like 1.5 to $2 billion already gone into the blockchain, and many of the central banks like JP Morgan to everybody are using this distributed ledger technology. There is a lot of consortium efforts. That means like you have a effort like Hyperledger, which is like a merger of 40 different companies and coming in investments in this, and you will see like you will see like 2,500 patents filed in over the last 3 years. That means like it's growing rapidly. There are a lot of collective standardization efforts, and but then it's kind of getting into a formal legal framework, but it has to get captured in a much better way. So, but you see this slide like distributed ledger technology, as we have seen in the earlier slide, there are two kinds. One is blockchain is a main, and there is newer technologies like Hashgraph. But at least in the blockchain area, you are seeing these kind of data points. It's just for information. That just shows the curiosity how the entire industry is moving towards the whole ecosystem. That's all for the session. In this session, we'll learn the potential for financial applications in distributed ledger technology, and it will be going to be very interesting. Thank you so much. Chapter 4, Distributed Ledger Technology, Potential for Financial Applications. Welcome to the third session of Distributed Ledger, and in this session, it belongs to Potential for Financial Applications and Distributed Ledger Technology. So why do you need distributed ledger technology and why it is important for future of financial services? So DLT has got great potential to drive simplicity and efficiency through having an optimization of financial services infrastructure and process. What I mean to say is like your intermediary layer is cut, you have real-time settlement process which is transparent, and you have seen the other benefits. You have the data processing time is also reduced. Of course, DLT is not a panacea, but this is one of the main technologies that will form the foundation of next generation financial services infrastructure. Already cloud is leveraged by banks and financial institutions. Now they will build blockchain as the next level of financial information infrastructure. But the third point which I want to deal is that the application of DLT will actually differ by use case. For example, this can differ from trade finance to corporate banking to probably trade settlements to how share market. So it has different ways. You have different use cases, and it has diverse range of benefits. And the reason why it is is because the whole digital assets is using digital identity, and it's a critical enabler to broaden applications to new verticals. And digital fiat legal tender, because you have seen blockchain using smart contracts, it has amplifying benefits. But you need to have a caveat here. The most important is you will have to have deep collaboration between incumbents, innovators, and regulators, and adding complexity and delaying implementation. So you need to be very frank. Is it required or not? If it's required, let's have a plan. So one of the main advantages, the current orthodoxies which you believe in the traditional business model will go away with distributed ledger technology. So it is very simple it drives simplicity, it is efficient, it cuts across the next generation financial services. Any use case in the financial can actually use it, but you have to weigh the advantages. And since the whole world is moving to digital, you need to have a digital identity, especially the security part of it, and you need a legal tender which is digitally acceptable. And blockchain believes and gives you that snapshot, and it clears away the orthodoxies that is kind of available in the today's business model. So there are main 6 key value drivers which I have actually used in this. So regulatory efficiency improvement, that's one, because DLT enables real-time monitoring of the financial activity between regulators and regulated entities. It's already available, but it will more increase the efficiency. The second is operational simplification. It reduces manual efforts to perform reconciliation and resolve disputes faster. Counterparty risk reduction. It's very important because you have a lot of counterparty. You have to agree, disagree, obligations as agreement. But here it's all immutable and it's codified and this is foolproof. Liquidity and capital improvement. That means reduces the locked-in capital and provides transparency into the sourcing liquidity for assets. One of the important ones. Then we already discussed clearing and settlement time, because you are cutting away the third-party intermediaries. Actually, it validates and accelerates the settlement faster. And finally, you have fraud minimization, because you know who is a single source of truth. It enables full provenance, and you can actually track the history. Not that it is not trackable now, but it has more efficient processes embedded within the distributed ledger technology that makes it little popular for new financial infrastructure and processes. So this slide, essentially we are talking about distributed ledger technology has potential to drive simplicity, and what are the 6 value drivers. As I said, if you need to identify use case, for example, I'm using a trade finance, just look at these benefits and then you can start your use case for distributed ledger technology migration. So you have seen lot of technologies have emerged in the last 50 years. So you are currently seeing the emerging technologies in starting Industrial Revolution 4.0, being biometrics, cloud computing, cognitive computing, machine learning, quantum computing, robotics. So again, in these entire thing, distributed ledger technology is one of the many transformative technologies that will shape up future services infrastructure and should be seen as a part of toolbox. As I said, it's not a panacea, but it is one of the emerging technologies that will form the foundation for next generation financial services infrastructure. And second thing I've already gone to is this, digital identity is a critical enabler, because the future innovation actually goes on to the digital identity. So you need to move from the current state. So you have seen current state, current capability enabler, and future benefit. So this is how the concept has been built. That means You need to identify who is the person who is actually identified for transferring the information. Be it protocols, be it cash, be it any of the storing information or transferring information, transferring assets, doesn't matter. You should be actually using the digital identity in a proper way. And the benefits why I need digital identity, because it actually gives you the accurate anti-money laundering and protects the KYC, and customer onboarding is faster, and it actually improves the counterparty matching. So the current state, you have digital DLTs are denominated with tokens, but with the formalization of the financial structure, you will have more distributed fiat currencies. That means like you have a single source of currency that can be settled within the one ledger. And tomorrow's world, maybe you have a single bank throughout the world, and it is all run by distributed financial infrastructure and cutting away the whole intermediary layers, whether it is between any country in the globe. So digital identity is very key, and digital fiat is one term which you need to identify. Fiat currencies are the normal cash. So digital fiat will be the new normal as a legal tender for currencies, and future maybe like you're looking at a complete alteration of the financial system where it will be like a single world, where the distributed ledger technologies can actually replace the whole intermediary layer. So, but yeah, the benefits are many. We have to wait and watch how the whole thing amplifies. Here is the end of the session. Next, we will see how we can develop financial distributed ledger technology or DLT. Thank you. Fifth, how to develop financial distributed ledger technology. Welcome to this session, and this session is going to be about developing financial distributed ledger technology, or we say DLT. So let's get started with the session. Once you know something is coming, the most important thing is it requires deep collaboration between incumbents, innovators, regulators, and also avoiding complexity and delaying implementation. So some of the thing is, it's a mix of three things. Why it is important, because DLT will have its own advantages, but then you need to have three things into the whole structure. First, you are replacing the infrastructure replacement. Second, there should be a competing interest, and third, it should be supported by legal, regulatory, and governance framework. Very, very key. So in terms of infrastructure replacement, you are actually moving away from the traditional model, and it will require significant time. I can give an example. In the old days, like when enterprise resource planning came, where there were disparate applications, actually ERP linked the whole organization. Typically here, you are linking the whole ecosystem. So that's the kind of a change. Second, competing interests. It's like, you should have a collaborative actions between the ecosystem. That means like a supplier or a manufacturer or a customer, everybody should be in buy-in with the whole competing interest. Then implementing is easy, but then you need to have an approval. Regulation is key, and governance framework should be defined, and it should be actually acceptable legally. So that's the key which is very key in terms of, achieving the impactfulness of the distributed ledger technology. And in one term, it should be collaborated. It should be innovative only when you have all these three elements getting tied together. So in this concept, it's very important. The current state, there are information silos. There is a single version of truth. There is an asymmetric information between markets. There is no transparency sometimes, and there are lack of trust. So these are the transformative characters which distributed infrastructure will bring in. I've already told this. It's immutable. Then it's transparency, and third is autonomy. So you can understand immutability, transparency, and autonomy. I'll just give you. Immutability means it eliminates the need for reconciliation. It just provides with single version of truth. Transparency means it eliminates imbalance of information between the participants. It increases cooperation between regulators and regulated agencies. And autonomy, as we already discussed, has to be governed within the ledger. There is nobody who will going to manage it. It runs on its own, so it is completely autonomy. So there are entities who should resolve disputes by themselves. There is no agency. Yeah, it is covered by a legal framework, but then the adjustments have to be made within the ledger or within the distributed ledger the ecosystem. So the transformative characters I am again summarizing. It is immutable, it is transparent, it is autonomous. And so it needs, and why financial services will use it, because it eliminates the need for reconciliation, it gives you an imbalance. It actually takes out the imbalance of information among market participants, and it's actually executed within the intermediaries, and there is no need to have a central authority. So that's why your financial services actually is important to adopt distributed ledger technology. Yeah, so the one of the current state is this distributed ledger technology will question the need for individual books of records through immutable and distributed record keeping. This is one of the very important things. The DLT provides, I already told, transaction immutability. That means a key requirement of enforcement of trust. That means like the tamper-proof of data, in which trust is not an issue and allows counterparties to just operate with a single version of truth. Currently, assets and transaction information is stored within physical books, current state, and some physical books are actually accessed, but even you have digital ledgers which is accessible by many people. There are a lot of issues like, you can actually copy the book of record and then you can just sell it at some money because at a fraudulent transaction. But if you see the core of distributed ledger technology, you have multiple copies. It's actually, you have participant nodes, you know who is coming and approving it, and that's the potential. So why financial services will go for it is, it actually challenges the information silos. It actually gets down the central intermediaries and reduces for the arbitrage within the ecosystem, and you have complete tracking, one-to-one tracking in the whole ledger, and so it becomes tamper-proof. Counterparties can just go operate with single version of truth, and it's kind of having an enforcement of trust in the ecosystem. So one of the key things that you can actually see in the whole distributed ledger technology, and that's why when you have such technologies, the second point we need to identify is it increases transparency between markets. So the current state is that it's completely fragmented. That means like you have a varied degrees of transparency. As a result, some actors within the ecosystem will have competitive advantage based on the sometimes title, sometimes power, sometimes money. But distributed ledger technology will bring in that transformation potential. That means like it provides full transparency into transactions. It has potential to transform private records into ones which is actually promoted within the ledger, and you can promote the creation of public record, because here there is nothing about private. The people who are going to be in the distributed ledger technology will have access to all market participants, or it's all real time. So you will know who is going to access, because everybody is in the same page. So why financial services? Because so existing competitive advantage model will go off. It reduces the role of supporting entities. That means like there is opacity within the ecosystem. There are few folks who are getting profited from it. So this will kind of completely reduce that. And third thing is it actually brings in a transparency between market participants, and there is something, no secure personal identifiable information data. It's very important, right? When you have an enterprise data, it becomes sometimes like personally identifiable data. So you're removing the actors, you're making it seamless, you have a transparent system, and you're removing that information asymmetry. So these are the ones which is very important for any financial services. That's why distributed ledger technology brings in sharing information among all market participants, and it's built on single version of truth to provide transparency for historical and real-time transactions. The other point which we discussed is it reduces the information asymmetry between borrowers and lenders. That means DLT enables improved visibility into the ways in which assets are being employed through the tokenization of assets and public record. The current state here, you see like, you have a varied forms of transaction types, be it loans, be it pledging, be it asset management. And there are limited line of sight between the borrowers, between the debtors, between the creditors, and who are creating an asset value. So this opacity is actually creating a lot of reputation factors, and some of times even after rating agencies gives you an idea how it has to be done, still it has issues. But why distributed ledger technology is actually you can tokenize the individual assets specifically to a trusted ledger. That means like you can have a single line of code like smart contracts, and you can make this available in the system where all the market participants can get access. and it increases the efficiency of credit transaction. So why financial services will go for it is it promotes visibility of assets. It reduces to capital for borrowers because it limits the use of same asset to leverage from multiple parties, and it challenges the role of the current entities in quantifying risks. So distributed ledger enables improved visibility into the ways in which assets are being employed through the tokenization of assets and public record of transactions. So I'm just giving 7 principles of the distributed trust using blockchains. It would be inaccurate to label blockchains as a tool for intermediation of trust. In reality, they are enabling re-intermediation of trust. So try to understand. They are building trust. They are building original trust, single truth of trust. And blockchains enable a single degree of trust unbundling. The whole change is actually transformative, and it reassigns some of the responsibilities, sometimes weakening the current authority. The blockchain does not eliminate trust, but it shifts, it moves around. So trust is always needed, but with blockchain it is delivered, it is earned, and it's a technology. So it brings in that singular, it changes from the multiple into a singularity way. It's easy to authenticate. So the blockchain actually disrupt the existing economics of trust because the cost of delivering such now are distributed. Whereas if you really take the central distributed things, brings more trust rather than creating more confusions. So it's a shift. It's like you have to earn the shift. You have to become more authenticated with the shift, and it's delivered through relationship and trustless among all the powerful entities within the blockchain. So with that, there are 7 principles which I have covered. So we have seen, like, what is distributed ledger technology, what are the benefits, how technology can enable, and why decentralized trust using blockchains are key. With that, we will be also focusing on much more on the distributed ledger technologies in the coming modules. So that's all for the session. After that, we will consider some blockchain principles and blockchain business rules, transaction processing rules in blockchain in the next session. Thank you. 6th chapter, blockchain principles. Hello and welcome to the session. In this session, we will understand about blockchain principles. So let's jump to the blockchain principles. So in continuation, how blockchain will disrupt the financial industry, we will see in this section of what is blockchain principles and basics, and as we discussed in the earlier slides, what is distributed ledger technology and how it fits into the decentralized model. So we'll have some kind of understanding how it fits into the decentralized model. As I said, Bitcoin is the first blockchain-based cryptocurrency, and the blockchain principle started with Bitcoin, and it's a part of the decentralized ledger technology. So if you really take 2016, most of us are aware of the hype cycle. This is actually given by Gartner, and if you see the curve, the sigmoidal curve, you see the blockchain is in the top, in the sense like it is going to stay. It's going to be very mature in terms of next 5 to 10 years. Like that means like 2016 or 2017 to 2027, there is a huge requirement. Blockchain will be disrupting the whole environment. Though you have a lot of technologies that is coming through, but this is one technology is in the growth phase, and it's going to continue for next 10 years at least, minimum of 5 to 10 years before it gets plateau. So how did the blockchain start? So this is as we discussed, like Bitcoin is the first blockchain-based use case, and it all started with this small 8-page white paper, which is telling that it's Bitcoin is a peer-to-peer electronic cash system. That means it's a system of electronic transactions without relying on a trust, and laid down the working principles of cryptocurrency. So this is a white paper by Satoshi Nakamoto. We don't know the actual physical person who is he, but he was the person behind, he or she was the person behind this Bitcoin. And what happens is, the purpose of the solution was to ensure that the payments can be done from one party to another party without having any kind of intermediaries or any kind of approval or trust. So this whole transfer of payments from one happened through electronic code or software code, and that relied on a chain of transactions. That's where your blockchain started, and this transaction was stored in many nodes, multiple copies, and that's the longest chain. So the basic blockchain came from the Bitcoin use case. So to just summarize, blockchain technology was first introduced in a white paper entitled Bitcoin, a peer-to-peer electronic cash system by Satoshi Nakamoto in 2008. So what were the features? It was based on no reliance on trust. It was completely based on digital signatures. I did explain about peer-to-peer network. That means you have multiple nodes that connected in the blockchain for multiple copies of the same records. Proof of work means there is an approval mechanism within the system. You don't need proof of work means the transaction is actually executed, and all the transactions can be shown publicly. It shows, and it's honest, intermediate, interdependent nodes, and it's basically based on the computing power. So the nodes vote for the CPU computing power, and rules and incentives are actually enforced through consensus mechanism. I'll explain how the 51% that is required for a Bitcoin transaction next for this slide. But this is how the fundamental things are. So blockchain technology was entitled. So if somebody asked, it's basically started with the electronic cash system by Satoshi Nakamoto. So based on this, there's a definition. Blockchain technology is a digital innovation that is poised to significantly alter financial markets with the next few years within a cryptographic ecosystem that has the potential to also significantly impact trusted computing activities and therefore cybersecurity concerns as a whole. So what is it? It's a digital innovation that significantly will help financial markets with next few years within a cryptographic ecosystem, and it has a potential to impact trusted computing. That's where the fundamental business runs in financial. So that's about blockchain. So this is just for information. Earlier digital currencies had a problem of preventing users from double spending. That means one person spends, buys something, the seller gets the money, and seller also uses the same coin or currency to buy something. So it was a double spending problem. The same code was there, but actually Bitcoin solved this problem with a lot of maths. We will just cover this in a while from now in the next few chapters. So phases of blockchain innovation. So what does it add? It adds business value, adds services. So there are a lot of applications that is built on blockchain. These are embedded transactions, collateral networks, conditional payments, smart contracts, and so on and so forth. Overlay services, you build application, but then you need how transaction has to happen. So this includes wallets, exchanges, consumer merchant services, and Bitcoin. And apart from currencies, you have from Bitcoin, there are a lot of altcoins that is in the market. So any coin apart from Bitcoin is called altcoin, and they are in the initial stage of blockchain fabric technology. So what is blockchain? More formally, it is referred as the distributed ledger system, where participants participate in a network of database of transaction shared on a real-time basis by the parties in the group. So the network itself verifies the transaction through a consensus mechanism. That's how you can see the picture. A set of rules governing the process of agreement within the system. As blocks of transactions are verified, the blocks are logically and irrevocably linked to the one before it. So very simple. There is a distributed ledger. Participants in the network create a database of transaction. Once the transaction is approved through a consensus mechanism, a block is formed and the block is verified, and the blocks are logically grouped and linked to one before it. So that's what we call it as blockchain. So how it is bit different from unlike the centralized ledger system? This is a decentralized one, which can be copied and updated by a number of parties, with all parties copies being identical. This peer-to-peer linked transaction is embedded within them, that it becomes a computational point to modify the data once block is created. So the biggest power is that once you have created the block, it's impossible to modify or change. So this is a very great innovation, as a system. So why we are looking at blockchain? You have typically three levels of blockchain. So one is storage of the digital records. Second, exchanging digital assets. So that means like you can exchange tokens, coins, currencies, points, anything, or you can even exchange records like land records or. And third, you can execute smart contracts. Smart contracts, I explained earlier, it's a single line of code which is legally accepted. So that's easily identifiable with the blockchain. So ground rules is like the terms and conditions are recorded in a code, and distributed network executes contracts and monitors compliance, and the outcomes are actually automatically validated without third party. That's the beauty of this blockchain. Outcomes are actually automatically transacted without any third party interference. So distributed network executes contract and monitors compliance, and outcomes are automatically validated without third party. So this is the blockchain process as a diagrammatic way. What happens? You saw a user request a transaction. A request is transferred to a peer-to-peer nodes. Nodes verify the transaction with a computer algorithm. The winning node groups transactions. This forms a new timestamped block of transaction. This is added to the blockchain on to the all the verified previous verified blocks, and transaction is completed and the ledger is updated. Very simple. User transaction starts. Request is go to a node level. Nodes are verified. Blocks are arranged. Blocks are timestamped, and then the approved block is getting added to the previous verified blocks, and transaction is completed and ledger is updated. Say like there's a use case. First example is like generically told, but typically if just understand, A wants to send money to B. So what is here is the transaction is represented as a block online. So the block is broadcasted to every party in the network. So that means like here the money is kind of approved in the fourth step. The network approves whether the transaction is valid. And once the transaction is valid, it can be added to the chain, which provides an indelible and transaction. And finally, the money moves from A to B. Simple. Earlier, I just told generically that this is the money A to B, and that's how it has been transferred. So it's a very simple thing. It's a disruptive technology. We just need to understand how it works. So blockchain in a nutshell, it's an up and only system of record shared across business network. That's a shared ledger plus all parties agreed the network verified transaction. That means what you call it as consensus. So on the left hand side, it's a shared ledger. That means like only once you can append the record. Second, it's all parties are verified with the network transaction. That's called consensus. And it ensures secure, authenticated, and verifiable transaction plus cryptography, what we call as cryptography. Plus all business terms are embedded in a transaction database and executed with transactions. So that means it's a shared contract, which is kind of a legal contract or what we call it as smart contract. So what is blockchain in a nutshell? It's a combination of shared network and shared ledger plus shared contract, which works through consensus and embedded in a cryptographic way. And why it is important? Because it has broader cost participation, lower cost, and increased efficiency. So the core function of blockchain is as a historical record which cannot be modified after it's created and is difficult to tamper. That we have been telling about this. And it's a means of making and settling transaction without the need for central authority. So if someone asks what are the core function, that means like a historical record cannot be modified once it's created and it's difficult to tamper. And second, as a means of making and settling transaction without the need for central authority. So the key attributes of blockchain, let's see what it is. So some of the magazines produce it as a trust mission. Economists that said that the promise of blockchain, and the blockchain lets a lot of people who have no confidence in each other collaborate without a neutral central authority. Simply put, it's a mission for creating trust. Just a few thoughts from various papers, economists just like that. So let's start back where the origins of blockchain again back. Blockchain was created to enable Bitcoin. And the questions are Bitcoin or a scarce asset? Yeah, it is through digital mining. So Bitcoin is the first decentralized digital currency, as it doesn't depend on any central government authority. Some questions are like Bitcoins are scarce. Yeah, there are finite number of Bitcoins, that is 21 million actually available, but it may increase once the value gets increased. So yeah, real currency, it's a currency because it has a value and you can do all the transactions. And so what happens is, as more and more digital currencies evolve, the banking financial world will do changes in such a way that it will revolve around the forefront of blockchain evaluation. So we did see this case. Person here wants to do a money transaction. He goes to the money exchanger, asks for a Bitcoin, and Bitcoin he buys products and goods, and again person B takes the seller takes the money to the money exchanger bank, and he converts that into the fiat currency. So fiat currency or the normal currency that we use on a daily basis. So let's understand a bit of what is proof of work versus proof of stake. So this again, we just wanted to, a member of the network wants to carry out a transaction. Once the transaction is generated to the whole network, and individual members of the network called miners check whether the transaction takes place. This we have detailed in earlier slide also. And fourth, once the block has been verified in the network, it is the own copy of the blockchain. And whoever is successful can easily verify the block is indeed sound. If the if the transaction is valid, it produces a block containing the transaction. So it's a very 6-step process and it's very robust. Here is the end of the session. Next, we will learn some important business rules and also transaction processing rules in blockchain. Thank you. Blockchain business rules and definitions. Welcome to this session of business rules and transaction processing rules in blockchain. As we said before, for this, let's start with the consensus. So let's understand how consensus actually happens in the chain. That means like there is a party in the chain who wants to do a transaction, and he approaches the network for a ledger. Like means he goes to the exchange and he probably buys a Bitcoin and then he wants to transact. So what happens is, so you should at least have a secondary train. Main chain actually at least should have 51% computing power. That means the people who are in the chain should approve at least 51% consensus. That means like people of 51% should agree in the chain that whether in the blockchain for the transaction is that they have to check whether the transaction is valid. So that means like the consensus happens only when there is a approval. It's not an approval, there is an agreement within the chain that it has to be a valid transaction. It has to get approved by at least 51% of the people who are having nodes or who own the nodes in the transaction. So that's kind of consensus. So for anybody who asks you, you should have at least 51% approval or acceptance within the blockchain to do a consensus. So that's basically the consensus. So again, go back to the thing. What is blockchain? A blockchain is a distributed ledger that contains financial or non-financial transactions, is replicated across a number of systems in a real-time or peer-to-peer network. Every participant owns the same copy of the ledger and they get the same transaction is added. Every participant helps to determine the intrinsic immutability of all existing records. Understand this, very, very immutable. Immutable means it is a trust that is created. It cannot be reversed. It is immutable. Once done, it's done. Then it uses cryptography and digital identity signatures to prove identity, authenticity, and it enforces read and write access rights. And it has mechanisms to make it hard to change historical records or at least make it easy to detect when someone is trying to change it. So every person owns the same copy and it's immutable. That means once done, it's done. So contracts, transactions, and record keeping in the digital age. So we have seen that we have actually when we were understanding what is accounting principles, we did understand what are contracts, what are transactions, and what are record keeping. For example, in the digital age, the pace of innovation has not only done technology-driven business administrations. All companies keep records of transactions, but they don't have master ledger. So in terms of it's very important because, for example, in a contract management or a security trading, there is a huge case that is kind of complex because the more and more documents are coming through. A lot of issues in terms of how they store the records. So, for example, if you use Amazon online, like whether can retailer cards be based on Bitcoin, or Skype, like whether you have a smart contract execution or private ledger for email network. So these are some of the complexity going forward with the digital age. So these are the ones that can be addressed through blockchain. Uh, so basically, you have aggregation of transactions and by different miners. So these two new blocks can be formed from one earlier block. This is called a fork. Each fork can grow at a different place and one will be longer than the other. It depends. The shorter fork will then cease to exist and all transaction will follow the longer fork. This is a self-correcting feature as a part of governance, and this is based on the Byzantine general problem. So that means like no one can supersede the majority unless he has exceptionally computing power. That means your computing power has to be very high. And these miners typically there are a lot of mining facilities across globe that's getting popular. So it's very simple. There are different miners. Can be two new blocks, and each time a block is formed, it comes from a fork, and each fork can grow into a major place. And the person with having large computing power can actually supersede with the short fork. It's as per the written in the as of the to just make sure that it is part of a governance. So there are three types of blockchain. Please understand: public blockchain, private blockchain, and federated consortium blockchain. So I've given certain what's the difference between all three. That means access public blockchain anyone can do. Private blockchain is kind of single organization, and federated is basically you have conglomerate or the consortium of organizations. Participants, it's permissionless. You can do it anyway. No, you don't have permission. Anonymous. Private blockchain, you know who are the identities and its permission. Same thing with federated. Security, here you have consensus mechanism. We did see what is proof of work and proof of stake. I'll go in details about this again. Whereas private blockchain, it's a pre-approved participants and it's based on multi-party consensus. Same thing with federated consortium blockchain, and transaction speed is much slower in public blockchain. It's a bit faster and lighter in private and consortium. So essentially, you need to understand that security and transaction is the most key, and in public blockchain it is permissionless, whereas in private and federated it's permission, and it's you know who are the identities who are doing the transactions. So again, I'm just giving through. Blockchain is a public ledger of different of the Bitcoin transaction that have been ever executed. This is one of the old stuff, but altogether. A blockchain is a type of database that takes large number of records and puts them into a block. So this is actually defined by UK government for science. And blockchain is a sequence of electronic files in which an entity-linked transaction of data is gathered and condensed. So it's kind of from Takashi. And some Deloitte extended that a blockchain is a technology that allows people who don't know each other to trust shared value of events. This shared record or a ledger is distributed to all participants in the network who use the computers to validate transaction, and this remove the need for a third party to intermediate. So the various kinds of definitions as per blockchain. So 5 basic principles we need to understand. First, it is a distributed database. Each party on a blockchain has access to the entire database and its complete history. No single party controls the data of the information. As I told earlier, every party can actually verify the records of its transaction partners directly without an intermediary. Second, it's peer-to-peer communication. There is no approval mechanism. Communication occurs between peer-to-peer instead of through a central node. Each node stores and forwards all information to other nodes. It's transparent with pseudo-anonymity. That means every transaction and its associated value are visible to anyone within the system. Each node or use as a 30 plus character alphanumeric address that identifies it. Users can choose to remain anonymous or provide proof of identity to others. Transaction occur between blockchain addresses. So transaction is very transparent. It's just a single line of code, which is software code. It has 30 plus alphanumeric characters. So first one was distributed database. Second one was peer-to-peer transmission. Third is transparency with pseudonymity. Immutability is seen irreversibility of records. That means once a transaction is recorded in the distributed ledger, records are essentially impossible to alter because they are linked to every transaction record, and that comes before various computational algorithms and approaches are deployed, and to ensure that the recording of database is permanent, chronologically ordered, and available to all the network. So once you create a record, it's impossible to alter. you have lot of computational algorithm that was applied to ensure that the recording of the database is not at all tampered. It's permanent. It's chronologically ordered. That's very important, and it's available for anyone in the network to add. And computational logic. This is the important one. The digital nature of the ledger means that blockchain transactions can be tied to a computational logic and in essence programmed. So you can also come with more and more algorithms that actually make sure that the trigger happens at a transaction between nodes much faster. So anyone can write computational logic which can actually help develop more faster transaction processing inside the blockchain. So these are the 5 basic blockchain principles which we need to identify. The first one, I'm again telling, distributed database, peer-to-peer transmission, transparency with pseudonymity, irreversibility of records, or what we call it as immutability. Please understand what is immutability. And finally, computational logic. So with that, we complete the fundamentals of blockchain and how it fits the distributed ledger in this part 3 of the chapter. So that's all for this session. In the next session, we will cover transaction processing rules in blockchain. Thank you. Transaction processing rules in blockchain. Hello, in this session, we will cover transaction processing rules in blockchain. It is going to be very interesting, so let's start with the session. So let's continue. We have understood what is blockchain. Let's understand how transaction processing happens in public and private blockchain. We did understand what are the differences, and one of the things is private blockchain is a bit faster, but public blockchain takes a little more time. So let's understand in this section. So what is public blockchain? It is permissionless distributed ledger. It's no central control is there. Participation is open to the public. Anyone can read, write data. Verification process is open to all. Security and trust is through knowledge distribution, and it's a technology-based security. Knowledge of identity not needed. Transactions are publicly available, lower cost, slower transaction speed, and platform code is open source. That's important. So anyone can take the code, and it's open source, so they can actually develop using any of the functionalities in public blockchain. Private blockchain, we call it as permission distributed ledger. It is subject to some central governance or control. Selected group of participants, for example, within an industry or enterprise. That means, like for example, if you have a logistics industry, and then the companies which are in logistics industry can actually form an enterprise or a consortium to have a blockchain. And security due to verification, identification of controls. It's basically a technology-based security. Transactions is not public. It's kind of high running cost, but it has faster transaction speed. Foremost thing is platform may be proprietary. So why blockchain? Because blockchains are emerging technology patterns that can actually radically improve banking, supply chain, other transaction networks, giving them new opportunities for innovation and growth while reducing cost of risk. So in the right side, you see, right, you have transaction numbers on block 17, you have transaction numbers on block 18, and transaction numbers on block 19. So it is a secure and trusted record keeping. We saw that it's a immutable of transactions, contracts, or other legal tender or documents. By design, nobody can modify, delete, or even append to the record. So that's a significant aspect of blockchain, and it only happens through consensus. That's very, very important. So it reduces complexity and cost. For example, if you want to have a demat assets, like for example in the current share market, so its current system is like you have a centralized depository. Most participants are disconnected from their asset depository. That means like settling a transaction would require participants to collaborate in a flow that is slow, inefficient, and expensive. That means the participants keep doing it and it finally accepts it. But it requires a lot of approvals, and it involves third parties and potentially trade operations. It is complex. It takes a little more time. Maybe T+2 is the settlement time for any participant to get the money back into the account. So it's a little inefficient and inexpensive. But with blockchain, it just offers a direct way. Everybody is in the same ledger, and the depository is on the shared ledger, whether you are a custodian bank or a clearing parties or trade depository or trading platform or a customer. So all, if you see the bottom down, completely changes. They are all in same ledger. So when they are having a shared repository, all participants can interact with depository directly, without involving third parties and potentially making use of trade operations much cheaper and faster. So that's how blockchain is actually very important. So again, we have seen this. Suppose I as a person wants to send item X to petty B. The item could be cryptocurrency, contracts, or any records. So what happens is Alan posts a record. It goes into the hashing character, and the encrypted transaction is sent out to all nodes in the network. And once it is, then you have a verification. There's a decrypting of the message with Alan's public key to ensure that transaction was sent only by Alan. And then they will trace back the chain of ownership, who, what is it, and whether it is unspent. That means like whether it's unutilized, it's a new transaction. And once the transaction is a valid transaction, it is written into the ledger. So verification is performed by a difficult computational problem based on the value of the block. So once a node verifies a block, the confirmation is published to all the nodes of the network, and block gets added to the chain, and transaction is accepted and complete. So it's like a typical 3-6 workflow, which is like having around 3 to 4 steps to make sure that the block is complete once the validation is done inside the transaction processing, inside the chain, or inside the network. So this is another type. This is how it is. Once you have a blockchain transaction, each node verifies the transaction. So that's what you see, 1, 2, 3. So that 4P02Y is actually each node verifies the transaction. Be it one first node, second node, third node, or a complexity of fourth node, fifth node, it keeps going. So that one single transaction is actually verified for the Bitcoin dollar transaction in the blockchain. So once it is verified, a new block header comes and it attaches to the hash of previous block header. So that's how the transaction happens. First it is verified. This section is about how verifications are done, like how transactions are accepted. So earlier the transactions was 6Z8ET and Y75R5F, if you can see in the block. And you have a block header, and then you create a new block header where this transaction can go and sit either in the old one, or it can also create a new header. That means like multiple transactions are batched into a block, and this block is distributed into the nodes. Understand this? It's a kind of a computational contest. It's a kind of programmable code which keeps attaching itself to on a regular basis so that a transaction is valid, and it matches itself automatically to make sure that it forms a block. So that's a simple thing, how transaction is processed. So you have applications, banking, finance, and capital markets. You can see some of them. JP Morgan is choosing a building in blockchain on Ethereum. The other companies, Visa is trying to use blockchain for cross-border payments. These are some of the snippets from various kind of net search. And Wall Street is also looking at blockchain investments up to $1 billion. So these are the companies which is kind of going in gungo with the, be it Santander, be it Thomson Reuters, which is a research company, to Toyota, to UBS, all of them are experimenting blockchain. The most important thing is blockchain has a lot of corporate governance. So in one of the distributed ledger share clause in the Corporation Law Council, it has been given a strong backing to this initiative because it's a legal code, and it's very important. So corporate governance is definitely managed well with this blockchain. So another use case is corporate governance and EOT. For example, if there is a large company and you don't have to send physical records or by post or by courier, all that you need to know is having a blockchain, and the government, the stakeholders or shareholders can just vote it. Another one, Nasdaq is using to blockchain to record shareholders' votes. So that's again what we call it as e-governance or corporate governance or EOT. Ubiquity is used for blockchain for real estate transactions. It's used for supply chain. That means like people have started looking procurement and supply chain using blockchain. It's also tracking academic credentials on Bitcoin blockchain. It's also looking landmark transactions, including global trade using blockchain. It's getting used in healthcare. So I'm giving snippets how blockchain is actually applicable across industries, across companies. HealthIT.gov is using kind of blockchain, and you kind of have blockchain as a service. This is offered by IBM, Amazon, Azure from Microsoft. So basically, it's an enterprise offerings for developers that integrates blockchain-based apps run on the cloud. So customers can create private or coalition-based blockchains and add software to speeds development. And IBM plans to combine Watson IoT platform with blockchain apps and also to have smart contracts as a part of the app. These are some of the current ones. And you have Ethereum blockchain as a service. People are using it for ticketing, payments, loyalty programs. So CloudChain is a classic example where you get ticketing platform. And loyalty programs are increasing because any retail company they want to have a loyalty program, they can keep using blockchain. So even physical world like IP related, everybody is using blockchain. So again, it is used for fraud, starting with diamond. So even in the precious industry or the mineral industry, it's kind of used. Everledger is a very good platform. Even for content licensing and distribution, digital records management. You have songs, you have your own videos. It can be patent. It can be kind of authored and validated using blockchain platforms. And that means like you have a decentralized content distribution, like be it like Netflix or any of the content, it's already available, which is a future of blockchain, decentralized content. And even it is used in gaming, where you can actually have a professional platform for traditional football players. This is one of the ones. Private equity, you see like companies like Deloitte and other private equity players using blockchain to invest. Other applications can be in higher education, public sector, energy, even in postal services and all other gift cards. So it is numeric. So till that we have seen what is a transaction processing and typical applications in the various of blockchain in various industries and some of the use cases till now. Hope you have understood till now. In the next session, we'll get an idea about blockchain technology stack and its different layers. Thank you. We'll talk about blockchain technology stack. Welcome to this session. In this session, we'll be covering blockchain technology stack. We have seen about distributed ledger technology and also we understood blockchain in the earlier modules. In this section, we will be understanding the blockchain technology stack to a little more detail. So we had legacy eras, that is like data computation, data applications, transaction processing, business intelligence. That's all before 1994. And then we had internet years. That's like e-commerce, self-publishing, personal communications. And now we see blockchain promise, basically decentralization of trust, enabling value without intermediaries. So we did discuss that, it produces simple trail of trust and you have immutability and it's secure in better than the yesteryear technology applications. So blockchain is the new generation enabled by decentralization. So what is blockchain? We have already read through. Blockchain is an established technology, based on established technology, but it's integrating into a robust solution that actually eliminates the reliance on trust, but specifically assigns trust to the community at large having the blockchain. The established technologies are, so what happens is blockchain is a combination of many of the technologies. So it's a distributed database. That means it is having a database of blocks of transactions that are timestamped. So we did see how the blocks get developed. Then it is cryptographic tokens. That means it's public key infrastructure, which is having both public and private keys. PKIs are one of the popular cryptographic methods, which many of us may be aware. Then it is managed by cryptographic hash algorithms. Like it's like a signature for a text string or a data file, and it's based on peer-to-peer architecture. That means like every node is a client and a server. It's also happening through consensus because whatever happens, basically collectively it is endorsed within the chain, and it's a programming language. You can ability to program if then else like kind of statements. So if you really look at it, blockchain is a combination of at least 6 to 7 existing mechanisms in terms of having a robust solution. So that is the technology stack. So again, we are reiterating in a detailed way how blockchain works. For example, someone has requested a transaction. So this second part, you see the requested transaction is to broadcast to a peer-to-peer network, or what we call P2P network. You can say P2P in pink, consisting of computers known as nodes. So it goes as a P2P network consisting of nodes. Then in the nodes, what happens? Network of nodes, it validates the transaction and the user status using algorithms. So it will understand whether the correct transaction is valid, and then it gives you the verified transaction. If a verified transaction can involve cryptocurrency, or it can be contracts, records, or other information. So there are two parts. Once after the verification is done, it combines with the other transaction to create a new block or a new block of data for the ledger. The new block is then added to the existing blockchain. It is permanent and unalterable, and the transaction is complete. So you understood, right? The verified transaction can involve contracts, records, or any other information. It can be cryptocurrency. So once the transaction is verified, it combines with other transaction to form a new block or of data on the ledger. And the new block is then added to the existing blockchain, and it is non-permanent and unalterable, and the transaction is complete. So understand, if the blockchain, if the verified transaction is a cryptocurrency, then if it's having intrinsic value, then no intrinsic, then it's not redeemable. It's physical form and it exists in the network. If its supply is determined by the central bank and the network is completely decentralized. So that's how the entire blockchain works. Blockchain technology can simplify modern banking, because you have seen in some of the snippets earlier that many of the banks like JP Morgan and Santander are all investing in blockchain technology. So what is like a new process? This is a distributed consensus. Earlier, in the left-hand side, you see a centralized database and it has a centralized ledger. Whereas in this process, it is a decentralized database, distributed ledger. So that is most important. So you have current systems. How is the banking happens? It's like central bank, and all banks are related to the central bank, and it's a centralized payment system. Whereas here, if you see public blockchain, it is permission. So you have large network of people where the transaction happens, they approve it within the ledger or the blockchain. So private blockchain is within the group, and you know who are the actors. So if you see the current difference with the existing architecture, just take the internal processing system or internal transaction system. The architecture is based on central database. The central settlement process is internal. The speed is real time, but transaction cost are relatively simple, but it has third-party system. Similarly, middleware or messaging, it again secure inter-party. It is independent, but then depends on the centralized processing, and it's an external processor. That means on the middleware and the messaging. And if you see the clearhouse, again it is a third-party agent in possession. Settlement process via clearinghouse, and its limitations are complex and cumbersome and expensive. So when you take internal transaction system or middleware managed messaging or clearinghouses, the current architectures in the terms of financial and banking system, this is the current system. But whereas blockchain, if you see on the extreme right, it is a distributed ledger with cryptographic integrity. Settlement process, it's a consensus. Speed near real time to minutes. Transaction cost similar to internal databases. Benefits, it enables third-party transaction to be simple and efficient as an internal transaction. Issues, it is still maturing, but it can integrate with the existing systems and workflows. So essentially what we are telling is blockchain distributed ledgers provide efficiency of a central database and robustness of a third-party clearinghouse for complex distributed transaction without any costly middleware. So that is the biggest advantage, and your speed can be reduced from 3 to 5 days to just immediate. So blockchain runs on hash functions. We have seen that in the earlier slide. Like human fingerprints, hash function is a way to verify the fingerprint that matches a specific person, but without the ability to create the person from the fingerprint. So if you really understand, the technical design of a blockchain is evolved through a number of iterations by using hash functions. Basically, it's a mathematical operation which creates a digest of the transaction. For any input, you will have an equivalent output. That means it identifies the data and has the ability to recreate it. Thus, you can see in the figure, SHA-256 hash function is used. For example, if I give an example as Fox, it has a cryptographic hash function. The digest is DFCD3454 and so on and so forth. The same thing, if I do red fox jumps over the blue dog, then it is 008646BB, FB7D, CBE2803C, like that. The red fox jumps over the blue dog, the cryptographic hash function. Then again it goes 8F7DB and things like that. Then the red fox jumps over the blue dog. It has again unique function. And last one, if it is like OEVR or OVER, each hash function is unique. So basically, every input produces a 256-bit hash, no matter what the size of the original data. That is the most crucial aspect of this. So one of the distributed ledger technology specialists, Mr. Richard Gendel Brown, actually he said the first and most important feature is what is genuinely new in terms of scale and scope. And is that they create a world where parties to be shared the same fact from the stakeholders. I know what you know and that I know what you know. A simple it's a kind of a scale, the process that he is talking about. So who is doing what? So this is one of the example where R3 Coda, it's a company where they are trying to build a ledger, an open source distributed ledger for financial services. It's kind of found by Peter Randall, and there are like building loyalty points using EPAM, So that's the one which is kind of blockchain infrastructure for loyalty programs. Similarly, you have a future of financial structure, like they understand how does it work and they looks at the full potential scope of the blockchain. He has written several white papers on how the blockchain ecosystem looks like. It's getting mature. So R3 Corda entered some of the latest technologies in the enterprise blockchain. Then we have Hyperledger project. We will come through on each of these when I go through in third module. It's basically Hyperledger project is a community of software developers building blockchain frameworks and platforms. The key features are its architecture is based on smart contract, based on called chain code. It is hosted on container technology. If you understand many of them, containers and Dockers are the most useful ones in cloud. And they are using that. And the development is basically open source. It's collaborative in cross-industry and hosted by Linux Foundation. So it's one of the unique ones. Hyperledger is created in order to encourage and facilitate cross-industry platforms through an open source, compartmentalized, and collaborative blockchain platform. So that's the uniqueness of Hyperledger. We'll go deep dive into this next few modules. So in this one, we have seen what is Hyperledger and what is Corda. So here is the end of the session. Next, we will know how we can actually architect a global scalable blockchain. Thank you. Hello, in this session we will deep dive into how to architect a global scalable blockchain. You will understand how blockchain happens, what are hash characters, what are the functionalities, and how cryptography works. Let's understand a bit of architecting a scalable blockchain. So if you take a Hyperledger fabric, you have a consensus fabric and you get chain code A, chain code B. It's kind of smart contracts. And once the consensus is happening within the chain, within the fabric, then the kind of blockchain is formed. So apart from that, there are many more blockchain initiatives starting from physical layer, data link layer, network layer, transport layer, across layers, all the 7 layers of the communication, you are seeing investments. Like for example, in the transport layer, Docker is used and there's a P2B broadcast library. Then at a network layer, there is something called Gossip. Then data link, they are gRPC and it's made of Angular and Node.js. And HTTP2 is basically blockchain tech lab. So if you see across 7 layers, at least the top 1, 2, 3 for physical, data link, network layer, and transport layer, blockchain initiatives are actually getting created. And similarly, you have even in the sessions layer, that is PBFT, presentation layer, you have SDKs, application layer, you have Go Java. So basically, Hyperledger fabric across it fits in So we are trying to compare most of the fabrics, most of the initiatives. Like there are many initiatives, Hyperledger fabric. Now Hyperledger has taken over Sawtooth, it's Blockchain Explorer and Iroha, and there is a comparison between R3 Corda and digital assets. So you see top of them are all new initiatives, and you see how each layer actually they are investing into each layer. That means like from the physical layer to application layer, how each company is investing into this blockchain initiative. So again, we have been seeing this value of a blockchain. It is a decentralized processing network. It is based on distributed ledger. It has digital signatures. It has a programmable logic and it complies of private and public. So it's a significant opportunity, blockchain, to link disparate system of parts of one enterprise together or many different organizations from within the same sector. So if you see the fabric comparison, just there is an attribute, there is Bitcoin, there is Ripple, there is Ethereum and Hyperledger. So the top fabric comparison is built in this. For example, we will see whether it's permissioned or permissionless. Bitcoin is permissionless, Ripple is permissioned. Ethereum is permissionless, and Hyperledger we discussed it's permission. That means a private blockchain. And you have a consensus algorithm. Bitcoin runs on proof of work. Ripple is again kind of custom made. Ethereum is again proof of work, proof of stake. And Hyperledger is basically open source. It's basically based on Byzantine consensus algorithm. And smart contracts in Bitcoin, it is stack-based scripting language. Ripple doesn't have any smart contracts, whereas in Ethereum you have Solidity. And in Hyperledger, it's Golang. And if you see the cryptocurrency, yes, Bitcoin has BTC, Ripple has XRP, that is XRP Ripple coin, Ethereum has ETH, and actually Hyperledger doesn't have any cryptocurrency. And finally, Bitcoin doesn't have any encryption, whereas even Ripple doesn't have, and Ethereum has a smart level contract level confidentiality, but here fabric level confidentiality is there, plus it's a chain code in the Hyperledger. So exactly you have 4 to 5 attributes, and you can see the comparison of how Bitcoin versus Ripple versus Ethereum versus Hyperledger is kind of getting used in the market. So debt developments for future applications, you see a lot of applications. You have cryptocurrency, you have registry which is used in the land records, you have values ecosystem, you have value webs in the finance world, So basically, everybody is using Ripple, R3, Factom. All these people are using, and even it's been tried by Nasdaq. So it can be opportunities, domestic and international payments, trade finance, and capital markets. So we have seen this cryptographic hash algorithm is used in Bitcoin blockchain, but SHA, as they popularly call it, secure hash algorithm, is one of a number of cryptographic hash functions. So basically, a cryptographic hash is like a signature for a text data file. It's like a algorithm is used in Bitcoin, and it generates a 256-bit or a 32-byte hash. And hash is one way of function. It cannot be decrypted back. That means we have seen this example. The quick brown fox jumps over the lazy dog, and you see a hash function D7, A8, DB, which is on the right hand side, 07, D7, 8094, 69CA, 9ABC, 0082EF4, so on and so forth. So if you understand the blockchain technology transaction layer, there are other blockchains from those Bitcoin systems. There are also variations in the way process to create blocks in other blockchains. Bitcoin's transaction layer only handles cryptocurrency transfer. But in other blockchains, it is used for identity, property titles, logistics, etc. We have seen that all other use cases. But if you see the common denominator with the blockchain solution is a blockchain provides inherent trust mechanism and immutability of data without intervention of trusted parties like banks. That means the common denominator is that it has a transaction layer. It runs on transparent inherent trust mechanism. It is immutable, and it doesn't have a centralized intervention of current trusted parties like banks. So this is the variation. It comes from the current industry applications. So you can see in this example how previous block with the height and header hash, they keep adding to that to form new block. It's just a representation, just for your information. So you can see like block depth and block height. One thing you have to understand is blocks are normally referenced from their block height number. In how many blocks from the first block created in 2009, at least in the sense of Bitcoin. And then block depth is the depth of block of interest from the latest block. That means at what depth it goes in each block. The deeper a particular block is from the latest block, the more difficult it is to alter the transaction of the block. So you understood, right? One, blocks are normally referenced from the previous block height number. Block depth is the depth of block of interest, which contains transaction from the latest block. And the deeper the particular block is from the latest block, it's very difficult to alter the transaction. This doesn't mean that the later blocks are easier to alter. This explains that it is much more difficult. So this makes only one statement, that immutable, or it cannot be modified after creation. That's what we have been telling. It is the more deeper or doesn't matter. It doesn't mean that blocks are easier to tamper. So it's very difficult, and that property, what we call it as block height and transaction immutability, is the most crucial in blockchain. So it depends on each transaction. As the transaction happens, it keeps attacking to the same block. You can see block 1, block 2, block 3, block 4, block 5. And the more successful mining you have, the adjacent node 1 becomes mining node, and adjacent 2 to adjacent 1, then adjacent 3 to adjacent 2. This is how it happens. Basically, it is verified and assembled as information on successfully mined block is passed to the adjacent nodes, and the other informal, unverifiable, non-compliant will not be passed to the adjacent nodes. So that is important. Which is verifiable, which is verified, it will move on to one adjacent node to another adjacent node. The one which is not compliant will not move to the adjacent nodes. That's all for this session. We will understand the blockchain generations in the next session. Thank you. Hello, welcome to the session of blockchain generations. In this session, we will get an overview of the blockchain generations. So we will understand how block generation and overview. Basically, you see Bitcoin transaction as example. It creates a selected transaction, and the transaction hash is passed down to kind of a Merkle tree. It's a hash rate which happens within the system that is existing within one block to another block. So if you just look at the double hash, how the system is calculated, it's a target computed by the system passed on by several parameters, such that every block can be mined approximately at every 10 minutes for the previous block to arrive at a solution. So that means like it's a kind of a Merkle tree, and nonce is just a kind of a number. And so before every 10 minutes you have a block that kinds of get assimilated between each block, and the hash rate of each block is different from one hash rate to other hash rate, and it kinds of gives you a proof of work, like in terms of how the whole this thing is anticipated. If the mining all characters is met, Then it goes to node 1, node 2, node 3. So basically, the output of the block is complete when the proof of work is complete. It's very easy to, it's little transactional based, but then understand that a system calculates the block depending on the mining process and how much investment has gone into the compute power. And in terms of Bitcoin, this is around 10 minutes. So for every number of hash that's created with other inputs, it kind of get attached to the previous hash with a timestamp. And then it forms a block. And then the whole block is kind of given proof. And then it makes a node, and in each node you have different blocks. So basically, this is kind of Bitcoin transaction block, but again, this is a very crude system that we have just put it here. We don't have to go through more technologically, but just understand that a Bitcoin based transaction block gets mined up once in 10 minutes, and you have it's like a hash transaction which is based on Merkle tree, and there's a timestamp to that, and every accepted block with the adjacent nonce value given output gets attached to the previous block or the new block, and each block gets on to added to each node which is found adjacent. That's the only thing. That's a summary of this slide. So as I said, every Bitcoin or any other blockchain transaction has based on encryption. Basically, it's a transaction level security and it's one way. We have seen hash functions, and it cannot be reversed. Each Bitcoin address is either a public key or a private key. That's the only essence of this slide. So we are trying to explain what is a block hash header target. The network is attempting to find a block whose header hash is less than this. So as you see, there are a lot of zeros at the beginning of that hash. The meaning that acceptable range of hashes is much smaller. Hence, it's more difficult to find a hash. It will take an average of more than 150 quadrillion hash calculation per second to the network to discover the next block. That seems like an impossible task, but fortunately, the network is bringing 100 petahashes per second of processing power to bear, which will be able to find a block in next 10 minutes of an average. So just understand, so much of power is required to make sure that the next block is kind of created in next 10 minutes on an average. Let me explain how blocks linkages in a chain through proof of work. The proof of work is a computationally intensive process called mining, and all mining nodes will race to generate the proof of work block after block. So understand, it's a computationally intensive process called mining, and all mining nodes will race to generate the proof of work block after block. After block is formed, resulting from successful proof of work, that means the communication is accepted to other nodes, it would become very difficult for earlier transaction to be altered. Hence, its security is very high. So what is proof of work? It's a computationally intensive process called mining, where you can generate mining nodes to generate blocks. And at least in Bitcoins, they are kind of rewarded with 12.5 Bitcoins and transaction, but this has come down very well now. So you see block 51 kind of proof of work done, then it goes on from more secure, like, block 52, block 53, block 52, block 51. It keeps going, and the more and more mining power happens, the more and more generation happens using proof of work. So there are other alternative proof of work is proof of stake and proof of importance in other blockchain. This is more towards Bitcoin. So summary of transaction immutable through blockchain. Each mining node verifies transaction using previous block header hash and timestamp before it starts mining. Mining nodes will mine concurrently to solve a mathematical problem. We have seen this. The node that first successfully mined creates a block which relays its block information, that is transaction, previous header, block header, timestamp, and mathematical called nonce, to the adjacent node. The adjacent node will verify that all the information provided by the successfully mined node is correct, or before creating a block and relaying the same information to the adjacent node. So very simple. Each mining node verifies transaction, and it solves a kind of mathematical puzzle. Once that is done, then it relays its information, that is transaction, previously blocked header hash, timestamp, and the mathematical solution called nonce to the adjacent node. The adjacent node will verify the information, and again it goes on and the process is completed. So in the event that if the same node is giving incorrect actions, the receiving node will reject, obviously. Thus, the immutability is assured through blockchain creation. That means like earlier blocks are linked and distributed blocks, databases in blocks in adjacent node. The best thing is that the system assures trust without relying on a single party. So at least in a strength, like there are over 6,000 nodes, that it is unlikely that immutable will be compromised. This is the core strength of the blockchain, that called attention of the many observers. So blockchain, what we call it as distributed ledger. So in the event if there is a default issue, the adjacent node will not receive the information. So it will kind of create with adjacent nodes, and so again it is very difficult to tamper. That's why it is called as distributed ledger and immutability. So basically, this is how the transaction happens in a Bitcoin. That means it goes from one person to another and one wallet to another. And miners generate millions of hashes. They get incremental norms, and each norms will create a new hash. So that's how the Bitcoin, just for a representative purpose, the hash must include a number called norms. So basically, there are 3 steps to create a new block. Miners must find a hash, meet specific requirements. Hash requirement should have a header of previous block. It should be less than the target number, and it should include a number called norms. So this we have seen in the earlier slide also. So what is the security benefits of blockchain? A blockchain approach promises additional security needs. It standardized data, and it has more data efficiency and data acquisition. It actually offers a path to transfer data ownership rights to individuals. It removes need of trust to a central utility, which that current one will not applicable. It protects data through immutable records. That is all seen on the right hand side. It is data protected through tokenization because tokens are PKIs or the key identifiers. It's real-time processing capability. With all these complexities, it still process real-time. It has multi-sign authorization and capability, So that's the beauty of this entire process of blockchain, and that's how it's more secure. So let's understand what are the components. You have 3 components of a blockchain. You have a blockchain ledger, you have a blockchain distribution, and you have a blockchain consensus. So let's understand each one of them. What is blockchain ledger? A transaction ledger where each transaction is tied to the previous transaction by a cryptographic hash to the entire ledger every time there is a new transaction. Got it? So it's a transaction where each transaction is tied to all the previous transactions through a cryptographic hash, and each ledger procures whenever there is a new transaction. What is blockchain distribution? A system where all participants is in the consensus model and have a complete copy of the distributed ledger. And distribution can be public, partial, or with security rules. It can be even private. A system wherein all participants in the consensus model have a complete copy of the entire ledger. That's what is called as blockchain distribution. And distribution can become public or partial with security rules. And blockchain consensus is a process used to with distributed ledger that ensures all parties can agree on the validity of transaction and on the entire ledger. And what is blockchain? The 4th component can be considered as smart contracts, which is a process used to with distributed ledger that ensures all parties can agree on the validity of transaction and on the entire ledger. And what is blockchain? The 4th component can be considered as smart contracts, which we will go deep dive in the next few modules. Hope you understand and get an overall idea about the blockchain generations in the next session. We will know what is smart contracts, traditional contracts versus smart contracts, etc. Thank you. Welcome to this session. As discussed, in this session we will discuss about smart contracts, traditional contracts versus smart contracts, introduction about the fundamentals of smart contracts. So let's jump to this topic. So what is smart contract? We are seeing traditional versus smart contract. It is between 2 parties. Its execution is faster. Whereas in traditional contract, you have third party and execution is problematic. So smart contracts happens in minutes. Traditional contracts is, let me define what is smart contract. It's a single line of legal software code. And in smart contracts, you have automatic remittance, and in manual contracts, it is manual remittance. Here, escrow is not required. In traditional contract, you have need a escrow. It's a fraction of the cost, very expensive. It's virtually present. It's physically present. Lawyers may not be necessary, and law is necessary. That doesn't mean that smart contracts will get away with the lawyers, but then it is to be a new generation smart contracts where the execution is faster and it's more trustable and transparent, and actually it is immutable. So smart contracts, what does it define? It is not actually contracts. It's application based on the blockchain protocol which executes, verifies, and enforces the performance of a contract. So it's an ability not to store what has happened in the past, but also impact what happens in the future. It's actually intended to have paperless transactions with exchanges, cross borders in a secure way. Understand that it's a paperless transaction with strangers across borders in a secure way. What are the advantages? So it's not a contract. It's basically application based on blockchain protocol. It executes, verifies, and enforces the performance of the contract. So advantages being it's automated. No central authority is required for record keeping. Fully automated and self-enforcing, which is ideal for escrow and other conditional payment arrangements. No counterparty risk, and it has uses of oracles. Basically, it has web services where You can trigger information through contract enforcement. Example, price of commodities, transfer of money, legal filings, quotes, scores, etc., etc. So to summarize, it's not an actual contract, it's an application-based protocol for performing a contract. It facilitates paperless transaction for cross borders in a secure way. It is automated, it is fully self-enforcing, and we use oracles to trigger contract enforcement. That's smart contract. So it's ideal for automatic transaction underlying the infrastructure of financial transaction and transaction within few continuous. So understand, you have a lot of issues in the financial transaction. So this is very ideal for financial transaction automation. It's well suited for escrow and conditional payment that we have already seen. So parties to smart contracts will be using code, that is software code, to develop the contract as agreed by the parties. So can lawyers become coders? Yes, maybe in future, or already it is started. So I'm just giving some of the examples where smart contracts are applicable. Use case, simple to complex. Digital value exchange, where kind of Bitcoin, that's a contract between coins. Smart right, basically consumer buys an item online, you get a right. Basic smart contract, a seller gives you a motorcycle and then he gives access to the smart motorcycle lock. That's kind of smart contract. Then multi-party smart contract, that seller lends buyer from funds to buy a car. It can be a corporation taking care of sales and exhibitions via shared ledger. A shipping company having multiple contract arrangements with a lot of consumers. Then a government is basically like all the public distribution and stuff like that. And it's also autonomous society. So you have various case examples that moves from simple to complex on a smart contracts. Now, what is smart contracts? Lawyers will need to be like more programmers when they draft legal agreements. They should articulate the logic that will govern the relationship between two or more people in a way that the contract can be translated to a code. So it is going to simplify the legal drafting, more deterministic on a software base using the contract. So lawyers may need to collaborate with software engineers, and technology will work neatly because you have standardized templates or the forms with agreed terms, and potentially you have an issue automatically performs which is like legally modified, revoked, and it completely removes the fraudulency in the aspect. So if there is one party which is trying to dominate with the other one, you can completely reuse smart contract to get away with that. So there's a question, will lawyers become programmers? Yes, maybe, but yeah, we have to wait and watch. So what happens is, if you see current paper-based systems, it drives $18 trillion in transactions per year. And consensus protocols is important. So for that, smart contract code, this enables peer-to-peer trading of everything from renewable energy to automated hotel room booking. So everything can be contracted through smart contracts. So that's a potential also. You are replacing 18 trillion transaction market, starting from renewable energy to automated hotel room bookings. So let's understand what is Hyperledger. Hyperledger is an open source effort to create cross-industry blockchain technologies. It is a global collaboration hosted by the Linux Foundation, including the leaders in banking, IT, IoT, supply chain, manufacturing, and technology. It's a business blockchain frameworks are hosted with Hyperledger. The Hyperledger addresses some important features for a distributed ledger. So it is a collaborative project under the foundation. It is collaborated with Linux Foundation, including leaders in finance, banking. And you can visit hyperledger.org. Basically, it's a framework which is cross-industry, cross-functional, and being supported by many leading organizations. So you have a lot of Hyperledger projects: Hyperledger Burrow, Hyperledger Fabric, Hyperledger Iroha, and Hyperledger Sawtooth. So what is Hyperledger Burrow? It's a permissible smart contract machine with a blockchain client built into the specification of Ethereum virtual machine. So understand that it's based on Ethereum virtual machine. So there's a smart contract embedded with the contract. Hyperledger Fabric, it is a foundation for developing plug-and-play solutions with modular architecture. So if you want to build any decentralized apps, this will be the best fit. Hyperledger Fabric. Hyperledger Iroha is a blockchain framework designed to incorporate infrastructure projects like your cloud and other infrastructure. Hyperledger Sawtooth is a modular platform for building, running, deploying distributed ledgers. So you have each one of them: Hyperledger Burrow, Hyperledger Fabric, Hyperledger Iroha, and Hyperledger Sawtooth. Each one was an independent project. And when the Hyperledger became matured, all of them got into one, which is called a Hyperledger. Each one has its unique use case. So we have been talking about what is Ethereum. Let me explain what is Ethereum. Ethereum is a decentralized platform that runs smart contracts, applications that are exactly programmed without any possibility of downtime, censorship, fraud, or third-party interference. So Ethereum was actually bootstrapped in August 2014. And it's developed by a foundation called Ethereum Foundation, a Swiss non-profit with contributions from individuals and organizations. So Ethereum is a decentralized platform which runs smart contracts, applications that run like a program language. It uses Solidity, and you also have a cryptocurrency called Ethereum, Ether. So what is Ether? Ether is a crypto fuel for the Ethereum network. So it's basically a necessary element. It's a form of payment made by the clients to the platform, to the machines executed for operations functioning so that developers can write quality applications. So the Ether supply is dependent by the donation that comes through the usage of Ethereum. Developers can intend building apps using Ethereum blockchain. Users who want to access the interactive smart contracts and anything can also do. So basically, Ether is a crypto fuel that brings in funds to the Ethereum platform, and the developers can build apps for using it that can use Ethereum blockchain. And if they want to use smart contracts, again, it's open source, so Ethereum blockchain can be used for smart contracts. So with that, we kind of complete some of the hyperledger transaction processing, how it happens, and Ethereum to a certain extent in this module. Hope we have understood whatever we have covered so far. Now it's also imperative to understand what are the key challenges to blockchain technology. Let's discuss about in the next session. Thank you. Hello, let's discuss about the key challenges of blockchain technology. So we have listened to a lot of concepts in blockchain, distributed ledger technology, and how transaction processing happens in earlier chapters. Now we will be covering a bit of why challenges to blockchain in terms of, there is widespread adoption, but it's not still a kind of full-fledged solution. So let's understand few of the blockchain, but innovations are coming across to make sure that the blockchain is going to improvise in the next probably few months or so, and it will be kind of widespread after, as you saw in the Gartner hype cycle, next 5 to 10 years. So first of all, challenges like legal, sometimes of clearance in terms of legal. So you have some kind of existing laws and see how it can be applied to blockchain developments, but many foreign regulators across globe are kind of evaluating this. For example, Department of Treasury, US Commodity Futures Trading Company, then the International Exchange Commission (SEC). So many of them are looking to see how they can actually use blockchain for their current addressing the problems and giving a solution to deployments. So the legal issues are there, but then they are getting to sort it out. The regulatory environment, regulators are focusing more on how they can actually make sure that currently how blockchain can be implemented. For example, in a recent thing SEC met and see how they can actually use futures and how they can make cryptocurrencies as a part of how they can want to regulate cryptocurrencies. They are also looking at how they can use exchange traded funds using cryptocurrencies. There's some of the discussions going on. So these are some of the examples. For example, NYS New York bit license they finalized in June 2015. The first agency to release a comprehensive framework for digital currency to know your customer. And basically, there are a lot of issues still, but they just issued a kind of a money transmitter license. It was treated like a money transmitter license, what they call it as a bit license. And basically the keystone is the main aim is to protect consumers, so anti-money laundering and know your customer, and in terms of borderings without shifting the innovation or the benefits. So this was one example. Then FinCEN started one of the CFR, the code for regulations like money service business. It's called 31 CFR 10.100FF. So this does not differentiate between real currencies and virtual currencies. And exchanges and payment processor are considered to be money transmitter unless a limitation or exemption applies. So this is one of the FinCEN in one of the this regulatory. Then you also had CFTC environment that was in May 2016. Again Hong Kong Bitfinex. So they was fined, and they're basically, this is just for information. So I'm just covering through some of the regulatory environment that has gone through in last couple of years over cryptocurrencies, blockchain, and and virtual currencies or digital currencies. Then IRS guideline in March 2014, March 2016, there was a California bankruptcy court under fraudulent transfer. So they said that IRS virtual currency guidance, virtual currency is treated as a property for US federal tax and general rules for property transactions. So they proposed it like virtual currencies are like what you call as property, and whatever tax liabilities are available for tax for property, this will be also equally available. So from Bitcoin to blockchain, we have a lot of regulations, a lot of consensus, but the thing is, FinCEN found a rule in FIN 2015 R001 in response to a company that provides internet brokerage service between buyers and sellers of precious metal. So they kind of used Bitcoin blockchain, and they were telling whether trading can be done or not. So they just give the answer. So basically, this falls under the money transmitter. So they gave same reasoning, and any service under assets and digital will be subsequently freely traded. So that is the finding. So this is one of the use case that, for the example that was there in 2015. So similarly, what are the challenges to blockchain in terms of smart contracts? First of all, it's a real world verification. So is there any that, how do you find the property may have to verify under existing laws or certifications or third party authorities still be needed? Second is proof of identity. How to prove an identity is a trustless network? How will one link blockchain address to satisfy, know your customer and related obligation? Those are one of the good questions. Many banks conglomerate or getting into conglomeration see if they can have one ledger where all the banks can verify the customer. Then taxation and bankruptcy, digital currency is treated as a property, and how tangible are there for blockchain assets under the tax or bankruptcy law? That is still a $100 million question. Jurisdiction is a centralized arena where transactions are running on international computer network without a central place. So how, in case of some deviation, fraud, which jurisdiction they go? Force majeure, what is unforeseeable seen in the blockchain world? Real relationship to real contract, how to address issues within agreement to which smart contract it relates. There are a lot of input transactions also, or input control, and then deviation, fraud, and all coding errors, how to address. So basically, there is a blockchain and law working group which is kind of getting these answers, and so that customers can be really coming out of the pain. So still compliance with UCC contract issues. How will blockchain mesh with existing UCC definitions? So they have given some under Article 9 of the UCC. Basically, it's a general intangible, means any property including things in action, forms of chattel paper, commercial dog, deposit accounts, and everything can be considered. Or investment property means a security, whether certified or uncertified, security instrument, security account. So this is the kind of challenges with smart contracts as well. Or should it be treated as a financial asset? So they've given some, what do you mean by financial asset? So there is a definition, or can blockchain be treated under financial asset? So these are some of the costs, again under article of UCC. So the other one is seen some legal challenges. How can we define, under what criteria can we define, whether it's legally permitted? Do I have an obligation? Where to go in terms of fraud? All these questions are there. Next question is, how do you do the challenges, in terms of security? You have heard a lot of hacks happen from the exchanges. Some of the high stake cut down happens in blockchain. Like a lot of exchanges got hacked recently. So many customers data got hacked. So what do you do there? That's one of the biggest challenge. So there was a big thing, in 2016. DAO was a crowdfunded investment firm, and what happened is the hackers found a software bug that allowed an investor to cash out shares repeatedly before system determined the user's account was zero. That means he was trying to take the money before the investment becomes zero. So that's a kind of bug. And that's how they utilized and hacking completely hacked. This is in June 2016. So what are the challenges? What are the applicable laws? So you have a deep dive of a lot of laws actually. So which jurisdiction laws apply? It can be under taxation. It can be under privacy and data security. It can be cross-border transfer. It can be how to determine whether any breach occurred or not. You need to balance confidentiality, traceability, and cybersecurity. And is there any conflict of laws consideration? So how will changes law be addressed in blockchain architecture? How would court orders be enforced and implemented against whom? So they kind of have what they call it as legal status of decentralized autonomous organization, or DAOs. Some questions need to be answered, and in the similar way, you need to understand the potential use of this blockchain. So we need to have a weighing average of how you can use the blockchain versus how laws can be applicable. So there are other issues like collaboration issues. In terms of, if 2-3 people are holding, distributed ledger, for example, Ethereum Enterprise Alliance, R3, which is Corda, digital asset holding. So how the collaboration will happen, whether ability of blockchain to be used to collusion or exchange sensitive information, or do they have the technical standards, or they are a potential dominance of few or blockchain providers, or is it a closed access granting of refusal to private blockchain, but then who are the gatekeepers in this? So you have various questions, and we need to answer this. Consortia. You have famous consortia Hyperledger, but we will have to see how we can outline the steps. Then you have intellectual property rights, as and when everywhere. Infringing materials on blockchain. Who would be responsible for infringement? Then is something like, if some service provider broadcasts blockchain wrongly, those things. And could takedown request be compiled with, and what are the applicable laws to blockchain providers, so on and so forth. The reason to highlight both is as a financial professional, you should be able to articulate What are the challenges and how you can address the business challenges for the blockchain in case you are going for a use case in your, say, for a bank or for an insurance company or for a tokens or a wallet. You need to be understanding what are the legal issues, security issues, intellectual issues, and so that you have a proper usage of that of blockchain. So wave of patent filings, you see a lot of in last 1 year. If you see USPTO, the wave of patent filings have gone up, starting from JP Morgan to Nasdaq to SEC to Hong Kong, Shanghai Bank to Santander. Everybody's filing patents on blockchain, and the highest in terms of software development is coming from, I think, from IBM. So you see on the right hand side, Bank of America, Goldman Sachs, JP Morgan, Citibank, Bank of New York Mellon. So they're all submitting patents using open source or the blockchain that is kind of getting developed. So mainly as an intellectual property, efforts to own blockchain will necessarily focus on improvements in the technology. Underlying principle is that whether it should be with better encryption and it should be applicable to any kind of application, or it should have innovative ways of particular purpose or fields. For example, if it's like a banking field, it has to be. And can we call it as a patent pooling in terms of, if you have common thread between the blockchain, can we do a patent pooling? How we can structure it? These are some of the questions in terms of intellectual property issues. But there was a court case in terms of Alice Crop versus CLS Bank. Is distributed ledger an abstract concept that is not patentable? So there was some question and there was a case and the analysis was done by the lawyers. It was still unsettled and inconsistently applied. So this was one patent issue. There was another filing on October 31st, 2008 and revealed that there are 879 filings mention Bitcoin, blockchain or distributed ledger. So this is how the list is, the blockchain patent rush. 824 mentioned Bitcoin, 159 mentioned blockchain, 55 mentioned distributed ledger. These filings have resulted in 150 issued patents and 729 published patent applications. And there are some 488 unique fillers. So this is some of the filings till February 16, and from February 2017, of course, I have not updated the data, but they have seen a lot of filings, more than 1,000 patents have come, I guess. So other one is it's also open source. Some open source have patent grants and some realization process, so we need to be very careful of that. So certain conditions, we need to be having auditing on what is for compliance and how you can know your customer, how to address the fraudulent activities and errors, how do you manage the tax and bankruptcy, who is liable for blockchain failures, what is dispute resolution in terms of a patent clash, or post-merger, what happens if something like completely down, or it also performance management of performance versus service levels. So these are some of the alerts that we need to be having, and we should be able to plan. And keeping away with all this, blockchain is still a very good technology and it's going to rule the future, no doubt about it, but then we have to be aware of certain facts and figures. So we saw about the challenges, but then you can see every sector almost like in the way of blockchain implementation. Whether it's consumer products, manufacturing, technology, media, telecommunication, healthcare, license, it doesn't matter. Everybody is indicating. There was a survey and they said like 39% of senior executives, large US companies, said that they are kind of deemed crucial for their companies, and 42 believe is that it will disturb the industry. So cross-industry adoption, cross-industry IT frameworks, open source, and there are so many things that we can discuss actually. Financial industry, definitely noted. We have been seeing some of the financial industries saw opportunities in blockchain, and they've been heavily investing in usage primarily as a part of private implementations. And the second use case is identity management, because as one of the issue is like how do you manage a physical asset versus identity? How do you map the identity? So you have to have corresponding entities to identities, identities to attributes. So that's where the diagram is showing. So basically, you should have identity management concerns, protecting the access of data, where to store the data, with GDPR in place, how do you store the data, report the data, what is ongoing resource dedication. And of course, there are multiple solutions available, but we need to be figure out the fact that identity management is an area that will be certainly impacted by widespread use of private keys to secure transactions. So you need to have audits at a certain place, and you should also have strong identity management attributes inside the blockchain. And it's also creating a lot of waves in distributed access management, not only creating identity on blockchain, but it also has access control over their personal information to access. So like areas impacted can be like your passports, e-residency, birth certificate, wedding certificate, IDs, online account logins, etc., etc. And digital ID can provide digital watermark that can be assigned to every online transaction of any asset. So see the use case, right? Once we get the usage, it'll be easy for us to identify which digital ID and what's the use case or what is the utility that we are going to do. So blockchain can actually give us that immutability, right? So once you create a record, This record can be verified for any of the purposes. And it also has protecting the private keys, right? With blockchain, trust relies on safe keeping of the private keys in support of the truly distributed identity management. So we need to be cautious of the fact that, safekeeping resides very important how to secure the private key. For example, cryptocurrency traders, they always say like, write a piece of paper and put it for safekeeping, like you're putting it in an actual physical locker or safe deposit box, as we call it. So there are a lot of digital identity solutions. Netkey, a blockchain startup, found the digital identity solution. Released at Consensus 7, like this app can use Hyperledger to provide decentralized open source identity management. And this is also kind of approved by anti-money laundering and know your customer. This is one of the solutions, but there are thousands of solutions now available in the market on digital ID. So we saw like what are the challenges, how blockchain is actually transforming. There are various challenges, security challenges, legal challenges, IP challenges, coding challenges, and then there's also transcribing of how blockchain is changing in various industries. And we have seen some of the use cases like digital ID and the banking solutions and stuff in this chapter. So that's it. I hope you get a basic idea on the key challenge of blockchain technology. In the next session, we'll deep dive into the introduction of cryptocurrencies and more. Thank you. Welcome to this session. From this session, we'll start understanding about cryptocurrencies. So if you don't know what is cryptocurrency or don't have a clear idea about cryptocurrencies, just grab these sessions and start learning about cryptocurrencies. So we have seen what are blockchain challenges and things like that in the earlier chapter. In this section, we will be focusing on cryptocurrencies, a very important use case of blockchain technology, Bitcoin being the first use case of cryptocurrency. And actually, the blockchain started with Bitcoin. So let's deep dive into a bit of introduction to cryptocurrencies. So mining is an evaluation that actually started in the process where they can create through transaction processing that occurs every node on the network that we have seen earlier. So in 2009, one could mine 200 Bitcoins with a personal home computer. And in 2015, it would take about 98 years to just mine one Bitcoin using a personal home computer. Today, there is almost no money to be made through traditional home mining because there is a specific circuit which has been designed strictly for mining Bitcoins, that is like application-specific integrated circuit. And what happened is there is a transition, like, group of miners have formed mining pools for which they are relatively paid share for the contribution of the work performed. So it is completely changed. So what is the difference between currency and a cryptocurrency? Here it's backed by sovereign, that means it's a thing, and it's backed by users in terms of cryptocurrency. It's controlled by a central banking system in a traditional currency or what we call it as fiat currency. And here it is controlled by users. Easy to steal, cryptocurrency bit difficult to hack. Hard to transport, it's very simple, line of code. Relatively easy to trace, here it's little anonymous, because Bitcoin provides you a kind of example where you hide your identity. So what is introduction to Bitcoin? It is a virtual global currency. It's tracked in public ledger. No issuing entity, we have seen. It is traded online using peer-to-peer networks. It runs on open source protocol. That's strong encryption. So if somebody asks what is Bitcoin, it's a virtual global currency. It is tracked in public ledger. It's issuing it no issuing entity. It's traded online using peer-to-peer. It's an open source protocol and has a strong encryption. So this was somehow started in 2007 by Satoshi Nakamoto, and we have seen many companies in 2014 started accepting Bitcoin. So what is the technology behind Bitcoin? That's what we understood as blockchain. So you first think of Bitcoin as an electronic asset. It's a digital currency. So basically what happens is a network of computers keeps track of Bitcoin payments and keep adding to the list, and they become more and more chain. And that's what it is called as Bitcoin blockchain. The file that contains all the data is often called as ledger, and it is transacted through transaction processing that is called mining, which is distributed through processor called nodes of the peer-to-peer network. So it's very simple. It's an electronic asset. It's a digital currency. You can actually make payments online in the blockchain using Bitcoin blockchain. It is transaction, what is called ledger, and it's processed through mining and has a distribution through nodes. Well, this is quite confusing, but basically you just have to understand how the whole thing happens. So there is a node. We have seen a bit of this actually in the earlier thing, but this is a deep dive. This is just for information, a good graphic that you can just learn about it. In that you can understand what's are blocks, how they have synchronized a block. What's a Bitcoin exchange? Bitcoin exchange is a marketplace where people can buy and sell Bitcoins, and they can create using signed transactions. They can have the wallet on the mobile as well, and you can have a solo miner or a mining pool, and you have basic databases on the top, which is basically distributed databases, and you have a payment engine, and you have a node that interacts with the blockchain and then keeps distributing the coins. Basically, you have 6 things. Uses a distributed database. It's in blocks. Anyone can join the network. can do transaction, create add blocks, which is called block miners, and validate any of them. That is node. So if you just see the center part, that's the most important thing. And the software does it for all. So we have seen this hash function in Bitcoin. It's a public Bitcoin address by hashing the public key. It's a transaction digit for use as input for any transaction. So we have seen this. It produces a Merkle root for authenticating whether the transaction is in a block and using hashes all the way up to the tree. And once it is approved, then it adds to the previous block to using the block header, and then it creates nonce and then a block that satisfies difficulty needed in mining. So we have seen this. This is just a capture of how double spending is prevented and how the copy of the public ledger containing an audit trail of all the Bitcoin, so that you can see how much of BTC has been transacted and what is the height, what is the time taken, and what are the transactions, what is the total BTCs in, and how much relay, and what is the size. So this is a blockchain basically. So if you just compare the protocols, Bitcoin is public, it's P2P and business to business, simple program. Every 10 minutes settlement. Ethereum, again P2B, business to business. It has programmable applications, whereas Bitcoin, simple program, one application. And 14-second settlement. And then Ripple, it's a permission bank to bank. Basically, it's a kind of a private blockchain. A simple program, one purpose, and it's almost like a near settlement. Just we need to understand how the protocols compare between these. So let's discuss about what are tokens. A broader use is supported by the digital infrastructure through Bitcoin as represented by a token. So what is token? A token can be defined as a scarce digital asset based on underlying technology inspired by Bitcoin. So broader use is supported by the digital infrastructure introduced through Bitcoin as represented by token. A token can actually similar code databases but use different blockchain databases. So Ethereum was next to Bitcoin, and it is programmable, and tokens can be issued on the top of Ethereum blockchain. What happens is token buyers are using private keys which are similar to API keys but can be transferred to other parties without consent. You can just transfer it. You don't need a consent. So these are programmable keys, and Ethereum was the one which started with tokens can be issued on top of Ethereum blockchain. So very popular thing. I'll tell you about ICO, which is initial coin offerings. So tokens therefore comes with a price and has a value. And tokens are a new model of technology, can be alternative to equity-based finance. Like what we call it as shares or debts or whatever you want, bonds. Here you can call it as a new model. Tokens definitely don't dilute capital. They introduce a huge increase to your buyer base and time to liquidity. Tokens launches differ from equity sales. However, they can be issued as a way to share profits. Tokens can be sold internationally over the internet and are always open for business. What is the other thing? Tokens decentralize the process of funding technology. So tokens have a value. They are model of technology. Tokens do not dilute capital. Token launches different from equity sales. Token can be sold internationally, and tokens decentralize the process of funding technology. So tokens, that means like it enables a free new business model, and it introduces what is called as tech-savvy senior executive. And tokens accommodate immediate custody without an intermediary, and tokens can be extended to hardware as a part of the Internet of Things. So you have software tokens, you have hardware tokens also. And you can have Ethereum token, which can be created on the top of the Ethereum blockchain. So understand token. Tokens introduce rise of what we call tech-savvy senior executives. So nice term. Please remember that. And tokens can be issued on hardware also. These are the 2 points which you have to remember. And this is just a timestamp of how much Bitcoin volumes have done, and somewhere in February, March, April 17. And what's the time closing price? Actually, Bitcoin peaked up to $23,500 last December, that is December 2017. So what are the uses of Bitcoin? It can be used for online purchases. It's a single application, like in programming. It can be used for micropayments. It gives you irreversible transactions. It can do anonymous transactions, can be invested, and you can buy anything on Virgin Galactic or airlines ticket or whatever you call it. So it basically shows that it's applicable anywhere you can use it. So here is the end of the session. Next, we will know more about this new revolutionary digital technology blockchain works and the use cases. Hello, let's start the session with the new revolutionary digital technology blockchain, and then we will know more about it. So we just have to go back. What is blockchain? Blockchain is the new digital disruption on the doorstep. What happens? Blockchain is a distributed ledger technology behind Bitcoin. Just understand it. So it facilitates the movement of assets across the world in seconds with a minimum transaction fee. It has a lot of potential applications for financial asset transaction. Nothing fundamentally different for the users. Guts of the infrastructure will get revamped, and it's like they're expecting like $20 billion reduction in operating costs, especially with use of blockchain. So this is going to existing cumbersome process, but it will be drastically reducing cost of new services. and which earlier used to take days for financial transaction to reach the customers. So it's a disruptive technology. It is going to increase the visibility, massive reduction in costs, and it has potential good applications. So we also have what are called as the coins other than Bitcoin is called altcoin. So there are other alternative coins like Litecoin, Ripple, Peercoin, Next. But the philosophy of cryptocurrency usage is still evolving. Ripple is one. So Ripple is basically built on the decentralized digital currency set by Bitcoin. The function is basically connect payment systems. Basically, it works like for sending bank to receiving bank. So basically, if you understand, it's an open payment network. For example, US bank transmission EU bank, and Ripple chooses the best USD EUR conversion rate. So that's the advantage, and it comes at a very less cost. It also comes with a currency called XRP. So that is Ripple. So it is more complementing than Bitcoin. It can allow seamless transfer of any currency. It is dollar, pound, or whatever you want, or even Bitcoins. And it allows more ways to connect with those using other forms of currency. So if you see how market positioning, 1 to 5 days is the traditional bank. Bitcoin is like up to 45 minutes. Whereas Ripple based, it's like for one conversion from US dollar to euro, it just takes 6 seconds. So see the difference from US bank to EU bank. So trading in Bitcoins, actually Bitcoin has got an ATM, Bitcoin has got online wallets. You can do over-the-counter tradings, you can do mining, you can have crypto exchanges. You can even have Bitcoins for free kind of donation. So you can do anything in Bitcoin, which we call it as a Bitcoin trading. Be it from wallet to ATMs to Bitcoins for free, to over-the-counter trades or to cryptocurrency exchanges, whatever, and including mining. And you have a lot of wallets. You have a software wallet, paper wallet, you have a USB drive wallet, you can have hardware wallets, you can have web wallets, and each one have its own function. You can have a mobile wallet. Basically, there are various ways you can store Bitcoin, but only thing is that hash value or that encryption characters, the 256 SSH characters, that 000 that we saw in the earlier one should not be given to anyone or should not be known to anyone. Otherwise, they will use your coin for their purposes. So Bitcoin mining, it's a decentralized computational process. We understood what is proof of work problem and add a new blockchain and a new block to the blockchain. It costs processing power, hardware, energy, time. So mining is basically creating a new block which earns Bitcoins. So Bitcoin mining resembles the mining of other commodities. Only thing here, it requires exertion and it slowly makes new currency available at a rate that resembles at a rate which commodities are like gold or mined from the ground. So it's as slow as that, and the same function it has, and the same exertion it takes for a new currency to make it available. So it's very costly process. Earlier we used to know 200 bitcoins can be mined in a used home computer, but currently it is not so because so many algorithms are sitting on the mining. So how does it work? Propose a new block, then it will hit the most recent header of the block. There is a nonce that creates, and then there is a hash number, and then if it's a proof of value is done, morning is rewarded is done. Then if yes means you have a target value is achieved, then you solve the proof of work. No means again incrementally keep trying. So you get a mining reward. We did see this Bitcoin transaction processing in a detailed one in the earlier chapter. So what is a major issue? Like lack of regulation is preventing big institutions from entering. No major exchanges in the US, and there is very hard to regulate decentralized, global, flexible, and though it's hard to regulate, but then decentralized, global, flexible, and they are all gaining popularity. Though regulation is not there, but still there are people who are using this. So what is a block? It is a permanently recorded transaction. Blocks organized in a linear sequence over a time on blockchain. Miners constantly process new transaction into new blocks. So what is mining? We have seen mining is a computationally resource intensive process, much like a commodity mining. So it's similar to gold and diamond, but here it is mining computationally using high compute powers. So there are decreasing supply algorithm. That means how currency will be created at what rate. So everybody, since this is an open code, people have started putting high-end qualifying algorithms. That means like to get the algorithm supply, it has created a lot of issues and it is taking more time to mine. And once the blocks are accepted only, they can never be changed or removed. So that is immutability. So once you create a block, they can get at least bitcoins. Currently, it can be identified also. And so blocks and bitcoins are created in a decentralized economy in a P2P network. As you see, this is not a formal economy. It's only survived by users. So it depends on acceptance among the users. There's no central agency movement. So what we call it as a block is a permanently recorded transaction. So just a connotation, banking is essential banking or not. That's how Bill Gates defined. Blockchain is essential, Bitcoin is not. So this is a new way of looking at blockchain now in 2016. So two revolutions at the price of one. No central authority. It's open to all. Any members can transact anonymously. So what we call it as industry level system of records, and it's a resistant digital cash. So it's a two revolution actually happening simultaneously. So just understand this. What are advantages? Accounts are updated, simplified infrastructure, increase visibility and cut costs heavily. So you don't need many people for authenticating and approving transactions. So the whole intermediary layer is out. So accounts are simultaneously updated, increasing speed, and it's easier to resolve disputes. And sometimes we can spot fraud faster. So cryptocurrencies, to summarize, a Bitcoin was the first digital cryptocurrency, and 21 million is what is available. Let's as with real mining, energy must be invested to small complex problems by which you can earn Bitcoins. And the most circulated are Bitcoin, Ethereum, and Litecoin. So with that, we've kind of understood what are the various cryptocurrencies, what is cryptocurrency and everything. And
let's end this chapter here and see you in the next session where we will be going to cover all the popular and most important use cases of blockchain. Let's end this chapter here and see you in the next session where we will be going to cover all the popular and most important use cases of blockchain. Thank you. Welcome to this session. In this session, we'll be going to cover all the popular and most important use cases of blockchain. Let's get started then.
So in this section, let's understand some of the practical use cases of blockchain and some industry use cases including financials. So these are some of the financial industry. It is between retail, banking, investment market, infrastructure, asset management, insurance. This is how my knowledge it's kind of divided. But then there may be some of them more, but then it includes from depository to lending to exchanges to custody to stocks to commodities to wealth management to trust to insurance to everything. So everywhere you will see blockchain getting adopted. So you will see radically changing from, for example, if you just see securities on the left side, right, it is increasing equity, private markets, debts, crowdfunding, derivatives. In the smart contracts, we have seen it is giving for digital rights, escrow accounts. For industries, digital currencies, it's kind of doing microfinance, globe payments, remittances. In terms of record keeping, it is like doing healthcare, title records, ownership, voting, intellectual. So you name it, you have potential application and disruption. So this slide essentially shows that blockchain has got use cases across industries and it can change the future of transactions. Very, very important. So we have seen smart contracts. It's basically a commercial transaction which is legally approved through smart code. Smart assets, basically trade finance, supply chain, workflow, everything. Clearing and settlement, basically the short-term settlement basis. Payment, you have seen like it's going to replace the frameworks like ACH, Swift. You have seen Ripple, which can just do it 6 seconds. And it has digital identity because you can reuse the identity for many services like banks use KYC and anti-money laundering. And IoT also, because now, as I said, what is tokens can be created on hardware as well. So it's going to do mission-to-mission commerce. Financial industries using payments, private equity, bonds, derivatives, trading records, spending records, mortgages, microfinance, all are on blockchain, getting proof of concepts and stack of process, clearing networks, international transfer, auditing, reconciliation, reporting, settlement, everything is on the stack of process. Whatever the process you call it in the financial industry, what are the financial instruments that you have been using, whether it's cross-border, peer-to-peer, corporate, internet banking, everything is kind of getting used in financial industry applications best suited for blockchain. Blockchain for trading and clearing. So you have a smart contract that runs on the chain, for example, both on the chain, off the chain, and you have oracles. And we have discussed this, and they integrate with chain contracts, and then basically network participants can get it on the almost like a real time security contracts. So this is the fintech landscape. Just see the number of companies, blockchain technology growing. So you have some companies which is already there. These are some of it. Started with LHV Bank. Now you have seen Society General, Citi. I actually shown one slide where people have started using all the JP Morgan to Citibank, how they're filing patents. So this again gives a credibility that they're trying to understand the disruption. From UBS to Santander to Society General to Barclays, everybody is trying to research on blockchain. Again, last year close to $2.5 billion have been invested in 2017. This is an old slide, but then people have become more active. Venture capitalists have become more active. They are doing investments on blockchain-based companies or startups. So why that investment interest? Because blockchain has the potential to reduce infrastructure cost. It can save money transfer up to $500 billion. And currently there are so many active fintech areas in New York area itself. And the sector is tripling into $12 billion. So there's a huge scope, little outdated data. But the important thing that we have to essentially identify in this because investment interest has grown in blockchain. and it's kind of quadrupled to or 8 times in last 1 year. So blockchain for banking, this can be replacing letters of credit. It can be a good instrument for corporate debt. You can use it for repurchase agreements, and you can also use supply chain and self-executing B2B contracts. So it can reduce from 4 days to 1 day. It can drive 99% of the cost out into letter of credit. Corporate debt, because you just need a blockchain system so that corporate client can win the highest net discount immediately, just one API. And you can also use it as a smart contract for doing the repurchase agreements. And supply chain can actually reduce the supply chain kind of real time. So blockchain for banking consortia, you have security services, you have capital markets, you have trade finance and card operations. In security services, you have security settlement, post-trade operation and trade repository. In capital markets, you have derivative trading, derivative post-trade trade and syndicated loan. In trade finance, you have cross-border payment or cross-currency payment. And in credit card or anything, it can just do KYC. So each one has a direct share on the blockchain, basically financial services use cases. So be it from security settlement, like where it is a demat form of shared ledgers, where all stakeholders will have a direct access to the asset repository. Similarly, in trade repository, blockchain is a secure record which collects all the financial transactions. Capital markets, you can just do a trading on shares or futures or options using capital markets. Trade finance, you can do a cross-currency payment, and card operation where you can use a single KYC for getting different of all the thing in the credit cards. So where is the potential? You have potential in payments, you have in investment management, you have in market provisioning, you have in deposits and lending. So all the ways you can see the potential. This is as per the Future of Financial Infrastructure World Economic Forum 2017. So just rethinking the banking industry. So how do blockchain offers an opportunity for banks to take huge amounts of cost cut out of their back-end processing infrastructure. So a blockchain startup could be set up and offer for services as quick as possible. So like, with distributed ledger, how do you gain the same trust as you have in hub and spoke system where you have a centralized process through an intermediary? So we have to rethink the whole banking industry. Another thing is why blockchain, when and how. Banks taking this very seriously because they have to rethink their value chain like never before. They have a potential for huge disruption. Blockchain is going to cut out the banks. And they are also high threat because they are giving investment and struggling to understand where to start. These are some of the questions. And blockchain is coming from 2017. It's like they say that real impact from 2020, but Morgan Stanley says that, but Barclays says that it's 10 years away, but we are not sure. Maybe as fast as 1 or 2 years. Next 5 years, where you will see the impact, payments, definitely, digital currencies, we have seen capital markets, digital identity, and others. So these are top 4 most inroads that can make in between 2017 and 2022, as per one of the survey. So you have strategies to leverage, whether it's Goldman Sachs, Visa, Nasdaq, partnerships, how they are using it. So they have gone with Santander, has gone with Ripple, Visa has gone with this chain. In-house development is happening for Nasdaq, IBM, and Citibank. And some of them are going with partnerships, like Barclays with Cephalo, UBS with Clearmatics, and Etherport, Fedor Bank, and all are going in Ripple. So basically, whether you do it investment yourself, like buying a new company on blockchain, or investing in your in-house development or partnership, doesn't matter. There are strategies to invest, and the blockchain is disrupting the whole ecosystem. So how do you do that? First, 3 to 12 months. There are 6 steps or 7 steps. First, develop or publish an internal roadmap. First, understand. If you are in a trade industry, or if you are in trade finance, understand what's a business problem. Then out of that, identify opportunities to strengthen business through proactive innovation. Once you do that, you will do ongoing research to keep what's actually driving blockchain within the sector and ensure that all the staff within the are educated on development threats, opportunities in the business. Then do workshops, develop an innovation program, and start testing the technology to find what kind of solution you can provide or it can provide. So very simple. First, understand the roadmap, identify opportunities, do ongoing research, education to the key staff, and upgrade you to offer sessions and workshops, do innovation program, and finally start testing and see which use case it fits in and how it can provide. This is a recommended strategy. Long term, we can look at replacing the existing bank services with a crypto exchange, or you can give free cross-border remittances. We can also think of trading and capital markets in delays, and we can start making partnerships with other banks to set up a common platform and standard. It's something like Hyperledger. So each bank, some 10 banks to come together and then form their own blockchain. So there are some key technology players. These are some of the names which I have listed. You have CryptoCurve, if I really take your Cradle, Sigtree, Third Key Solutions. You have a lot of them. Hashcurve, Cryptsy. So we have seen this hash functions. It's basically if you give any kind of data, it gets us a SHA 256 function. And if you give a 256-bit hash value, it is like with a numerical hashtag, alphanumeric. So whether you give an image or you give a hashtag file or you give a PDF document, doesn't matter. All of them will get converted to hash value. Understand that this is only one way. You can't do reversing.
So these are some of the use cases. We have seen record keeping, contracts, data, currency settlement, new ecosystems. Everything runs on blockchain. So starting from financial, you have to real estate to logistics to trade and finance, supply chain, internet, value, cross-border payment, escrow, identity management, auditing compliance, digital rights management. Doesn't matter. The whole end-to-end use cases have been defined. So this is one of the KYC AML with blockchain. So you already have a trusted parties. Blockchain, you can just have one place the identification blockchain. They can be used for insurance, bank, funding, anything you want. Just have a KYC document, just upload it, and completely all faster process. Then your subscription becomes easy, whether it is for distributors or whether your currencies asset doesn't matter. So the subscription becomes faster. Just a workflow. How blockchain can actually simplify the process. Settlement also, so you just have fiat currency, you have a bank, it all goes on a one ledger and it goes as a digital shares and you can get a digital currency and get settled in the bank. It's all simplified subscription process. Transaction process, so you have a regulator, you have an investor, you have blockchain which stores all the transaction details and you can also do it auditing and you can simultaneously understand the fund. So there are continued interest that is going on. These are some of the snippets I have again gone through. So this is a transaction process which I just want to go through. There's a step 1 blockchain, then step 2, which kind of transaction happens, then it's stored, then it understands between investor and the transaction, then there is a regulator who controls, and there is a fund that is getting out, and then you can do an auditing. So these are some continued interest, some snippets I've just taken from the internet. Again, there's some ripple happening, so we have received this. It happens through 6 seconds between one sending bank to receiving bank that we have shown that US dollar to euro. So some explorations that's happening in central bank. And again, some US Federal Reserve is paying close attention. So there are business use cases. Some people are providing blockchain as a service. Then we discussed about land registry, protecting personal data. You can have intellectual property. States like Delaware has already started using blockchain. So these are some of the resources which you can actually go through. So as per foreseeing blockchain, Bill Gates says we always overestimate the change that will occur in 2 years and underestimate that will next time. Don't let yourself be lulled in action. So with that, we have seen the entire thing. We started with what is accounts, contracts. We went on to what is distributed ledger technology. We have summarized key facts of blockchain. What are the challenges? We understood cryptocurrencies. And then finally, we have seen some use cases. So we completely complete this module end to end. So that's all. With this session, we'll conclude with this module. Hope you enjoyed the very first module of the blockchain course. See you in the next module, which is all about advanced blockchain concepts like mining, blocks, consensus, distributed databases, Ethereum, smart contracts, and security. Thank you. Hello and welcome to the second module of the captivating course, Blockchain for Finance Professionals. Let's jump to the second module, which is all about advanced blockchain concepts. Roughly, we have almost 8 topics in this module. And in this session, we'll talk about fundamentally what blocks are. So we are starting the module 2, and the module 2 will be called as Blockchain Advanced Concepts. Here we will be understanding a little bit of blocks and how blockchain can enable a bit of technology, and especially in the financial industry, how it can quickly solve a lot of issues that we have seen in the earlier modules. So moving on to the first submodule. So the submodule 1 of module 2 is blocks. Let's understand what's a block. We have seen a bit of this block in the earlier sections. So the first question is how do blockchains work? Because it's a question that we need to answer now and then, because the concept that we need to understand is that how the blockchain is formed and how it enables the various characteristics that it brings in as a technology disruption. So how does it work? Primarily, what is a blockchain? As we have seen, a blockchain is a sequence of hash-chained records. That means, like you have seen, one block getting linked to blocks, and it goes one top of the other and cuts off itself, and it's a kind of records, chain records. So you have n number of records, and in the thing, like you can't change anything in the part. That means, like what we understood is immutable. So what is the proceduring of adding blocks to blockchain? And we have seen an example of Bitcoin, how it gets added to blocks. And we have seen it's characterized by the size of the block and the faster the mining it happens. So it's kind of how it is done. That's the second question we need to ask. So what are the valid conditions for blocks? Are transaction valid? Do we need digital signatures, etc.? Or is it enforced by consensus? That also we understood, right? We need a 51% consensus at least for a Bitcoin kind of a mechanism. And finally, what is a procedure for deciding between alternative candidate blockchains? Like example, which is the right blockchain for the right solution? So we need to understand all these questions. So we'll see some answers in the forthcoming slides. So the first one is, what is building block? Let's understand what is a cryptographic hash functions. We have seen that a cryptographic hash function takes a bit string as an input. Like it can be a file. It doesn't have to be a Word file or it can be any file. It has typically a fixed length output because for any input you will know there's an output, and typically the output size is either 256 or 512 bits, and there is no way we can get collisions. And we have seen this bit in the Bitcoin simple concepts. So it is basically 110, 101, 001 kind of a thing. And most of the people follow the SHA 256, SHA 512, SHA 3256, which is currently very popular. And write payment is one of the cryptographic mechanism or the standard that currently many people are using. So there is a real maximum input length. So input can be anything maximum, but actually it comes as a 256 or a 512 bits. So it's a very important characteristic that is used in blockchain. So let's understand what is a collision. That means like I have two different inputs, X and Y. So that means like hash of X is equal to hash of Y. That's a collision. But for a cryptographic hash function, it is collision resistant. That means it's impossible to find colliding impulse. For example, a black cat crosses the road and a black cat runs across the road. Or if you take a black cat crosses the road and a white cat crosses the road, it's all different. For every input, there is a unique output. That's the beauty of this. There's absolutely no collision. It's completely collision resistant. So why we need to understand collision resistant useful? It's because for every input X is equal to Y such that hash of X is equal to hash of Y. Then we can use for any kind of a message digest. That means like a classic use case is a digital signature where it's unique to somebody and nobody can change without changing hash. That means like there is no collision in that. For electronic signatures or digital signatures, that is a uniqueness. There's a single identity, there's a single person, and there's a hash character of that, and no two people will have same hash. And once I know hash X, we can show hash of X and we can have X star, but it won't have the same hash. So for every input X, there is a unique output Y, and for every input X star, it will be Y star. So that's the beauty of this, and biggest use case is digital signatures. So hash chains is basically, here I'm just trying to give you how the records are linked together. So every hash is linked to the previous record. That is what I'm trying to show you in this slide, nothing more than that. So what's a hash chain? A hash chain is a series of records in which each record contains the hash of the previous record in the chain and hash of all the current records contents. So hash gets converted to previous one, previous to previous, and finally previous. So linking records together, each record contains the hash of the previous record. So that is the most important one. So why do we invest in this? Because we are using a cryptographic hash function like SHA 256. This means two inputs will have the same hash value, and it's a committed n records that is available. And for every n, it will be n-1, n-2, n-3, and so on. So that is very, very important. That's how blockchain uses one of the best technologies to interlink themselves. So how does it help in blockchain? Hash chains have the property that record every record, and it's a commitment to previous record. That means like one string is attached to the earlier record, it keeps attaching. So for an n record, you will have n+1, n+2. You have seen that record, right? It goes into the previous one. So once we accept every record, it shows us as the algorithmic progression like 1, 2, 3, and n-1. So why we need to use this? Because blockchain use hash chains as a component. And hash chains are also useful in other contexts because it's also helping you the arbitration, so that your change history cannot be changed always, it is like intact. That's how the relation between hash chains and blockchains is a very important concept. Because blockchain uses hash chains as a component, it's important for us to understand what is hash chain. Now that comes as a blockchain. So this is an example of a Bitcoin. You have a transaction 1, 12, 13 on the brown side in the diagram, and you have 3 blocks. So each block comes with a commitment to all the previous blocks on the transaction. So for H is a transaction that gets stored as a hash 10, then 10 goes as an input for hash 11, and input of hash 11 goes as an output for hash 12, and so on and so forth. So the essence is that each block in the chain commits to all the previous blocks and transactions. And I will try to explain what is nonce. specifically to Bitcoin in the future slide. So the main core thing we need to understand is the hash of the previous block and each containing sequence of transaction and a nonce. So what is one of the validity conditions? What will the world accept as a next block? As this is decentralized, we don't have any trusted entity to decide what may be added to the blockchain. So we have to decide. The people in the ledger or people in the chain decide. For example, in Bitcoin, signatures are needed from moving one Bitcoin to another. BTC stands for Bitcoin from an account, and you can't leave a negative balance in account. And block must contain proof of work. We have seen what is proof of work and proof of stake. And if there is an additional block and it doesn't qualify the conditions, then it cannot be forming a valid block. So the valid block is actually enforced by consensus. Very, very important. So validity conditions is key because that decides the blockchain progression. What are fork chains? So blockchains are used in distributed systems. So you understand, right? Actually, distributed ledger it started. Blockchains are a kind of distributed systems. So it is possible for different parties in the system to have a disagreement. That's how it is, right? That's why they say, like in Bitcoin, it's like 51% is agreement. So there is no trusted arbitration, right? That's one of the uniqueness. And any blockchain must deal with this. That means there are Alice and Bob. They no longer agree to the same state of the world because they don't agree on history. So here you have to come who is right. There can be several disagreement techniques to resolve disagreements. That's a beauty. Somebody comes with a better challenging algorithm on Bitcoin, he mines faster. So that's how, like from earlier transaction which happened in home computers, now you need high-end speed computers and probably quantum computers in future. So fork chains are basically a part of chains that somebody else is using kind of to make sure that no two algorithms are same and they get an improvement in the blockchain. So what is important is we need to add new blocks to the chain. That is important. And any blockchain has to determine who can add blocks to the chain and how it's done. So two main ideas I will discuss is proof of work and permission blockchain. But I will not be discussing more on proof of storage and other things. But I will be more discussing on proof of work and how permission blockchain happens. So I just want you to do a big computation. Why proof of work is because it limits the rate of new blocks. It makes attempts to add invalid blocks to the chain expensive. That means a clear way to decide between competing chains when there is disagreement. The one with the most work wins. And not all blockchains use proof of work. That's very, very important. So it provides a clear way to decide between competing chains and there is a disagreement and the one with most work wins and not all blockchains use proof of work. It's very important. So building block depends on how you use proof of work mechanism. That means like you need a disagreement algorithms in the blockchain that most of them accept. In case of Bitcoin, it's 51%. So that's kind of proof of work. And here you have a hash-based proof of work because you can find this challenge as 2 power 220. That's a kind of a limit. And you can typically find in such that it is like SHA-256 C/N less than L. That means like you can have a 2 power 36 probability of having a success. And when you succeed, only one takes me to hash to check. That's like Adam Back's hash cache scheme. Understand this? You have 2 power 220 challenges. Out of that, if you use SHA-256, the expected kind of proof of work comes to as 2 power 36, which is like as a probability. And out of this, only one gets agreement, and that comes as a hash value to check for the new block. So you have seen this. You have transaction 11, transaction 12, transaction 13. And we have to choose this value on the yellow table. That's nonce 1, nonce 1, nonce 1. But you have different blocks. And it should be always less than L. So you have 3 blocks in the blockchain. The nonce is the first block to choose to force its hash value, which appears in the second block. But it should be less than L. So hope I'm making sense. The hash value should be always less than the nonce. And it should be concurrent with the second block. So that's how you get the algorithm done using SHA-256 protocols. So mainly what is proof of work? It actually solves some problems. We can resolve disagreements. As a financial consultant, you just need to understand this only one point. Blockchain to a certain extent works on proof of work mechanism. Proof of work here means solving the disagreements by using the best algorithmic method using hash characterizations till that everybody's agreement and the chains should work. And second thing, it actually disqualifies the wrong block and protects it. That means like discourage people trying to add invalid blocks. That's how the entire Bitcoin thing has been designed. So why this agreement? Because I'm having a blockchain as a third party, I can fork the chain and I can put my algorithm into chain. But if I do a wrongdoing of this blockchain, it will create issues. So that's the reason you need to have proof of work. It actually solves many problems, but some of the key problems is agreement, disagreement, and giving proof to that invalid blocks doesn't get added to the blockchain. So I hope I'm making sense here, and Bitcoin has cleared this design in a very decent way. So that's all for this session. I hope you understood the very first session of the second module. In the next session, we will introduce with the blocks in advanced. Thank you. Hello, in this current session, we will know blocks in advanced level. So let's get started. We also need to understand that proof of work resolves some of the problems, but it's little difficult in terms of cryptocurrencies, at least to use Bitcoin as an example. As I said earlier, there were a lot of things that can be solved using personal computer, but now more and more people have been forking Bitcoin algorithms and they have got best algorithms, and that's the reason now it's expensive and it actually needs special mining. So, and second thing is it's actually very slow. The transaction speed has come out very slow. And it's like you need to wait for every 6 blocks, at least an hour, to be sure of a transaction, at least in Bitcoin. So that's one of the reasons why proof of work is kind of getting a bit legacy in blockchain. So that means like to come away or to get away with the block proof of work, that's why we have this permission blockchain, or what we call as private blockchain, where it's an alternative to block proof of work. And the second thing is you have some entrusted entities who can work together to add records to the blockchain. So if you know who are the trustees, for example, you have 5 trustees, and if you have 3 people who are in favor of adding a block, then block is added. That means out of 5, you just need a 3 on 5 signatures. And resolution also is very easy, right? Because you know who are the competing blocks, and you will also know how the votes have been given. So that's the reason permission blockchains are actually gaining importance in the enterprise world. So this is a typical ledger that you have seen, right? It's been existing for so many things. So ledger can be a simple record book, it can be your databases, it can be with records. There are so many ledgers, right? Every market has a ledger. For example, an inventory ledger, a transaction ledger, banking ledger, so on and so forth, right? And every organization will have its own ledger. So you have multiple ledgers, right? What are the disadvantages? Problems, faults, diverging. So every Charlie, Alice, Bob's, everybody has their own ledger, right? And that's the reason there may be a lot of defaults. So that's why you have blockchain, right? This is from Geneva conference. Like it has one ledger, whether we have Franz or Bob or Charlie or Dave or Eve, doesn't matter. It has one trusted common ledger, and it's implemented by a centralized intermediary. That means like the process is decentralized, but it is actually a single point of contact. It's single ledger for all parties, and it doesn't have replication, and it produced collaboratively. And why it is safe? Because it has a cryptographic protection and it has a distribution validation. Who is distributing what. So blockchain provides one virtual ledger. It creates single ledger for all parties. It's replicated and produced collaboratively. It helps in trusted form, and it unifies actually, and it's replicated and collaborated, produced with a good fashion. So for characterization of blockchain, on the right hand corner, I see cryptography. Why cryptography? We have understood hash. We have understood SHA 256. So why cryptography? Because it brings in the integrity of ledger. It shows the authenticity of transaction. It increases the privacy of transaction, and it helps in identity of participants. Second, left hand side, it's a replicated ledger because it's ultimately one ledger. It's immutable. It has multiple storage of records, and it's pass distributed and replicated. So you can't actually tamper the records. Third is consensus. You have a decentralized pool, you have a shared control, and you have a transaction validity which is exactly available. Now let's understand what's the business logic. You have a logic embedded in the ledger. You have execution that comes in the fair transaction way, and you can do anything, any use case, from simple altcoins, your Ethereum, to you can enforce smart contracts, right? So these are the 4 different elements that actually characterizes blockchain. If somebody asks key characteristic, it's cryptography, it's replicated ledger, it comes as a consensus, it comes with a business logic. Let's understand what is meant by state machine. But just this is in a high level that I'm providing here. State machine is basically a transformation that happens for a functionality from a state S to the state S/ to generate a response. This is something like your functional theory, or probably game theory, or probably set theory. It's a combination of this. It's actually done by a Boolean algebra, right? If it's true, it goes as a true. So it comes as a functionality. It transforms from one state to another state, and it comes with a validation condition stating like, it should be validated with a probability of P, and if it is true, it gets validated. So it's a state machine. So why it comes? Because I'm talking of a blockchain state machine. That means like there is only one append only log. Every operation appends a block of a valid transaction to the log. So S to S state will have increased 2 blocks to 3 blocks. That's all. Nothing else. So it's only append only log and keeps adding the blocks. And the second thing is each log content is verifiable from the most recent element. And each log entries is coming from a hash chain. We have seen what is hash chain, right? This is in reference to Geneva Conference 2017. So that means the hash of transaction 1, transaction 2 goes on hash T1, T-1 output to T, the transaction T. So blockchain state machine is like you append the block for a valid transaction from a state S to state S dash and keeps adding the blocks, and it's actually verifiable from the most recent element. So understand this, it's trade transaction S to S slash S star. It appends only the block. It verifies the validated content which is in the log, and it's a part of hash chain. So that's how you have blockchain state machine. So I'm giving an example of Bitcoin state machine. See, these are just for examples, okay? This is just for information, because as a blockchain finance professional, you should understand the technology behind these transactions. So here, Bitcoins are unforgeable bit strings. It's actually mined by the protocol itself. It actually comes with the digital key signatures. That's what you see. That helps in transfer and owning of Bitcoins. And every transfer of a Bitcoin is kind of changing. And one flow from another one, it's actually signed by the current owner. And validation of history of transaction can be easily seen. Because owners are pseudonymous. We don't need to know. And digital signatures, they play a part of the transfer coins, which is a Bitcoin. And you can actually do a validated history of the past transaction. That is very, very important. So let's end this here. Next, we will discuss about the various consensus mechanism of blockchain. Thank you. Hello and welcome to this session. In this session, we will understand how do we mine the blockchain. So let's move on towards the topic. So let's understand a bit of section 2 in consensus. So we have seen state machine. We understood what is a block, how hash characterization helps in a block. Now we will move to bit of second is what is called as consensus. So we have seen this. It comes through what we call it as a Byzantine agreement, which is existing in the war field. That's how you have seen, right? In a permission blockchain, you know the actors. And similarly in the consensus, you have to need a majority of the vote to make sure that you come into the consensus, So there are various forms of consensus. Every blockchain comes with a different consensus. Here I'm showing you what do you mean by distributed consensus, and it comes with an agreement where all honest parties have the same value. And third, you can have validity which for every V will be accepted for every output. And third, it can be terminated. So there is another example called Me94, which is actually a strong consensus. Again, it's a part of the all tolerated consensus mechanism, which I just want to mention it here because it's one of the required. You just have to understand this, or you just have to know this. That's all. So actually there are 3 parts to this. The model is you need to set up a way that you can come to a consensus, and what are the assumptions behind this consensus. So channels is like point to point, right? You can see the red dots on the right hand side. You have 1, 2, 3, 4, 5, 6. It's almost like a matrix where you have a point to point, and it comes with the communications, right? So you have a network protocol communication running between one point to another point, and it's a synchronous communication. As you have seen in network communication, this is what we call it as a mesh network. So it's kind of rushing and it's unbounded, right? Because that's a computational power. So it's unbounded, it goes on a polynomial way. It gets authenticated using cryptography authentication in very highly secure environment. So what is basically a model is you should have a channel, you should have a network communication protocol which is synchronous, and you should have a high-end computational power, which is very, very required. So the best part was it started with Nakamoto consensus, which is used by Bitcoin, and basically you see like a nodes prepared blocks kind of list of transactions, and all valid transactions are stored. And so as I said, it actually solves a lottery race. So you don't know who is a winner and a loser or leader. The winner operation is execution only. The power or the compute power and the algorithmic power actually makes a new Bitcoin generation. But the basic thing is it comes with the consensus, like how fast the consensus can happen between the miners and how long the chain is validated. And sometimes you see longest chain wins. So typically Nakamoto consensus is like a lottery race, but it comes with 2 principles: valid transaction transactions and listing all transactions with valid proof. So that is kind of what is meant by Nakamoto transactions or Nakamoto transaction consensus, which is used in Bitcoin. So this is permissionless, right? We have seen, anyway, I'll come back to permission. So it actually survives censorship and suppression, no central entity. So what consensus, what Nakamoto produced was proof of work. So original intent was one vote per CPU, but that is not happening now. You might have read, maybe as an interest, you can always look at what is hash power, what is Bitcoin mining, though I mentioned few, but it's a growing subject. And they're giving huge incentives to get one Bitcoin mining. And currently, from a machine, single laptop or a single desktop, it is now requiring 1000 megawatts. That's very, very electricity consuming. And stability is also increasing. What do you mean by stability? Is a trade-off between dissemination of a new block. And so, as I said, you can create 6 blocks in an hour. And that means you need to wait. A trade-off is actually between 10 to 20 seconds in a new block. But it actually depends on the mining rate also. And you might not even know that the decisions are final. So decentralized but permissionless. So it is kind of understood in a detailed way, but we need to wait and watch. Decentralized deployment, Bitcoin is one, but there are thousands and thousands of altcoins and blockchain. So Ethereum is the first digital currency with the purpose of smart contract. I did explain in the earlier modules. And now you have this POET consensus with Sawtooth, which is Hyperledger. So basically, what is POET program is basically it comes with a trusted execution environment. It reduces amount of time. It creates an attested proof of elapsed time, and it's like a Bitcoin protocol. So primarily, you need to at least understand 3. Bitcoin, it comes as a proof of work. Ethereum typically runs as a proof of work, but it also creates a digital currency with another digital currency, but it has more of a smart contract execution as a use case. And finally, you have Hyperledger Sawtooth Ledger, which is kind of goes with the POET program. So I'm just going to the consortium consensus, which is Hyperledger. So there are designated set of homogeneous validated nodes. So you see on the right hand side, green color, blue color. Basically, there is agreement which is already defined. And there are quorums, that means it's easy to find out the faulty. So all the transaction goes to the consensus node. So all this all the green. And consensus validate transaction and decides and disseminate results. So you have a lot of transaction, the small one, big one, and it kinds of goes into transaction mechanism and it disseminates. So all the blue ones that you see are the transactions, and once it is approved, you see a tick mark. And once you tick mark, then it's kind of consensus and results are disseminated. That's the important thing. But let's see what is meant by permission. So Hyperledger is a kind of a permission ledger. So what happens is, in this, there is a central entity which controls your group membership. And a group can be decided by inline by protocol itself. And there can be changes in the protocol. And it's open source. That's one thing, because this is one of the understood problem in distributed computing. And many systems also provide a crash-tolerant consensus. And this permission consensus is growing, but the scalability and communication efficiency has to be mapped. Just for information, there are a lot of communications consortiums. So this is one of the permission ones, but primarily it is led by Hyperledger. As I said, some of the under development are Hyperledger. There is other ones like Iroha, Chain, all in existing now. Some of them are coming with use cases. Then you have Honey Badger BFT. That's again not much use cases with that, but you see some other examples like from Lisbon and Johns Hopkins University. So these are some of the consortium consensus under development. So you see it's a kind of a matrix, greater than 20 nodes on the x-axis and greater than 1000 nodes. And you also see a performance. So the main critical issue is the node scalability versus performance in terms of latency. And third thing is transaction speed. So you need to understand 3 things. One is node scalability. Second is transaction speed and latency. And how are the protocol efficiency? Those are the things which is kind of required in a consensus mechanism. So that's it. I hope you have a basic idea on mining. In the next session, we will dive into databases, which is mainly distributed databases. Thank you. Hello and welcome to this session. In this session, we will understand how do we mine the blockchain. So let's move on towards the topic. So we have understood typically what's the important parameters for a proof of work. Let's also understand what are the transaction validity. So please recall the validation that we said, for every operation, that means you have for status for performing an operation O. So when constructing a block, the node actually validates all the contained transactions and it also decides on which to order within the block. Understand this? Constructing a block means all valid transactions. So if the protocol is not actually useful, it actually detects the unuseful block which is not correct, and it actually cannot be attached to the new block. So very, very important is when a new block is propagated, all nodes must validate the block and its transaction. For an example, if you say for a Bitcoin, it has to actually verify all the digital signatures and make sure that there is no double spending. We've seen what is double spending, and it actually shows that the coins are not spent. And it's more complex and costly for Ethereum because it actually runs on the smart contract node. So it's bit of transaction. So validation can be expensive, but you have seen like now a lot of protocols comes in, which is kind of transaction speeds are becoming very, very faster at a fraction of cost. Well, we have seen this, but just only one thing in the slide. You just need to understand the Byzantine consensus. It's basically like every node should verify. There should be an agreement. That means like no two correct nodes should differently. And every termination also should have correct node only. That's the only important thing, and nothing else as a BFT. So let's understand a bit of private validation versus public validation. So far, is everything on blockchain? Where is privacy? So that's why we use cryptography, and it gives you a verifiable transaction. But in Bitcoin, it's actually a digital signature which is kind of private. But in other examples, Zero Cash and Hawk, it actually checks for the valid proof. But if it has to be completely private, it requires some additional consumption which exists between the permission, the blockchain, which is typically of the hyperledger. There is a way that already trusted parties are entrusted, and who are actually participating in the validation. That's kind of a private state. Many things, like you may ask one question. You have seen Bitcoin, you have seen blockchain, you have seen permissionless, private, public. But then where is security? Security and privacy is already existing as a part of blockchain. So there is a transactional privacy because you have cryptographic tools. There is a contractual privacy because it's actually again computation which is with encrypted data. There's an accountability and non-repudiation because your kind of identity is masked. And at the same time, in a private blockchain, who is the identity. It's auditable, it is transparent. That's what we have seen. For any hash character which is as an input, there is an excellent output hash character which is completely different. That means like for any input, there is an output using hash which is completely different from other ones. And all of these need high-end cryptographic protocols. So to a certain extent, it's secure. It also carries some privacy. So that means like we have seen the consensus to a certain extent. We have seen from permission blockchain how it is different from proof of work, what are the critical characteristics that is required, and we have seen like it enables kind of security and privacy. Now let's move on to the section 3, which is called mining, because actually you see mining started with Bitcoin, and people are making money using mining. So what is mining? It's a byproduct of publishing the blockchain. So this is a race. It's a way that Bitcoins are created. Which Bitcoin? New Bitcoins. So as a result, miners get transaction fees plus also they get some rewards. It's a race to find confirming hash every 10 minutes. So you have to have cash, time, and electrical engineering skills. As I said earlier, Bitcoins used to get mined in a laptop or a desktop. Now you see you need 1000 megawatts for mining. It's incredibly competitive. High upfront investments, difficulty, and it requires specialized hardware. Earlier with simple laptop or desktop it used to get mined, but now you see like it's getting mined using chip, which is itself an investment for companies or individuals. So how Bitcoins are recreated? Again, this is just for understanding. Every 10 minutes, miners try to solve a proof of work algorithm. So as I said, it's kind of fork, and every now and then the new fork comes in and the new algorithms comes in. The first one to solve the problem, and if it's a valid transaction, all the transaction is included in the last 10 minutes, and each one approves the transaction, and the first one to solve the problem gets the reward. And understand that there are only 21 million Bitcoins that's available. That's one thing which you need to remember. How Bitcoins are not created because you can't pay to get extra coins. They can only mine. And second thing, there is no central bank. Developers cannot add extra coins, and even miners can't mine extra or faster in response to market forces. This is something beautiful about Bitcoin. That's why you see Bitcoin's utility is growing day by day. So why you are talking of a blockchain? Because as I said, distributed ledger technology was existing, and Bitcoin was the first blockchain protocol to use distributed ledger technology, and blockchain is a byproduct of Bitcoin, and that's the reason they're using block to create a chain, and every 10 minutes on an average, and every block we have seen it attaches to the previous block, and if there is a disagreement in the valid blocks, then the block is disabled, and the more chain it is, the more useful it is, and it can create interesting things. So that's how mining and blockchain are intertwined. So I'm just repeating some of the hardware for mining. You have some CPU, which is the old one. If you have FPGA, ASIC, and GPU. I'll try to show some of the examples. So CPU mining, most easiest commonly available hardware, problem associated node designed for high value of calculation, and very astronomical. Currently, you need a lot of CPU mining machine, but it's astronomical cost. Earlier, in 2009, when it started, you can mine in your home computer. So there are some of the various CPU models, Core i7, these are some of the ones which is getting used. So what is GPU? It's more focuses on mining due to reduced instruction cost. So you have you have this AMD company, right, and NVIDIA. So basically, you have a comparison, and you can choose your GPU. Primarily, this is more used for Bitcoin mining. And you have these models and the hash speed. So the more, Tesla K20 actually comes with 134 power 0.8 M hash per second, and you have something like GTX 590 that I have used. It comes to like 193.1. And AMD I've seen like, up to 2094 transactions. That's like 69990 into 3. That's like M hash speed. This is for information. And FPGA, it's actually field programmable gate array. It comes in a blank state and it can be programmed to the user needs. So you need to understand. Sorry, there's a spelling mistake. E is missing. So it's actually according to the user needs. You have various FPGA. Now currently there is a FPGA demand in the market. And you have a lot of software. I think the best one which I have seen is like Easy Miner, Bit Miner. You have Diablo, you have CG Miner. There are some of the popular names in mining software for Bitcoin. So this is a screenshot from CG Miner. So CG Miner is actually supports Windows, Linux, and Mac, and it's actually AMD. And you have open network and some of the password and things like that I've just given here. And this is ZTX FPGA. This is some of the local that I've downloaded. GUI Miner. This is one of the software that you can use. RFC Pool. This is one of the one where you can join yourself to learn, and you can make some Bitcoin money. So I'm introducing why not join a pool? This because as you see, right, you as an individual you can mine, but you need to have cost that you have to involve. So why not you join a pool? So Bitcoin, there are a lot of pools. Some of them are like Slush Pool, LGS Pool, Gash I.O, and BTC Guild. So you can join a pool, you can put your own algorithms, you can do proof of work, and you can mine a new Bitcoin. In the section 3, we've kind of seen what is mining and what are the equipments and some of the hash rates and some of the selection, and you can even join a pool.
So that's it. I hope you have a basic idea on mining. In the next session, we will dive into databases, which is mainly distributed databases. Thank you.
You need to remember how Bitcoins are not created because you can't pay to get extra coins. They can only mine. And second thing, there is no central bank. Developers cannot add extra coins, and even miners can't mine extra or faster in response to market forces. This is something beautiful about Bitcoin. That's why you see Bitcoin's utility is growing day by day. So why you are talking of a blockchain? Because as I said, distributed ledger technology was existing, and Bitcoin was the first blockchain protocol to use distributed ledger technology, and blockchain is a byproduct of Bitcoin, and that's the reason they are using block to create a chain, and every 10 minutes on an average, and every block we have seen it attaches to the previous block, and if there is a disagreement in the valid blocks, then that block is disabled, and the more chain it is, the more useful it is, and it can create interesting things. So that's how mining and blockchain are intertwined. So I'm just repeating some of the hardware for mining. You have some CPU, which is the old one. If you have FPGA, ASIC, and GPU. I'll try to show some of the examples. So CPU mining, most easiest commonly available hardware, problem associated node designed for high value of calculation, and very astronomical. Currently, you need a lot of CPU mining machine, but it's astronomical cost. Earlier, in 2009, when it started, you can mine in your home computer. So there are some of the various CPU models, Core i7 to these are some of the ones which is getting used. So what is GPU? It's more focuses on mining due to reduced instruction cost. So you have you have this AMD company, right, and NVIDIA. So basically you have a comparison, and you can choose your GPU. Primarily this is more used for Bitcoin mining. And you have these models and the hash speed. So the more Tesla K20 actually comes with 134 power 0.8 M hash per second, and you have something like GTX 590 that I have used. It comes to like 193.1. And AMD I've seen like up to 2094 transactions. That's like 69990 into 3. That's like M hash speed. This is just for information. And FPGA, it's actually field programmable gate array. It comes in a blank state and it can be programmed to the user needs. So you need to understand. Sorry, there's a spelling mistake. E is missing. So it's actually according to the user needs. You have various FPGA. And now currently there is a FPGA demand in the market. And you have lot of software. I think the best one which I have seen is like Easy Miner, Bit Miner. You have Diablo, you have CG Miner. They are some of the popular names in mining software for Bitcoin. So this is a screenshot from CG Miner. So CG Miner is actually supports Windows, Linux and Mac, and it's actually AMD, and you have open network and some of the password and things like that I have just given here. And this is ZTX FPGA. This is some of the local that I have downloaded. GUI Miner, this is one of the software that you can use. RFC Pool, this is one of the one where you can join yourself to learn and you can make some Bitcoin money. So I'm introducing why not join a pool. This because as you see, right, you as an individual you can mine, but you need to have cost that you have to involve. So why not you join a pool? So Bitcoin, there are a lot of pools. Some of them are like Slush Pool, LGS Pool, Gash I.O and BTC Guild. So you can join a pool, you can put your own algorithms, you can do proof of work, and you can mine a new Bitcoin. In the section 3, we've kind of seen what is mining and what are the equipments and some of the hash rates and some of the selection, and you can even join a pool.
So that's it. I hope you have a basic idea on mining. In the next session, we will dive into databases, which is mainly distributed databases. Thank you. Welcome to the session of distributed databases. In this session, we will learn more about what is distributed databases, how it works, etc. So let's start this.
So we are in the module 2 and we are in the section 4, which is like we are going to distributed databases because distributed ledger has some of the distributed databases as a basic concept, because this is also one of the technology that's been used in blockchain. So let's see how it actually helps blockchain. So what is distributed database? There are no data storage. All nodes contain all information and every client has equal rights. That is the most important thing of distributed database. Advantage of decentralized database because you have high security, you have reliability, you have accessibility, you have data transfer rates, and it's scalable. Let's understand some of the characteristics in detail. So first question is security. Well, they do not have centralized storage, and the second thing is actually stored between the nodes of the network. So if something is tampered or added or deleted, it will be reflecting across the network. And if some legal amendments or anything can be done, it will be spread among the other users throughout the network. And data will be coinciding and kind of converted in all nodes. So that means like it is protected from deliberate attacks or even someone trying to tamper the change. Through accidental, it kind of prevents it. So that's what I say. Just say in one sentence, kind of is called it's self-sufficient and self-regulating. I'm not saying that it's highly secure, but I kind of solve some complexity of security issues. So it is also having the reliability and accessibility and data transfer. Let's understand how. Decentralized networks can actually withstand the significant pressures on the network. So actually the requests are distributed between the nodes. So the pressure doesn't fall on one computer. And the capacity of the network is so large that no centralized person can solve. Second thing is DDoS kind of attack, which is popular cyber attack. If the capacity is much larger than that of the network, so it's very difficult. That means that you need to have an expensive attack. And in a centralized model, it's very unique. But here, it's a decentralized. So distributed networks are safe. And third thing is the users are located all over the world. And in decentralized distributed network, you can choose a node and work with all the required information. So it kinds of answers some of the questions. It withstands a significant pressure and it has multiple copies, no centralization. So even somebody needs to attack, you need to build a network which is much larger than this network. And best thing is it's scalable. In a centralized model, you have a client which is connected to the server, but here only one server stores all the data. Whereas here it's like infinite. The situation in distributed servers is like it's finite, and it will be very effective till the time the number of participants. And if there is a load, it cannot exceed. Whereas in decentralized and distributed models, you don't have the problem because the load is shared between several computers. So you understand, right? In centralized model, it's client server and only one server or complementary servers store the data. And so every transaction keeps adding through the main computer. And there are finite resources, it can do the work, but in the distributed, it is like shared and the load is actually helping to solve the problems faster. So how can this decentralized and distributed database be applied? So why it has to be distributed and decentralized? The databases accelerate the communication between different parties in production lane. That means like you have multiple copies and you have transaction split. Let's consider the following example. In the entire life, the car passes many stages from assembly, sale, insurance, and into the utilization. At each step, a lot of documentation and reports are developed. If any clarification required, the request goes to different authorities. It takes a time, location, language, bureaucracy may become serious problems. Whereas this can be solved by decentralized one. So here all the information about each car is stored on the network, and this data cannot be removed or changed without the participant's approval. And you can access the information you need anytime, and smart contracts facilitate the blockchain implementation. So understand this. So blockchain is actually able to scale and solve these problems. So in this section, we have seen a bit of what is distributed databases, and we are trying to understand how it fits in the decentralized distributed ledger or the decentralized ledger. Here comes an end to this session. In the next session, we'll know about Ethereum smart contract, and it will be interesting to know about this. Thank you. Hello, we are in the fifth submodule of Blockchain Advanced, which is called Ethereum smart contract. Let's see a bit of how smart contract can help in the financial organization. So what is a smart contract? I would have explained in the previous slide, it's actually use of software code and a blockchain to execute the legal contracts in a consensus mechanism where conditions are met. So it's simple software code to have legal contracts or any other contract between two parties where they agree to a certain conditions. So let's understand what are the universe of smart contract, where all it is applicable. So it's a legal code, it has group rules, and it can also track the device interactions. So three things: it has a legal code, it is a group rules, and it has a device interactions. And this is how it changes. Basically, you have a group, it forms a legal code, and it gets binded between the code where there are multi-parties in the system. And finally, it is self-executing and it's harder to breach because it's very less ambiguous here. Otherwise, we have to have the regular contracts are good. It's been existing for many years. But when you compare for software code, simple line of code which is self-executable and it's harder to breach, is much easier to control. So basically, this is a kind of a complete contract which happens like it comes with a purpose, a proposition, it goes for the negotiation, then counter proposition, violation. So this is a typical mechanism which happens whether it is terminated, failed, fulfilled, etc., in the contract. So this is again, there is a proposition, then counter proposition, then valuation, then resolution, violation, inactive, active request. It keeps going on. So the first use case is in the e-voting. For example, if there's a listed company, for example, if it's listed in any of the stock exchanges, and all that you can do is just a smart contract that you can send it to the suppose there is need to be a change in the management or the board, and it requires the approval of the general body meeting or the investors. All that you just need to do is a e-voting mechanism through a smart contract where public voting is really not a concern. Then you have stock certificate, it just comes as a smart contract. This is another example. So some of the things I'm just pulling the snippets actually. Smart contracts on Wall Street. So they've already taken care, many of the Wall Street, they're trying excellently, the smart contracts. There's another smart contract called Hedgie. It actually helps commercial traders, over the counter. So there are a lot of commercial trading that happens, right, over the counter. So forwards or, with less counterparty risks. That's important. So Hedgie is just another example where it's between the commercial traders. So this is again one more smart contract where there's a spot price versus, how much he has owning in terms of shares or, any of the thing. So this is again another example of a lighthouse, So basically you have a smart contract where you can even raise money, fundraising, So these are some of the examples. Augur is one of the things where you can actually clearly understand in the early warning system for everything. A clear future, It kinds of platforms, it kinds of gives you better forecasting for any of the features like politics, commerce, technology, entertainment, and more. These are some of the snippets, or some of the use cases that's using smart contracts. So there is an urban art. Here also they are seeing where blockchain-based smart contracts are coming, even for selling art, music. So this is again, where they're trying to use blockchain with kind of using smart contracts, for music. People who can come and put their music, any prototype. Boardroom, it's used for votes. It's contractually secured. This is one example. It comes with the blockchain governance. Very interesting. Boardroom is one of the good blockchain app that you can use for voting democratically. So basically, what you are seeing is this is one of the snippets that I have taken from October 21st, where Nasdaq's Greenfield is talking about blockchain and how it is going to streamline the proxy voting processes. And there's some of the things like, consumables, service marketplace, energy marketplace. So basically, it's like it can be used in any of the places. So as I said, this module, I just covered what is smart contract and some of actual examples of smart contract. So that is very, very important. So that's all for this session. Hope you understood whatever I had discussed. In the next session, we will get an overview about the Ethereum with the topic Introduction to Ethereum. Thank you. Hope you understood whatever I had discussed. In the next session, we will get an overview about the Ethereum with the topic Introduction to Ethereum. Thank you. Hello and welcome to this session. As I have just said, we will discuss about Introduction to Ethereum and get a clear overview of Ethereum in this session. So we will be touching on a bit of Ethereum because smart contracts come from a platform called Ethereum. Let's understand how it is useful in the financial organization. So it is a component of blockchain technology. The Ethereum platform can be used for writing distributed applications. As I said, distributed ledger is the whole universe. Out of that, blockchain as a first use case started from Bitcoin. And the third one, it started creating decentralized applications. The Ethereum is one of the platform apart from Bitcoin which became popular, where you can write your own applications on Ethereum, and you can use cryptocurrency like Bitcoin, and it is useful for web business or society. So what is Ethereum? Ethereum is a decentralized platform that runs smart contracts applications exactly as programmed without any possibility of downtime, censorship, fraud, or third party interference. So understand this. First is a decentralized platform. It runs smart contracts. It also has applications that run exactly as any other web applications without any downtime, censorship, fraud, or third party interference. So how is it different from Bitcoin? It's more general. Bitcoin, it's not just a currency. Here you have a node which has a virtual machine planning. It's like a computer, and the virtual machine runs smart contracts. And the users can actually call functions on the contract, which is called transactions. So this is blockchain 2.0. It started with Bitcoin, but here you can create a node which runs like a virtual machine and it runs smart contracts. And all the transaction happens on the smart contracts. The core idea was simple. The founder says something like this. The core idea was simple. A blockchain with a built-in Turing complete programming language, allowing users to build any kind of applications on top. That is why Vitalik. So basically that is what as per the thing. And there is another counter code from Coinbase, which is one of the exchanges, crypto exchanges. There's nothing that Bitcoin can do with Ethereum cannot do. While Ethereum is less battle tested, it is moving faster, and has better developer leadership and developer mindshare, because this is core towards programming language, right? It can be absorbed easily by any of the developers. So as we see, what are smart contracts? They contracts that lives on Ethereum blockchain, and Ethereum has their own address and balance, and the currency which is used in Ethereum is called Ether. So they can send and receive transactions, and they're activated only when the transaction is happening, and they can be deactivated. The Ethereum virtual machine runs on a complete Turing language. So actually it runs on what is called a Solidity. And they have a fee per CPU step with extra for storage, and they can use the application on their local blockchain. So you need to understand contracts live on the Ethereum blockchain. They can send and receive transactions, and they also have a currency. They also have an address and balance. Then it runs on a CPU per step, and there is extra cost for the storage, and they can run this application on their local blockchain. So this is Ethereum node. You have a virtual machine which has smart contracts, and there's a transaction that hits, and whatever the transaction that hits, it gets updated on the state of the blockchain. As you know, would have seen what is state in blockchain state. It moves from S0 to S1 state or a new state. So similarly, Ethereum node also is available. So this is like a program. Ethereum programming language is there. It's called Solidity. It's like a JavaScript or a Python or a C-like language or a Lisp. So it's a combination of all four. It's a JavaScript with Python, with C and Lisp, and they're actually compiled into bytecode before being deployed into the blockchain. So it's a very useful thing. They're compiled into bytecode before being deployed into blockchain. So Ethereum programming, you need to understand, it's called Solidity. It has Serpent, Solidity, Mutant, and LLL, which is similar to Lisp-like. So this is how a smart contract happens. For example, for a voting, anybody can vote. Transaction passes through a function called vote, and it counts on the blockchain. So let's end this session here. Next, we will learn how blockchain enables security, and we'll get an idea of blockchain security aspects. Thank you. Hello, in this session, let's discuss about the blockchain security aspects. We'll also know how blockchain enabling the security. Let's start then. So let us understand the next section, how blockchain can be enabling security, mainly information security and cyber security. So it's a virtuous cycle. You have security, it includes blockchain. Let's see how it happens. We have already seen, right? Blockchain is interpreted broadly like it's a tamper proof and it follows precision rules, no trusted parties, and it has confidential data only to authorized parties. So these are some of the advantages or the characteristics of blockchain. It is tamper proof, it updates, follow precision rules, it has trusted parties, and it's completely private or confidential. It's basically a new combination. As I said, how did it happen? It's a combination of peer-to-peer networking. We have seen that, communication happens through peer-to-peer. It's a distributed consensus. You don't have a centralized consensus mission. It's a replicated state mission. That means one has to happen from one state to another state happens, and then it gets replicated in the chain. Then it's programmable. You can write programming language. You can use it as a programming language to develop application. It is cryptographic. It has cryptographic hashing for data immutability. Finally, it has digital signatures and signature for authentication. So what is this? It's a combination of all these 6-7 ideas that has come as a blockchain, which is basically the distributed ledger technology, or what we call popularly as distributed DLT. So it's peer-to-peer networking. It contains distributed consensus, replicated state machine. We did understand what is state machine and how it is different from how blockchain state machine happens. It is programmable. It has a specific domain-specific rules. It's like smart contracts as example. It has cryptographic for immutability. It has embedded with digital certificates, and it goes with signatures for authentication. And it comes with privacy and confidentiality, where you have encryption, you have multi-party computation, you don't need any knowledge proofs, and it is homomorphic encryption. So particularly related to privacy itself, you have 4 of them. So that is very, very important. So now what we need is data safety, data confidentiality, data privacy, and it also should be computable fast. So these are some of the things which is information security rules, right? So all of them is kind of covered by blockchain. Security, it is protection of both machines and resources. So it is security of protection of machines and resources, availability and reliability of networks and systems. It gives integrity of data. It has economies, global economy. Everything is protected. It's just not about single mission. You can create one ledger across the globe. So all of them are some of the integrated features that comes with blockchain. Protection of human rights, privacy. Most of them is now looking at privacy, right? We should not have like GDPR, which is introduced by EU this year. It's like basic thing of protection of rights, freedom of expression, system of government, humanity. Overall, it's kind of protection of everything that is helped by blockchain. So can we actually see whether blockchain redefines cybersecurity? Actually, no. Blockchain may not be the solution to every problem, but existing challenges remain, new ones arise. But what we are saying is security is enhanced because you are actually deleting the bad behavior of any participant by giving one single point of trust. You have a consensus, you have a immutability, you have a single ledger, and you're solving your ledger cannot be attacked because you have multiple copies of data in each node. Processing is fast, and so you are redefining, you're actually giving a scalable solution to the cybersecurity, so that the basic cybersecurity issues doesn't exist here using blockchain. It's called programmable trust. So it's like, when I suppose I can specify reset my password and one colleague for one bank. So this is like creating my own rules, my own stronger passwords, and my own crypto keys. That's how we can call it as a programmable trust. So this is one of the new buzzword that's kind of getting using blockchain. It's more secure, more useful. It has higher value assets. It's creating more important use cases, creating higher value assets. It's more important use cases. It has got wider adoption. It is giving economic security because there is accountability, there is transparency and trust that is spread between the economics and communication system. So it is reduced systemic risk and no more of these GFCs. You don't have a single point of trust. So it's kind of giving an economic turnaround with the accountability, transparency, trust, immutability, programmable trust, and it's actually reducing the systemic risk by redefining the whole technology landscape. That is blockchain. It's just not about assets and finance, right? It's kind of creating a identity, authentication, and reputation. So you can actually enhance your identity. So in India, we are seeing the conglomeration of banks. They are trying to create one platform for KYC, know your customer. So it's unique. It's going to have an authentication protocol, and it's also solving the reputation problems. See some of the things which we need to understand. Just not assets and finance. It is kind of giving provenance as well. It is giving informed consent and consent for purpose. So it's like privacy is taken care here, and personal control of personal data, be it for social records, health records, or clinical trial data. It's just not about assets. Blockchain is trying to create a revolution in this entire thing. So Klee blockchain, cryptographic hashing, we have already seen it works with SHA 256. Like one hash, you give a 256 or 512 output. It's one-way function. It's impossible to find the original data. It's collision resistant, and it can't change the input without changing the output. So very, very key. And this is the key blockchain ingredient, cryptographic hashing. Please understand this. And I've given the summary. I've tried to give you the basic concepts, but this is an advanced subject. So its blockchain is tamper resistant. Each block contains a cryptographic hash of the previous block contents. We have seen this. There's an arrow diagram where it always points to the previous. It's changing, any block will be changing to all subsequent hashes. That's very good. That's one of the important things. And it's immutable and tamper proof. Why changing any block? Because as we have seen, any changes, any edits or changes in one block will kind of the whole nodes. It will change the whole block. So it completely changes the genesis. So that's how you see. If you change one previous block, it goes back to the whole thing, and it's immutable. You can't reverse it. It's very, very different, very, very difficult. So that's why we call blockchain as tamper resistance. Every block contains a cryptographic hash of each of the block's contents. Any change in one block will subsequently changes the whole hash, and it's immutable, and it is tamper proof. So blockchain also contains transaction data. It's immutable. Your information, you can't do immutability. Whether it doesn't matter, any kind of data, it's immutable. And so right to be forgotten, blocks also contain transaction data. If something happens to you forgotten, that's okay. It's safe and lying in the blockchain. That's the biggest thing. You have the right to be forgotten as well. So either when you have something like this, you have possible solution is you can encrypt data or store cryptographic data, identifying off-chain data, like only information about you. This is one solution. Like when you have a right to be forgotten, you can actually have encrypt data or store cryptographic data, off-chain data, especially yours. Or it's just know the hash, its name. Other possible solution is there any way that somebody has deleted it? No, because it is like off-chain. It can be safely lying in some place. All that you need is identifying the data. Or somebody has kept it, It can be like, it is there in the previous block and it can be lying somewhere, These are some of the solutions. Solution 2 can be given for specialized authorized parties, But it's like what I'm saying is they have never collision resistance, and different block with the same hash. Hash will be same, but you have a different block because you are having some trusted parties, in this. Or it can be available as a collision resistance with some other authorized parties. These are some of the possible solutions. Absolutely what happens is when you move from one hash to another hash, you can't do the modification to subsequent blocks. So that's how you see in the front, pre-PVR. So basically what you are saying is it's about your data, but it's like something happens, nobody can actually modify the subsequent blocks. So what is actually, basically we are doing a comparison between two solutions, encrypt and chameleon hashes. So here you are seeing an encrypt form where hash is kept about it, and in the second solution we are talking of a chameleon hashes where we are trying to give specialized authorized parties the chance to have the data. So if you do a comparison, chameleon hashes has much better characteristics. Special cryptographic technology, chameleon required. Honest and encrypted data, you don't need a chameleon to do that. And guarantee all deleted information, you cannot guarantee anything. So basically, you're trying to do an encryption hashing technology with off-chain and chameleon hashes. So it's one of the popular solutions that exists in the market. And just giving a crude example of how we can encrypt or use chameleon hashes to answer these 4 or 5 questions. So chameleon comes with the immutability, it comes with a feature, and it's basically what we have to see is whatever hashing doesn't mean, but you have to have immutability, which is having auditability and integrity, and have an effect on subsequent transaction. Very, very important. So we have seen a comparison between encrypt as a solution and chameleon hashes, and how we need to have an immutability as a feature. And it should be limitless, it should not limit. And it also stifles innovation, so probably if you have to have an encrypt or offshore off-chain, it kind of gives some limit solution and stifle, whereas chameleon, it kind of goes on. Remember, it's a one-way function, and if there is a real honest ones will delete information, but actually multiple copies may lie, using cryptography. And no solution can ensure dishonest participants and delete their data ahead. So nobody can guarantee, here. So here in this point, we are saying it's a one-way function. If there is a honest guy who want to delete it, we don't even know. But no solution can actually ensure dishonest participants, and they may have or may not have. So that's all. With this session, we'll end this module. Hope you have enjoyed this module of the blockchain course. See you in the next module, which is all about Bitcoin, the first blockchain, why cryptocurrency is needed, evolution of cryptocurrencies after Bitcoin, the other altcoins, ICOs, etc. Thank you. Hello and welcome to the third module of this course, Blockchain for Finance Professionals. So let's get started with the third module, which will cover everything about cryptocurrencies. In this module, we will get an idea about Bitcoin, the first blockchain, why cryptocurrency is needed, evolution of cryptocurrencies after Bitcoin, the other altcoins, ICOs, etc. So let's start with the first blockchain with Bitcoin, and later we'll discuss the Bitcoin fundamentals. So we have covered almost module 1 and module 2. Module 3 and 4 will be covering more detail on cryptocurrencies and the blockchain frameworks that actually helps in the financial services. We'll be touching on the bit detail how Bitcoin has actually helped in this section. So first blockchain use case, as I said, is Bitcoin, right? So we go on a little bit of what is money. Money is like a physical or electronic tokens of commodities that have the following properties. That means it has a defined value, it has an acceptability, and it is non-perishable, right? So it be dollars, Indian rupee, or any of the tokens or anything that actually where you can exchange. So what is electronic money? Basically is the exchange of tokens of money that gets transacted only electronically. For example, digital gold currency, Facebook gold, and other electronic currencies. So the money from physical to a bit changed to electronic money. And it can include even the authorization of credit cards, value holding tokens, and other examples. And actually, a currency that has value is being widely used. So Bitcoin is a startup currency with a deflationary bootstrapping economy. So that's how Bitcoin started. It's a kind of electronic money. So we can see like how the early money came in, early tokens of exchange, commodities or objects of perceived worth, minted coins, say for example, standardized units of metal, trade bills. Similarly, typically goldsmith, they demand deposits and promissory notes. So these are some of the early money. So modern fiat money, you have World War I and end of gold standard. And basically, gold was pledged as a main fiat currency, and fiat money is like whatever we are using the current. The country, every country has a fiat currency, like India has Indian rupees and US has US dollars. And then it started with decree of government, where it's basically under public uncontrolled, so that its issuers, depending on the issuers, it was basically ability to pay the debts. And then the entire thing changed to electronic money. We have private currency, we had community currency, we had world currency, we had hard currency and soft currency. So just these are some of the legacy stuff on the electronic money. Private currency, basically it is free banking. There is no central reserve bank. Free entry into banking industry. Some of the characteristics are free entry into banking industry. Freedom to issue notes, accept deposits and collect checks for payment. Freedom to borrow money on term deposit, and freedom to lend money and invest assets. So this is one of the private currency. Then we had community currency like Toronto dollar, Ithaca hours and Berkshires. Then we had now we have world currency, basically gold, British pound, US dollar, euro, yen are all global trade references. And we also have a International Monetary Fund, which kind of monitors the funds which is required for the global level. So let's come to Bitcoin. Bitcoin is a simple way of sending and receiving numbers to and from address. So simple, it's, as we understood, it's basically alphanumeric characters. It's based on encryption that goes between a buyer and a seller, or between one individual to other individual, and just having electronic addresses. So it's an open source peer-to-peer network. It uses digital signatures and encryption, and decentralization is the basis for Bitcoin security. So we already touched this. We had this public-private key information also, and we saw how digital certificates are enabling blockchain. It's an open source peer-to-peer network. It uses digital signatures and also encryption. So it started in 1999, and actually in 2009, this is actually found by a mysterious man called Satoshi Nakamoto, but in a document called Peer-to-Peer Electronic System. And in 2009, it started. The first transaction started verifying using blockchain. And even in 2018, it actually reached $20,000 per Bitcoin. I couldn't include in the 20,000. 2017, it reached actually $10K per dollar per Bitcoin, and it actually went, the max it went was like $20,000, 2017. So there's a huge interaction between Bitcoin and cryptography. So Bitcoin is actually a collection of concepts and technologies based on the digital money ecosystem. So what are the characteristics? It's basically a decentralized peer-to-peer network. That means it is enabled by Bitcoin protocol. It's a decentralized because this was the first decentralized ledger technology use case. The second, it's a public transaction ledger. It works on the blockchain. Then it is having a mathematical and currency issuance mechanism. That's what we saw, distributed mining and the proof of work concept. So in early 2009, you can mine a Bitcoin using your laptop or a desktop, but now you need high compute powers, and the algorithms have changed. And there is a decentralized transaction verification system. So it's like you need at least 51% approval for any transaction, and all the invalid blocks gets out of the ledger with proper verification. So why it is important? Because the Bitcoin system is based on the decentralized trust, and it heavily relies on the cryptographic technology. So we did see the way hash functions SHA-256 and RIPE-160. So these are two hash functions that Bitcoin uses, and it's also based on elliptic curve digital signature algorithm. It's a very important algorithm. So if somebody asks what are the cryptographic function, it has SHA-256 and RIPE-160, and it's based on public key cryptography, which is the elliptic curve digital signature algorithm. So you can see this in a Bitcoin on the right hand side. You have a private key. He is sending this money, and it goes through SHA-256 in the flow chart, and it uses RIPE-1, and then the other address receives this money. So in Bitcoin, a transaction is recorded, basically informing the network that there is a transfer from one owner to other owner. How ownership is attained? It is basically ownership of coins through digital keys and Bitcoin addresses and digital signatures. So the entire algorithm is based on elliptic curve digital signature algorithm. So that's what you see as the base 58, the kind of digital signature algorithm that helps. So the private key is initially generated at random and is kept secret all times. It is actually used by current owner to digitally sign a Bitcoin transaction. So when he authorizes the transfer to the new owner, A digital signature confirms ownership and can be used to verify the transaction, whether the transaction is authentic or not. So a very simple two-step process. A private key is generated when who is having a Bitcoin as a owner, and then he digitally signs the Bitcoin transaction as an authorization, and then the digital signature confirms the ownership and see whether the transaction is authentic. Then there is a public key which is generated from the private key, and it is used for a new owner to validate a transaction digital signature. See, one is private key, it gets converted later as a public key to just verify the transaction's digital signature. So when transactions are broadcast over the network, you see like it is using SHA-256 algorithm. So the reason why it is using this algorithm, because it needs to have a data integrity. That is, the data was not corrupted or modified during transmission. So that is very, very important. And if you understand, all Bitcoins are stored in blocks. We did see how in earlier modules, how each block is modified and then edited, added, and gets mapped to the previous block. And the entire sequence is called blockchain. So what is actually a cryptographic hash functions, why it is used? It's basically used to verify block integrity and establish the chronological order of the blockchain. And Bitcoin, that's why uses this cryptographic method, which is advanced, and there are more advanced technologies which is coming in the market now. Essentially, why we need SHA-256 is basically to protect the data integrity and also the block integrity with the chronological sequence of the blockchain. Furthermore, the hash functions used is basically used as a proof of work. That means you have seen, right? Everybody can join a miner club, right? So a prominent algorithm of Bitcoin mining, which is discussed like, a session, which we did touch upon this earlier as a proof of work. That means who produces more and more. You cannot create new Bitcoins. The only thing, Bitcoin can be mined. And in that case also, we need to understand that the mining depends on the compute power and the algorithm that runs into it. So again, I'm just reiterating, in Bitcoin, all transaction information is publicly visible to everyone in the network, and transactions are not encrypted. However, Bitcoin heavily relies on the digital signatures, mainly the public key cryptography to verify transactions. There are two keys, kprove and kpub. The private key, which must always be kept by the secret owner, and kpub, the public key, which is visible by everyone. So you have one that is used for the sending the money and receiving the money by the owner, and the second one which is authenticating the transaction using public keys. So you have two components that's kind of used as a public key cryptography. So that's all about the session. In the next session, we'll know more about Bitcoin and its advanced concepts. Thank you. Welcome to this session, and in this session, we'll deep dive into more on Bitcoin concept in advanced level. How Bitcoin works? We have seen bit, but again we are reiterating. The blockchain is the fundamental data structure of Bitcoin protocol. It's a single data file participant which passes from one person to another. So it allows to understand who owns it. So we have seen blockchain is a protocol which runs for the Bitcoin. It's like a file participant pass from one data to another person, a kind of data structure. You can always see who owns that, and you can always check who is going to change the money or anything else during the transactions. And others can actually verify using mathematically the transaction whether it is valid or not. So essentially, it's like a accounting ledger. So you can see like from one Sally, $15, how Sally to Jimmy, it went up to $2, And you can always check how much money does Sally have in her wallet now. She had 15, then she gave to $10 to Bob, then $4 to Barb, then was given $2 from Jimmy. So as of now, you will see $3 is what Sally has. So very simple example. So all that we deal is kind of dollars here. So it's accounting ledger. So let's understand the anatomy of transaction. Suppose you need to have 50 Bitcoins that you need to send. So first it verifies as the person who can receive the money or not. And then the second is like verifies the person can send the money. Then you can see like, there is a fee that is charged on a transaction. And similarly, you can see the other transaction as 100. And if there is any fraudulent transaction, it comes as a red. You can actually see in the thing. So what are the input that contains is? So input contains is a public key belong to the redeemer of the output transaction. So he is trying to redeem it. Then there is a ACDSA hash over a hash of the transaction. And then output contains like the actual amount being sent to the recipient. And there is any change that is came back to the original sender, the voluntary transaction fee attached to the output. So there's always a transaction fee that happens. And so it's very easy. One input that goes as a public key, and there's a ECDSA hash that runs on the transaction. And you can see whether the other amount being received by the recipient, if there is a change in the sender, and if any fraudulent transaction, you can detect that. And fee is like voluntary. If you want to give as a voluntary, you can attach the fee. So basically what happens is entire transaction is happening on the blockchain ledger. So the blockchain prevents the double spend. That means like it gives the nodes the power to verify that transaction inputs were already spent somewhere else. That means if you take 24, whether it has been already used by one receiver or a sender or a buyer or a seller. So blockchain actually gives you the verification to prevent the double spend, because that nodes in the chain actually has the power to transact mechanisms verification. So mining is actually, we did understand. So basically what happens? Miners collect the transaction on the network into large bundles called blocks. So it's like Alice pays Karim 10 bitcoins and Liam pays Sophia 8.3 bitcoins. So basically these blocks are strung together in a continuous authoritative record called blockchain. So we have seen this one block as a header, norms, and a transaction. So basically why this blocks is continuous. And one more thing, we see the longest block and the faster it is. So basically a blockchain doesn't permit any conflicting transactions and lets you know for sure exactly which transaction counts and which can be trusted. That means like if there is any transaction happening on the same, is this already happened or not, or is it a valid transaction? That means like it shows the proof that double spending is not happening. So Bitcoin and blockchain, Bitcoin makes sure that there is only one blockchain by making blocks really hard to produce. So and miners have to compute a cryptographic hash of the block that meets the certain criteria. So it is difficulty for the criteria for the hash is adjusted based on how frequently blocks are appearing. But important thing is it's carefully validate all the transaction that goes into the block. And you understand that successful miners are always awarded some bitcoins according to a preset schedule. So I have shown you an example in the earlier module where you can see the transaction speed per second on various Bitcoin mining machines. So first two thing learning is it makes sure that there is only one blockchain that is very really hard to produce. And second, it validates all the transaction that goes into the block. You can also see that users can trust the blockchain that was most difficult to produce. And I already told longest chain wins. So if there is a fake chain competing with the real ones, the fraudster has to do as much as work as the rest of the network to make the block as trustworthy, which is very tough. So it is intense work that goes into finding blocks through hash securing, and it is very difficult to produce a fake blockchain, to be very precise. So they are just going again for Bitcoin mining. It collects transactions from the network, it validates them and doesn't allow the conflicting ones. It puts them into large bundles called blocks. It computes cryptographic hashes over and over until it finds a good one to count, and then submits the block to the network, adding to the blockchain and earning a reward in return. So this is the process, and this is how Bitcoin mining is very successful. Bitcoin security, we have seen that Bitcoin is actually used on the Race Integrity Primitive Evaluation Message Digest, or what we call RIPE-MD, of SHA 256 of elliptic curve digital signature public key. So if there is any vulnerabilities in the algorithms, it actually creates a vulnerability in the Bitcoin itself. So any attacker with 50% can do double spend, reverse transactions, or prevent some of the transaction, prevent some of the other generators from. So it is literally difficult, but then you need to have a greater than 50% hash power if there is a real attack, a cybersecurity attack. So Bitcoin concerns wallet vulnerable to theft because it's a public key. Tracing a coin's history is little difficult. Packet sniffing is always there. Sybil attacks, some kind of attacks has already happened. And no authentication for IP transfers, because sometimes we don't even know from where they are accessing the networks. And this attack is downright because if you are using for Tor, and denial of service attack. So DOS is little there, and there is some illegal content which is has shown some extra already in the chain in earlier cases. There's a lot of energy consumption, So these are some of the concerns, but then people have overcome these concerns with the newer blockchains. So you can see some of the example of the transactions done per day. This is available in blockchain.info. So with that, we complete the Bitcoin and how it is the first use case of blockchain and how it can be used for as a sending and receiving money. I hope you got a good overview on Bitcoin after completing the session. Next, we will know more about the evolution of cryptocurrencies. Thank you. Hello, let's start the session with one of the most interesting topic, evolution of cryptocurrencies. So let's jump to the session. So we are in the section where we will be discussing more on the cryptocurrencies, the evolution and how altcoin has started growing. So basically any coin apart from Bitcoin is actually called altcoins. So if you see, there are a lot of blockchain systems. And the other side, there is one way that Bitcoin is only one of the cryptocurrency, and it has a blockchain-based mechanism. There are a lot of new innovations that's happening in cryptocurrency and in blockchain. So you have new blockchain in systems, and we have decentralized apps. So there is a substantial innovation that's happening in the altcoins and the new blockchain systems. So because of the crypto, sorry about this slide actually, there are a lot of sectors where cryptocurrencies are used. There are exchanges that's coming in where you can do purchase, sale, and trading of cryptocurrencies. There is wallets, like it's already there in Bitcoin, but there are many wallets now. There are payments. You can do payments using cryptocurrencies. Then you can do a mining. So basically, it's just not about Bitcoin mining. You have other alt currencies that you can mine as well. So basically, what is a door opener is the cryptocurrency. So basically, it's a revolutionary technology possibilities. You have smart contracts, you have smart properties, you have bonded identity services, you have notary services, whatnot. So these are some of the applications of cryptocurrencies or the blockchain-based cryptocurrencies. So what is cryptocurrency? It is a digital currency that uses cryptology for security. That is cryptocurrency. The important parameters are it is decentralized. It's not issued by any central authority. It is trust-based on peer-to-peer consensus. It is anonymous. It is no more identified to your identity, or transaction not identified to your identity. And what is the first and most popular cryptocurrency? It's Bitcoin. So what is this cryptocurrency? It's a digital currency that uses cryptography for security. So why it is used? It has almost no transaction fees compared to credit cards, and it's built in customer base of customer cryptocurrency enthusiasts. So you can see Shopify, which is one of the largest online platform, is now offering Coinbase, which is a cryptocurrency platform. Then you see Rakuten, which is a retail giant, e-commerce giant from Japan. It started using cryptocurrencies. Why for users? Basically, it's a fun. You can mine using community. You can do trading, and you can probably get rich. And it's but it's not even managed by a central trust. So if you see the largest cryptocurrency, that's still Bitcoin, and the second biggest is Litecoin, but it is easier to mine. These are some of the examples, and there are other altcoins. So you can see some of the altcoins here. This is from one of the altcoin site, just for information. So why you are looking at an alternative currency? Bitcoin is the first application of a technology that paves the way for a opportunity for innovation that didn't appear before, or that was not apparent before. Bitcoin is wholly open source, so it can be tweaked, modified, altered, or tested, just like evolution. Bitcoin's blockchain has almost grown large, almost like 120 GB, and will become larger and larger as more widespread use of it. And then it is argued by power of mining. That's it's now you have to use a lot of energy. And basically, there are some other factors which may get lost for the Bitcoin. So you need more altcoins. So essentially, the chain is growing, so it becomes very difficult for to mine. And there are other use cases of coins, cryptocurrencies. That's the reason you see Bitcoin getting its sheen lost, whereas other altcoins are picking up. So reason is, I'm just trying to define here. Reason is, while some are just identifying to modify the Bitcoin, others are trying to have an innovation. So what is the link? It has more functions like smart contract. For example, Ethereum improve fungibility and privacy characteristics of currency itself. Sorry. So also increasing the or altering the hash mechanisms, and also there are some mechanisms where you can use less energy intensive processes. So that's the reason why people are spanning towards altcoins, and there are some of them are like Ripple and MadeSafe or some of them. So but main reason is these 5-6 reasons. So that's the reason you are seeing alternative currencies. So these are some of the currencies. You have close to 2000 odd currencies as of 2018 closing. And there is like a market cap. This is a little old slide, but the market cap is like very high nowadays. And there are a lot of assets that's been traded also using these exchanges. The next best is Ethereum. That is in the left hand side first one. So you can see this Bitcoin, Ripple, Litecoin, Stellar, Monero, Icon, Nano, Tron, Binance. And these are some of the coins. And you can see like, Ripple, Monero, Ethereum Classic, Litecoin, NEM, Augur. These are some of the indicative coins that's actually happening. And the prices have changed to a drastic level in 2018. So basically not all coins are equal, right? So basically every coin has its utility, and it's not on the same dollar value, and it's not on the same market cap. So it keeps changing, and there are a lot of coins which is favored by the developer community, and there are some coins which are favored by the financial community. So it depends on where the use case is. So but then you have seen proof of work algorithms is kind of developed. I've also mentioned some of the next generation mining equipments like Script, which is used for Litecoin and Dogecoin, and Crypt N is like for X11, X13, which is very popular, and this is kind of used in Darkcoin, Cloakcoin, Bitcoin, etc., etc. So there are a lot of development that has happened in the mining world. So that's one advantage of alt currencies. More development, there are something like proof of stake. It doesn't have to be like just having proof of work. Just holding them is like proof of stake. There's some anonymity increase. Then there are other things like Ethereum basically gives us a framework and programming language even for creating cryptocurrencies. So basically the product development, if you see on the right hand side, is such advanced nowadays. So from a typical mining proof of work algorithms, now we have got other type of developments that's happening in the altcoins.
So let's end this here. After that, we will learn about altcoins and how to mine altcoins. Welcome to this session. As we have discussed before, we will cover altcoins and mining of altcoins in this session.
How to mine coins? You have CPU mining. We have GPU mining. It's very efficient. You have ASIC mining, which is fastest but bit expensive. Then you have entry level ASICs. You can try eBay. There are a lot of equipment that's listed. You can even purchase that, and you can see and maybe you don't become more bankrupt. So these are some of the advantages of using mining. Then there are a lot of cryptocurrency exchanges, be it Bittrex, Binance, and Cryptsy, Minpol, and more. So where you can see price volume order tab, where you can do price like it's like a stock market or a stock exchange. So where you can purchase on 24-hour basis for any of the currencies. So basically, how to use coins? It's like it is fun. You can donate to good causes, and there are new horizons that's coming up. Basically for gaming apps, or there are something like music paid by cryptocurrencies. So you're seeing new frontiers. But what are the common characteristics? They all have common characteristics. First is they rely on cryptographic hash functions and asymmetric cryptography. First. Second, most are designed to gradually introduce new coins into circulation. Third, all have a specific rate of issuance which may be capped. That means like you have a maximum number of coins. For example, in Bitcoin, it was 21 million. Similarly, Ethereum and Litecoin and Ripple all have a pre-programmed supply. And the response to demand and supply is what we need to follow. And there are some key performing indicators that we need to map, keeping in mind when you're assessing cryptocurrencies. The first one, they have a cryptographic hash functions. They're designed to introduce new coins into circulation, and they have a maximum ceiling or capping on the digital currencies. So the core difference between the decentralized digital currencies, proof of work, stake, resources, whether coin can be mineable or non-mineable, and what are the alternative uses of mining energy, and what are the total supply. So you can see these are the broad level categorization how digital currency. First, whether like Bitcoin, it is proof of work. Proof of stake, there are some coins. Whether it is mineable or non-mineable, that's the second characterization. Third is they're using other mining energy issues, and what is the total supply. So first one is the basic element of consensus and incentive method. That means proof of work. But basic element seems to be consensus and the incentive method. So what is proof of work? There are different methods, concepts behind the process through which one can provide the proof that there is a trade-off. That means like you empower the network to ascertain the participants to act rationally and mine new coins. That means like there is a earning or incentive that is given to the miners. So if you see proof of work, you have proof of burn, proof of work, proof of stake, proof of importance, proof of concept, and proof of authority. But what is proof of work? Mining is required to gain coins. So which is usually based on script, hash script. Proof of stake is coins you are earning as a reward. Proof of resources is recognition of contribution to network. Proof of burn means bootstrapping one cryptocurrency for another. So you have proof of work, you have proof of stake, you have proof of resources, and proof of burn. Proof of work means mining. Proof of stake means coins in order as a reward. Proof of resource means recognition of contribution. Proof of burn means it's basically bootstrapping one cryptocurrency after another. So proof of work is actually, it's like a challenge versus solution verification. Here a client requires a challenge. That means like one party present the result of a computation to compute and easy to verify. But whether the performance of the prover or the client needs to be proven using the certain computational work to get the results. So you have kind of challenge response versus solution verification. There are some of the classics of proof of work protocols. There are 7-step process in terms of challenge response, and it's a kind of 4th response in the solution verification. Whatever the proof of work may be. Basically, these are challenges process to give a best solution to make sure that the mining happens with the minimum amount of computation power to generate that new coin. So you have something like very hash algorithm. So SHA 256 for Bitcoin. You have Litecoin, which uses script algorithm. And you have hybrid and CPU algorithms in Primecoin. You have X11 algorithm Dash and Cryptonite basically for Monero. So proof of work system is very important, and you have KECAT, which is the 512.256 from used by Ethereum. So these are some of the hash algorithms we have seen, right? Proof of work is actually determined by the algorithm that used for verification mining. So that's right, and that is secure. So these are the algorithms which kind of different altcoins and Bitcoin uses. So you have SHA 256, name coin, peer coin. We have seen much details in the earlier one. What is SHA 256? So basically, SHA is designed such that for every unique input there is a unique output. Examples of coins using script algorithm. So what is script algorithm? It uses a password-based key derivation function. It generates the demands for the algorithm, and there is a memory-intensive procedure which is parallelized, like using application-specific integrated circuit technology. So it's kind of what is called a script algorithm. So it is a password-based derivation function. Second, it actually gives demand. It's raised by the demands of the algorithm. Then there is a time memory trade-off to see when mining can happen, and it's memory intensive, and basically it happens like a parallel processing with the application specific integrated circuit technology. So examples are Litecoin, Feathercoin, and some stuff like that. So then there is something called X11 algorithm, which is Dash. So again, X11 is a chain hashing algorithm that uses 11 different hashing functions to calculate the block header. So you have seen, right? It's a header nonce transaction. That's how you happens in Bitcoin. Similarly, here a dash algorithm is like, or what you call X11 is, it's like a proof of work algorithm that uses 11 different hashing functions, and this is also intended to be ASIC resistant and to see that CPU and GPU friendly. So this example is dash network for X11. Proof of stake is the second one which we try to learn. Here, instead of performing the task of solving the mathematical difficult problems, the proof of stake means that a owner of coin can earn coins, but proving that she owns certain amount of coins. Very, very simple. So deterministically, proof of stake is just showing that instead of mining of coins, here just show that this is showing that there is a certain amount of coins with the owner. So this is where you see some of the snippets which it started in 2011 instead of proof of work. So proof of stake is actually an algorithm used for verification, and the first 100% POS currency is called NXT coins, and they are charging transaction fees. Just for example, then there are some hybrid algorithms where you have proof of work and proof of stake. Peer coin is just an example. Again, you see there is an innovation that we discussed in the beginning of the altcoins, cryptocurrencies. So basically, there is a shift that's happening from the proof of work that Bitcoin started. Then there are other coins, secure coin, Quark coin. This also use hybrid algorithms. Then proof of resources. Let's understand what is proof of resources. The scheme is based on the notion that end users can earn coins by contributing to the network. That means more resources they use, they can to mine coins for themselves. So these users are called farmers, and they receive the reward for maintaining and supporting the network. Very, very important. So basically, to grow the network, to increase the popularity, to increase the hash rate, to decrease the compute power, and to have faster production of mining and coins, these people are called farmers, and they receive the award for maintaining and supporting the network. So how it happens? Farmer uses constantly measures and verifies resources, and resource provided must exceed usage, and then they take care of the entire network. Then this is another one, proof of resource, where something like safe coin is used. SAFE stands for secure access for everyone. Let's understand what is proof of burn. The idea is that miners should show proof that they have burned some coins. Like initially they would have produced a coin, probably they would have used Ethereum 4 to generate cryptocurrencies, but they've understood that over time there may not be utilization of these cryptocurrencies. So what happens is they will burn all the currencies or the coins because they are not being consumed. So there's a significant discussion on the Bitcoin forum, and to date, like all proof of burn work by burning. So basically, they make sure that it is properly utilized. It should not happen that these coins are lying and then they're actually used for they're not being used. So basically, it shows that the miner should show proof that they burned some coins. Proof of burn is actually important because there's a market cap and they're not using the coins as per the demand. It's better to burn the coins. So counterparty is one coin which is using proof of burn. So, and now let's explore how coins are introduced in the system and how rewards are processed for work. So there is a pre-mined or merged mining. Some currencies are pre-mined, which means that coins are mined from the creator of the cryptocurrency before it's actually released to the public. They can sell them in public. They increase the coins, leading to the cryptocurrency to deflation. So there are pre-mined, like there is like already they have 10 million coins, 20 million coins. They are pre-mined before they release to the public. But what happens is actually once they start supplying and the supply of coins go increasing, then it becomes deflated. So it loses its value unless there is a consumption of this mined coins. So basically, there is a interview in the Guardian which says it's like you might not know the actual required number of coins. So it's like pre-mined is little risky, and it's actually increasing more and more disk space, and it's not necessary. But understand that moreover, the pair of group of currencies that need to be choosing for merged mining or pre-mined to be on the difficulties level. That means like you have to produce hashes that are proper for one network each time and providing with less opportunities for synergies. So the more running more than one client is very course resource consuming, because you need to be understanding that everybody should have an optimum release of coins. So Ripple is a project that ran before Bitcoin, but actually it's a similar like system, but this is called as, basically this is usually used for transferring the, what do you say, foreign exchange currencies, and they were like, there is no mining process, and 100 billion XRP were created and 80 billion were given to Ripple Labs, and so basically they use a, what you say, payment gateway or a transaction gateway for issuing the transaction. So transfer is like very fast, it takes 2 to 5 seconds. But then they have now, XRP is actually used in some of the banks, and these pilot projects are going on. What I call XRP is Ripple. So the third is, can the mining effort be productive for other things as well? Let's understand. So alternate use of mining energy. Mining as a process requires a significant expenditure on significant energy. While there is a use of success of POW, that is proof of work, there's better to have an alternative. So there is now again finding like smart algorithms that is efficiently using energy, and then for example there's a Cunningham chain which is like used by Prime Coin. So this Prime Coin offers academic utility and attention to modern men, that they just go beyond the mining cryptocurrency. So there is energy efficient algorithm that's coming for even using mining equipments. And then the last criteria is like, is there any significance on the total supply and the new coin introduction? Yes, we have seen that it may lead to deflation, but let's understand that. So the total supply of Bitcoins and reason was 21 millions, but this was led to this, I don't know what is the reason, but then basically it is important to have a cap, the rate of issuance until the total supply, whether the issuance is based on what model of consensus, that is hybrid by POS or POW or whatever, whether will it be increasing, whether it will create inflation or trail emission. So basically you need to have a balance of this to see which is what is the total supply of coins that you need to mine. So we have seen alt currencies, and we have understood why it is important and what are the critical characteristics of alt currencies and why supply is important. That's all for this session. Next we will cover about ICOs. Thank you. Welcome to this session. Let's talk about ICOs, or I should say initial coin offerings. So we have seen a bit of what is cryptocurrency, what are alt currencies. Let's discuss on what is called as initial coin offering. This has been on the famous thing in last couple of years, at least in last 15 to 18 months or so. So what is an ICO? Basically it is a way to finance a company or a project via crowd sale of tokens or probably coins. So it's like earlier than even seed stage. I will give you some brief in the next couple of slides. Basically you can have donations as expected, that's one form, or investors receive tokens in proportion to their investment, or tokens again they are used on trading on exchanges and they are used for projects as well. So what is ICO? It's called initial coin offering. Why all the because you have seen at least like 3 billion. It's actually surpassed the venture capital investments in 2017. So there are a lot of entrepreneurs who love ICOs because they have much better value and its terms than traditional venture capital, and it's also a great way to expand your product or user base while raising capital. And some of the times like it has yielded spectacular ICO results in the trading. For example, Ethereum had resulted almost like 1000x times, and at least there is a minimum of 2 to 10 times returns in months. So that's like once it start trading and you have a good use case, there's a good returns as well. So basically what is the mechanics? First you do a marketing website, you create a white paper. It's a strategy paper on technology, how you are positioning your product or a platform, or for what cause it is used. Then you actually generate your own coin, or you make your own coin and basically collect funds through Bitcoin or Ethereum, and you deliver tokens to the investors and trade on exchange. So, and that's how you can create your ICO. So basically, this is a new way of becoming a millionaire, and for your products, So economics have to be very important, and there are a lot of people who have bought BTC, that is Bitcoin and Ethereum, at a low price, and they are now crypto billionaires. So you can see like Bitcoin, which did like equivalent to. There are coins that never did ICO. For example, Bitcoin generated 125 billion, Litecoin is 3 billion, Monero is 1 billion. But the new currencies that's coming in the market is actually creating, basically for generating revenue, producing a product through the crowdfunding. So what is good about ICO? A new form of credit creation. So basically coins or the tokens go to straight to the communities. Then they have the wisdom of crowd. Basically, it's a good indicator for demand. It's actually unregulated for now. A lot of innovation is coming. Government is thinking about this to regularize this, and it's immediate liquidity. Like you buy 25 coins of say a good ICO, and you can exit once listed. It can also be thinly traded. That means like you can always like a stock market where you can trade even one coin or two coins or tokens. Bad is like sometimes too much money is raised because we don't know whether like or right optimum money. There are some unqualified teams, like there is some bogus things happening here. There are some scams because there are stupid projects, but actually coins should not have existed. And sometimes like they are just doing this for immediate liquidity, so that's actually becoming a deflation. So on the contrary, you have some advantages about ICO, but you also have equally number of disadvantages. So Ethereum raised 17.3 for distributing 50 million Ethereum at 0.35. Currently in end of 2018, it's like trading between $150 to $175 per Ethereum. Tezos raised 232 million. These are some of the good examples. So how does it differ from an IPO? An IPO actually involves the issuing of shares or some definable token security as a legislative, as a trust or a company. But equally, ICO involves the raising of capital without giving any equity stakes, but designed to drive interest and usage of the product or service or the project. So the investor subscribes a kind of a cryptographic digital tokens which is operated only in a prescribed blockchain, for example, platform. For example, Stores ICO issued 30 million worth of tokens which is used by store services, but that is being offered by stores. So it's little different from IPO, and this is a new generation IPO, as I can say. So consequently, instead of securities being offered, ICO offers a token which can be later used as a payment for some service or commodity. But the thing is like token can fluctuate in the market but never be used as a service payment. So there is little difference in terms of how ICO offers and how it is differentiated from IPO. So let's see how public blockchain is aiding ICO or initial coin offering. Some of the most successful projects are financed through Ethereum platform, because they are the ones, Ethereum are the ones which created, you can create your own cryptocurrency using Ethereum forking, and it is not very expensive, and it's like open, permissionless, and it has a guarantees a consensus between dependent and independent participants. Third, most of the white papers are just created, or most of the initial coin offerings are basically as an ideation stage, and better to see which are the projects going into the production stage so that it can be useful to see where to invest. So basically they are using most as a utility token. That means like utility to pay electricity bills or mobile bills and things like that. But actually, if you see like a good use case, then ICO is a good way of generating cash for developing the product. And the best way is to see if you have a good implementation project which is almost like in a ready stage, or which is almost in production. So these are most white papers just lack justification of blockchain use. Basically, they just try to attract introducing new blockchain in the papers using white papers, but they don't have a reasonable justification of blockchain use. So the most commonly used phrases you can see, we are creating a community, creating Web 3.0, making the world better using blockchain. These are some of the cliches that they are using, so we have to be very careful in choosing the blockchain ICO that is required and which are the right projects, be it at a mature stage that we can invest and get some good returns. So these are some of the dollar millions that has gone up in the instance ICO, and for what all the reasons. You see some of the places like finance is increasing. It is also used for health, gaming. So there's quite a few ICO projects. Again, you can see infrastructure projects. Finance leads it, at least 22 projects. They've raised about 577. Bit old data, but then yeah, it still exists. And the average investment is like 28 million. And you can see on what are the various use cases of public blockchain, and which is much more useful rather than just utility token. So let's understand what is ICO platform and how it is ruled with the smart contract. So ICO projects either use existing or custom blockchain platform. As I said, they can use Ethereum, Bitcoin, Litecoin, any of these platforms, or they can create a new network and they can attract miners and pay for transaction confirmation. And most projects use, actually Ethereum is the most overloaded as of now. And the thing is, what is smart contract to do here? Basically, the terms and conditions of the token are defined in the smart contracts, and it should be very, very important that you should be able to understand the smart contract, and which should not result in loss for both investors and founders, because if there is a wrong code that is written in the smart contract, that will be very difficult. It will not give a fortune, but it will be making a bankruptcy for both investors as well as founders. So you can see Ethereum is the leading platform for smart contracts. So you will see at least 77% of the projects are on Ethereum. So till November 2017, you can see the transaction that happened on Ethereum, it's completely overloaded. And an average cost you can see is something like 523.3 in December 2017 for deploying a smart contract. So ICO and smart contract. So basically we need to make sure that smart contract can contain hidden terms that are not explicitly disclosed to investors, or it may contain unsafe algorithms basically on a smart contract logic. So basically it is unintentional violation of smart contract logic with functions used and as well as the non-standard functions. So we have to be pretty careful about this whole end game. So let's understand a bit of token valuation. So current token valuation is more like a gold valuation or a fashion item in high season, when a limited supply cannot meet high demand. With balanced demand and supply, the valuation would be determined by the project forecast and token in nature. But in most cases, it's just a hype. So you have to be very careful that the token economics of a token should be categorized for which ICO. So basically you see currently it's a utility token that I've been using it. So in terms of ICO, you should be understanding whether it's a right type of token, or whether it's a security token or an asset token, or it's an utility token. So there is the traditional token valuation as a means of payment is based on parameters that are difficult to determine the development stage. So it is what you call it as PV equal to PQ. That means P is the price, Q is the volume. So but then the token economics varies between each ICOs. It also depends on what is the utility value inversely proportional to the cost. So understand that it's depending on the value of demand and supply, then depending on the type of tokens, whether security or asset or utility, or it's based on the price and volume of the token. Then it's also, you can see there is capped funding and there's uncapped funding. That means you can fix price based on what are the minimum number of million tokens that's supplied, and second, uncapped, basically they will see the demand and then they will create a capping based on the rush. So you need to understand various token valuation methodologies, but it's completely different from the venture capital valuation. So the token valuation is based on fear of missing out. That should be while it should be based on project development and nature of token. So as I said, the most common type of IC is a payment of services, but it's not based on the valuation on the project development. So that has to be the important thing. So we have to be very careful to come out of this fear of missing out. So they fear that they will miss out the chances, so they are looking at transfers of funds from investors at record speeds. So there are a lot of places where you have seen like they are transferring funds at a very fast speed. Even another reason for Ethereum and Bitcoin price to grow is basically based on the ICOs. Like more and more companies use Ethereum and Bitcoin to transfer cryptocurrencies, or in the form of Ethereum and Bitcoin, the price of the Bitcoin and Ethereum also will rise, and that's where you can see the rise of Ethereum up to $500 per ether. And you can see some of the price changes that's happening in this chart, and some of the companies that have generated cash through extreme volatility. So with that, we are completing what is an ICO and what are the reasons why we should invest in ICO. We should not bother about FOMO. Moreover, we should depend on the development of the project. It's better not to invest in a utility token, rather than we can look at asset or a security token. And the token valuation is key. There are a lot of mechanism of token evaluation, but it's better to evaluate a token or a coin depending on the utility, depending on the use case or what is the problem it solves in the globe. So this is the end of the third module. With this session, we'll conclude this module. Hope you have enjoyed module of the blockchain course. Now you will see in the next module, which consists of some blockchain frameworks, mainly Ethereum, Hyperledger and Bitcoin. Thank you. Hello and welcome to the fourth module, blockchain frameworks of this course, Blockchain for Financial Professionals. Let's get started with this module, which will cover everything about blockchain frameworks, Ethereum, Hyperledger and Bitcoin, etc. So let's with the blockchain frameworks. So in this section, we will be understanding the frameworks that helps build the blockchain. We have three frameworks that we'll be looking at: Bitcoin, Ethereum and Hyperledger. We'll be covering the fundamental aspects of these frameworks. So if you want to have a Bitcoin, first make sure that you actually choose your wallet, and you can actually download a software for Bitcoin wallet. So this wallet helps you to hold the private keys in case you have specific Bitcoins, and the software creates public private keys as you need, and it's basically 160-bit hash of the public key, and Bitcoins are sent to these addresses. The wallet also contains software that you can actually receive Bitcoins. The reason why you're doing this is you can register your payments in the blockchain, which is basically a Bitcoin public ledger, which contains all the transactions since the beginning of Bitcoin. So this is how you can get started. So this is how it is. You can download the wallet. You can see after downloading the wallet, you can see like what is available, what is pending, and you can see what is the send receive transactions. So this is where you can see you can enter the address where you can see pay to, and you can also enter what is the reason, and there's a transaction fee that goes through, and it can get synchronized with the network, and you can do a send. So here you can do a send basically using the Bitcoin Core wallet. So how do you spend a Bitcoin? A transaction in the form of send these Bitcoins from address Y to address Z, that we have seen already. And the specific Bitcoins are described as outputs of previous transactions. So you are able to see that in the wallet. You can download and you can see the fields. And then the transaction is signed with the private key of address Y and broadcast with the public key to the payment network. And the transaction might also include transaction fee, which may be there, may not be there, depending on the requirement. So Bitcoin mining, we understood that every 10 minutes Bitcoin mining happens. Mining is the only mechanism for creating new Bitcoins, and the total number of Bitcoins will never exceed 21 million, and rewarded miner will also receive transaction fees in the block. So these are some of the important things. So how do you create a new block? Bitcoin miner creates a block by gathering the set of pending transactions, prioritizing with the transaction fees. He verifies the transaction, and he solves the hashing problem. So we understood proof of work is a basic creation, and how a Bitcoin miner is like, he can gather a set of pending transactions, prioritizing those with transaction fees. He verifies the transaction, solving a hashing problem. In October 2015, average transaction number was 491. Currently, it is 2495, and it's like increasing day on day. So Bitcoin mining is very key, and it happens with when a miner understands the three processes, that is set of pending transactions. He prioritizes the transaction fees, verifies the transaction, and solves the whole hashing problem. So how the transaction is verified? If suppose a person wants to send the Bitcoins from address Y to address Z, the miner first checks the signature using the public key for address Y. Then he computes the hash of public key y, which should be y. Then he checks the signature of transaction using public key for y. Then the miner checks the public ledger to verify that y hasn't already sent this Bitcoin to someone else. So it's a three-step process. First, miner checks the signature of using the public key. Second, he computes the hash of the public key. Then he checks the signature of the transaction. And finally, he checks whether after checking, he verifies whether the Y person hasn't already sent the Bitcoins to anyone else. So the hashing problem is important. We have seen this. To extend the blockchain, this entire process happens on blockchain. A miner creates a new block containing hash of previous block, new transaction to include in the blockchain, and create reward for Bitcoin and nonce. So block is valid only if hash 1 to 4 ends in enough zeros as determined by current difficulty. Miner has to find the right nonce by trial and error. So what does a miner do? To create a new block, he has a hash. He creates a new block with hash of a previous block. He creates new transaction to include in the blockchain. Creation of new reward Bitcoins and nonce. And he has to find the right nonce by trial and error. And difficulty is available based on how the first miner wins in the average 10 minutes. So basically, hashing is a very key mechanism. I have already shown some devices like GPU, CPU kind of devices, ASIC devices, where he does mining based on the hash rate. So you can see like a kind of difficulty, how it is increasing over time. In terms of 2016, you see like, how the estimation time actually has increased over time, it is over years, it's increasing from the earlier days of some few minutes to now blocked in with 10 minutes. So this is how it is 10 minutes. So you also see the rewards that has grown. Earlier you used to get 50 BTC per block, but now currently it's like, over years you can see like, it's come down to 0.78125, So the rewards are also come down drastically. If you have understood right, earlier in 2009, every block you can generate Bitcoin using a laptop or a desktop, but now you need a total network capacity, and we have seen that it is minimum of 1000 megawatts. So if you need an average of 9 to 10 power 18 hashes per block. This is as of October 3, 2015, but now it's consuming more than 1000 megawatts. So imagine the network capacity that's required to just generate one Bitcoin. Massive. So how does transaction? We understood what are the key things that a miner looks for. Then we also understood what is the hash power that is required, and we are now seeing how the transaction has been confirmed by a miner. So a transaction is said to have received K confirmation if it has been published in a block that has been added to the block, and K-1 more blocks has been added. That means if you see like you have a block, you have a header, you have a nonce, you have a transaction, it points to the previous block. So for every K block in the blockchain, there should have been K-1 more block that has been added. So for every for every new block, there should be a -1 block which has been already added. And a transaction is typically considered confirmed once it has 6 confirmations. And for example, newly minted Bitcoins are typically considered once they receive 100 confirmations. So this is important. So the moment they receive 100 confirmations in the ledger, blockchain ledger, the Bitcoins are typically considered confirmed for every newly minted. So for every K, there is a K-1. Typically a transaction is confirmed once they have 6 number. And for Bitcoin, it's actually they have received 100 confirmations. So just understand the numbers. So you can see here a screenshot of the actual transaction. It can be any wallet. So you have seen at 10:27:48, you have 26 confirmations. And in the set, like there are some unconfirmed transaction also. So transaction confirmation happens when there is at least 6 blocks. So a fork can occur when 2 miners publish blocks simultaneously. Such blocks are almost in conflict. So forking is important, right? There are a lot of miners who keep forking the Bitcoin frameworks. So it depends on like who publishes fast. So it can be mostly there are two simultaneous blocks that can come together, but it's almost in conflict, but depends on who does it fast. So give reward to X and give reward to Y and give reward to Z. So if you have rewards to everyone without even mining, the effort spent on a fork that eventually losses is wasted, So that's the reason you should be very careful in giving reward to X, only Y or Z. So how do you choose the branch? As I said, the branch with the highest number of zeros in hash is the best one. So for example, n-1 has 0 into 0, 0, 4, 6, 8, 3, 4, 8, 9. And block n-1, it has another block. So you can give reward to X and give reward to Y and give reward to Z. But understand that more generally, the longest chains wins. So here, the color code of the block, the yellow, blue, which is in the top, are basically the blocks. So here, the color green, which has the longest chain, wins. The other one with the blue and the red will not win because the longest chain doesn't have. Longest chain is, we have already seen, more probably the blockchain, Bitcoin blockchain with the longest chain wins, where length is measured in terms of sum of difficulties of blocks in the chain. It is difficult. So here you have blue and yellow and a green, but then actually the green wins. But red loses here or pink loses here. But assume that the length is measured in terms of sum of difficulties of blocks in the chain. So more generally, the longest chain wins. So in this concept, what we are trying to say is, we have to understand who is forking. When you have two miners, basically make sure that the reward to X or reward to Y will depend on who is doing the less wastage on the forking. And you can give reward to Z in case the block is actually already mined by Y, and then depending on the number of zeros, you can conclude who is the right guy to give reward. But general assumption is that longest chain wins in the blockchain. So why? So hope you understood the earlier ones. So why does Bitcoin have value? Because it is consensus in a state. We have seen that a state is like, in a Bitcoin transaction from state 0 to state 1 or state hash. Typically in a consensus state, you have proof of work. That is in consensus in Bitcoin. You have consensus in payment. Consensus in payment has only when there is a miner who verifies whether the transaction is correct, whether there is no double spending. And third, it's consensus in rules. Basically, there should be a 51% approval in the network. So that's why Bitcoin has value. So with that, we conclude about a bit of Bitcoin details and some of the frameworks and hashing and how miners understand. So let's understand. So in Bitcoin, we have covered how the framework works. How do you download the wallet? How does they receive money? How the transactions are happening? So there are two kinds. Minimum is 6 transactions, and 100 transactions can be a best thing for confirming a new block. We have understood that there is a requirement for a hashing, and finally there are criteria for a miner to understand what are the process involved, and he should be able to give a hash rate of more than 10 power so much and minimum of 1000 megawatts. And finally we have seen that how to recognize the best reward in terms of longest chains, and it has value because it goes through the consensus. So now we are here to understand the Ethereum. Ethereum is the next generation blockchain, and it's the second best blockchain in the market, and it has components of blockchain technology. Basically, Ethereum platform, you can write distributed applications. That means like you can just write any of the web applications over this blockchain. You can also create a cryptocurrency, and it has a lot of applications for the web, business, and society. So what is Ethereum? Ethereum is a decentralized platform that runs smart contracts, application that runs as exactly as programmed without any possibility of downtime, censorship, fraud, or third-party interference. So understand that it's a decentralized platform. It's a distributed ledger technology platform. It runs smart contracts. You can have applications that run as exactly as programmable applications without downtime or any third-party interference. It's on in a blockchain. How is Ethereum different from Bitcoin? Ethereum is more general. It's just not a currency. Here we will see, like we have already seen bit of it. Each node has a virtual machine performing a planetary scale computer. So unlike in Bitcoin where you require the mining machines, here you have a virtual machine, which is more cost effective. And it's like forming like a high performance computing. Then virtual machines can run smart contracts and users can call functions on the contract a transaction. So you can run the virtual machine for any of the contracts and the users can call functions over the for any transactions on the contract. The core idea was simple, basically to run any kind of application. That's what Vitalik, who is the founder of this. There is nothing that Bitcoin can do without by which Ethereum can't. But yeah, currently this is being more tested and developed as a developer mindshare. That's as per the Fred Estrom, Coinbase co-founder. The smart contracts, basically contract lives on the Ethereum blockchain. They have their own Ethereum address and balance. So they can send and receive transactions. They are activated only when they receive a transaction and they can be always deactivated. And understand that their Ethereum virtual machine runs on a Turing complete language. And they have a fee per CPU setup with no extra storage space, with extra for storage. So the users can run the application on their local blockchain. So first, the base is Ethereum blockchain. They can have their own address, like what you had a Bitcoin address. Similarly, you have an Ethereum address. Basically, based to do that, you can send and receive transactions. And the transaction can be activated and deactivated anytime. And this Ethereum virtual machine runs on a Turing language. Basically, it's like a programmable language. And there is an infrastructure where you can pay a fee for this CPU. And if you require more, you can pay for storage. And the users can run their application. It can be any application on their local blockchain. So the entire thing runs on the smart contracts using Ethereum JVM machines. So this is how it is. You have an Ethereum node. It's in the top. So Ethereum node contains a virtual machine, and each virtual machine has a lot of smart contracts. And you can do the transaction. The user can do transaction, and it hits a smart contract. And once that is done, it updates the state of the blockchain. So very simple mechanism. Ethereum node contains virtual machines, and virtual machines has a lot of smart contracts. So smart contracts can be for any use cases, and it can be done for any transactions. And so once that transaction happens, you can update the state of the blockchain. So smart contracts can be written in Solidity, Serpent, Muton, and LLL. So they are compiled as a bytecode before being deployed in the blockchain. So their Ethereum programming languages, you have Solidity, you have a Serpent. It's like a Serpent, like a Python-like language, Muton, and it's like a C-like, and LLL, which is like Lisp-like. So you can use, mostly Solidity is the one which is kind of used here in Ethereum. So for example, of smart contract application, voting application. The smart contract contains in the virtual machines, and you do transactions, and the voting as a function gets counted in the blockchain, which is on the bottom. So Ethereum uses gas. You need to pay gas to fuel the EVM. So gas is like a incentive in Bitcoin, or a reward like in Bitcoin. And every code instruction is executed by the EVM that uses up gas. So with that, we kind of understand some bit fundamentals of Ethereum. Summary is there is an Ethereum node, there is a virtual machine on the Ethereum. Every virtual machine has a lot of smart contracts, and there is a transaction that happens on the smart contracts. Actually, it gets into the bytecode and then stores in the blockchain. So the third one is Hyperledger. This is both Bitcoin and Ethereum are permissionless. That means they are public blockchains. Whereas Hyperledger is a permission blockchain. That means it is a private blockchain, kind of a private blockchain. So what is Hyperledger? The Hyperledger is a collaborative effort created to advance blockchain by identifying and addressing important features of a cross-industry open standard for distributed ledgers that can actually transform the way business transactions are conducted globally. So it's a conglomeration of somewhere around 40-50 companies coming to take the distributed ledger technology to the next level.
by addressing cross industry, and it's an open standard, be it retail, be it healthcare. This open standard will help, and they can do the business transactions very easily. So this is one quote given by Jim Zemlin. And these are the companies, you have from JP Morgan to Intel to Hitachi to DTCC, NT Data, Red Hat, Blockchain, ANZ. So you see all of these companies now. Most of the innovative companies are there. It's a global collaboration of banking, finance, Internet of Things, supply chain, manufacturing, and technology. That's how this entire this chain is coming, Hyperledger. So basically, it's Apache license 2.0. It's an increasing demand. Why it has been there for? Because there is an increasing demand for permission blockchain. Some use cases require validation to be controlled, just not by whitelisting organizations. Basically, you require some validations on some use cases where you have some certain number of people. So very network operators want transactors on network to obtain identity. Earlier it can be anonymous in Bitcoin, but here you need an identity, show that there is an authority service on the network. And there is a need for private networks as well as public networks. As everything, you also need a private network. And there is other thing is you need performance and scalability. So it's a kind of a world of many networks for performance and scalability. So this is again a kind of open source Apache license 2.0, and it's a permission blockchain. There is an identity recognition before issuing an authority on network. It's a kind of a private network. It is performance oriented and it's scalable. All these are characteristics of Hyperledger. So you have Hyperledger as 4 modules. You have an application layer. That means that's a top where you can build custom applications. Then you have value-added systems. Basically, you have API libraries, GUIs for any kind of policies, gateways, and operation. Then you have core APIs and SDKs. And then finally, it's in the blockchain, which is basically the shared ledger. And it's kind of code execution environment, ledger data, modular storage, and network pairs. So basically, understand that shared ledger, that is in scope. The top part, you can understand app layer where you can develop your own applications. Value-added systems and core APIs basically depends on what kind of business case you bring in, which is basically more technology-oriented, but you just understand the in-scope and the app layer. So if someone asks what is Hyperledger, it is basically a 4-layer mechanism. It's a shared ledger at the bottom, and the top layer is the app layer, and in between layer is the libraries and SDKs. So you can see here, you have a services layer, you have a APIs layer, you have a blockchain transaction layer, and the entire thing comes with the consensus manager. It has distributed ledger, it has storage, it has P2P protocol. The whole thing is called as chain code on the right side. Basically, they are the one which contains the services, and it's mentioned in the secure container. Container is a form of a cloud where you can store, and on this left hand side, you also know what are the memberships. You can register, you can do an identity management, and you do an audibility. So basically, this is the whole matrix of the Hyperledger. So what are the 4 things that Hyperledger provides? One is the membership. Second is the blockchain and transaction. Then there is a chain code, and it's all linked with APIs, SDKs, and CLIs. So if you go down to membership, you have registration, you have identity management, and audibility. If you look at blockchain services or transaction, you have a consensus, you have a distributed ledger, you have a peer-to-peer protocol, and a ledger storage. And there's a chain code, basically where the implementation happens. It's a secure container. It contains registry, and the whole thing is event streamed, and it's supported by APIs, software development kits, and CLIs. So this is a kind of a matrix, or this is a framework of Hyperledger. But you have to understand 4 things. It has membership, it has blockchains and transactions, it has chain code, and it comes with APIs, SDKs, and CLIs. Hope it is clear. So here we have seen 4 different layers of blockchain from Hyperledger. Let's understand what is chain code. Chain code is a piece of code that lets you to interact with the network shared ledger. So you have seen, there is a shared ledger in the blockchain services. So basically, chain code is a piece of code that lets you interact with the network shared ledger. Whenever you invoke a transaction on the network, you are effectively calling a function into a piece of chain code that reads and writes values to the ledger. As you've seen in Ethereum, a virtual machine has smart contracts. Once the transaction hits the smart contracts, the transaction is processed, and then it goes as such bytecode in the blockchain of Ethereum. Similarly, chain code is a process where once it invokes a transaction on the network,
By using a function, a chain code effectively reads that and actually writes values to the ledger. It's a simple one. Understand that it's a piece of code. Once a transaction hits the network and once you call a function, chain code that reads and writes values to the ledger is called chain code. So here it is. Your client login and transact. There's an application. It authenticates client. It maps clients to secure contacts, and it calls REST APIs, and it understands whether it's a validating or non-validating peer, and it handles the API request. And if it's a validating peer, it does consensus, run transactions, maintain ledgers, and emit events. Also, it understands using the member services, which it does. So once it, how does it happen? The application is used after logging in and transaction. It checks whether it's a non-validating peer, and if it's a validating peer or non-validating. Non-validating, it has a member services that gets combined, and it does consensus, transactions, maintain ledger, and emit events. So in the non-validating peer, it basically makes sure that there is security among peers. It requests services from the member services on behalf of client. It delivers events to application and handle API requests. Basically, it first non-validates and then increases the validation using member services and validating peer. Okay, so these are some of the references we have given and for self-reading. So that ends the the blockchain framework. We have covered Bitcoin, Ethereum, and Hyperledger to a fundamental level for us to understand how it is used for various application development and as a framework for using blockchain. So this is all about this module. We will conclude this module here. Hope you have understanding about the blockchain frameworks. See you in the next module where we will cover blockchain financial system, blockchain for supply chain provenance, asset keeping in blockchain, blockchain for multi-party systems, etc. Thank you. Hello and welcome to the fifth module, which is blockchain implementation of this course, blockchain for finance professionals. In this module, which will understand about blockchain financial system, blockchain for supply chain provenance, asset keep in blockchain, blockchain for multi-party systems. And in this session, we'll discuss about blockchain as a financial system. So this is in module 5. We are going to understand blockchain implementation. Let us go in deep dive to see some of the use cases, how blockchain is important in the financial world. We'll be covering a couple of the top use cases that's used in the financial world. So let's understand in this section as blockchain as a financial system, because this is going to rampantly change the way the business is going to get done in the future. So it is important to understand how blockchain can act as a financial system. So it started like 1994. It was a bad year for banking because kind of internet era came in, and then fintech was not that responsive in those years. But then times have changed now. In mid 2000s, fintech attacked the banks. They came out with every small thing in head on, be it small things in terms of how do you buy, to lend, to anything and everything. So you can see the aura of entire fintech companies that came in early 2000s. And actually in 2014 there was not much plan about blockchain, but then you can see other things. But focus in 2015 has been completely changed. Actually they had planned to do other priorities, including cybersecurity, balance sheet efficiency, payments transformation, compliance, data management, and all. But then suddenly it's now blockchain. That's the new internet, and it's becoming the whole end-to-end in financial world. So basically, but the outcomes are good for banks, right? Blockchain is helpful. It is like early stage banks, because you heard IT has given some savings when technology started going. Similarly, blockchain will bring in cost savings. You have seen already some of the numbers when you migrate to a blockchain. It almost cuts the intermediaries. So basically, what is the deep dive in the explaining blockchain is basically decentralization, disintermediation, and distributed ledgers, and it's programmable assets, right? So it's assets, trust, ownership, money, identity, and contract. So it's basically atomic DD dive. So it's programmable. Second, it's based on decentralization, and third, it's kind of affecting governance value creation. So basically, in a single statement, what we can say is exchanging assets without any central intermediaries. And it touches the core of banking, right? And it's a challenge. So just want to explain that it's atomic DD dive.
deep dive, in explaining the blockchain. So consumers ask why, because there are a lot of dependencies, right? When it comes to settlements or authorizations, depositing a check, we typically have to wait for long days before confirming confirmations, right? So this is what it will happen with blockchain. So you typically cut down the entire, this is almost like real time. On the left extreme side, you have the basically importer who wants to send goods to the exporter, and you can see that the importer has initiated the transfer between exporter to importer, and you can see the goods delivery, how it happens and how the smart term settlement happens on the right hand side. So it's very easy. The exporter initiates the shipment, verified goods, product shipped, received goods, goes through a smart contract, shipment received, and export bank, and payment complete with import bank. So there's a financial agreement, very simple, importer exporter. There is a smart contract. It's kind of a financial agreement, and the export import bank agrees to certain payments, and then it's almost like real time. So this is how fast it is. Earlier, current system is like, you have intermediaries, you have all, some of them are physical documents, so you need to verify. But here it is just simple, all smart contracts. Whether you exporter to customs to fight, or another importer customs, whatever it is, it's all like all shipments, it's all letter of credit, everything is like smart contract. So it's a simple line of code. So it's like financial services workflow, like, it's a very important thing, and it's almost like real time. In trade finance, it's important because why you need to set up chain in the trade finance, because it gives you real time review and approval. It is transparent factoring, right? Because you have invoices accessed on DLT enabled, transparent and real time. Ownership proof. Who's the ownership and where is the location of goods. It gives you transparency and reduces counterparty risk, because bill of landing is the most crucial one, and this eliminates the chance of double spending. Somebody has paid way, so corruption comes down here. Disintermediation, because there is no need of intermediary. This, like, you can just have an importer bank to an exporter bank, and you can just transfer the cash. And it's decentralized contract negotiation, because what happens is, as soon as the contract terms are met, then distributor ledger in real time, this efficiently monitors the goods delivery and reduces transaction fee. Like as I said, contract terms are very simple and executed through smart contracts, so it eliminates the need for additional transaction fee for verifying and all those things. So essentially, there are 7 to 8 benefits, and this is one of the biggest use cases in trade finance. And if you see the relationship, right, banks and fintech has been always going on hand to hand together. Like banks like Citibank, JP Morgan, all of them have actually funded startups to create products, and then they're being close to them, and it's like a symbiotic relationship. And they invest in ecosystems accelerators so that they can just absorb the company, and then they can use it internally, and then probably use it for their customers as well. So it's a symbiotic relationship. Basically, there is a common dilemma, but then the reality is that they seem to be survived. So there is an asset movement. If you see on the left hand side, bank A, bank B, bank C, bank D, and bank E, there are so many. It's like a circulatory world. It keeps going from bank A to bank B. There are so many permutation and combination. Whereas if you just see on the right hand side in the distributed ledger, it is like straight arrows. There is not much crisscrossing, because all belong to the same ledger, same blockchain. It's easy. So, but they feel that perceived techs are real, but actually no. Tech companies, global banks perceive threat for industry disruption, because tech companies have to. The first use case comes from fintech, so there's a lot of investment that goes, but then this is just statistics. So how does blockchain and established methods, how does it like retrofit, or how does it going to replace or anything? Blockchain such as clearing houses and private exchange networks like Swift are like oil and water. They will not mix well, because one is centralized intermediary, other one is no intermediary, peer-to-peer trust. So basically it will be like how the banks will retrofit the blockchain will be challenging, but then let's wait and watch how the entire thing is changing, because Swift you have to pay a huge commission. Whereas in blockchain, like, if you have to use Ripple, it's just 0.001 transaction percent of the transaction fee. Yeah, we can have that. Having the blockchain without Bitcoin, it's like a knee-jerk reaction. But then that is the first use case of blockchain. So without Bitcoin is a valid construct, but then actually if Bitcoin is becoming more and more acceptable. So, and I think it is a backbone for blockchain. So let's understand what are the blockchain capabilities of financial services. The key attributes is it contains a secure electronic timestamp transaction ledger database. that is shared by all parties in a distributed network. First, understand that. That means it is secure electronic timestamp. Second, it has a massive ledger of transaction verified by a global network of computers. And it is identical copies of the ledger are maintained in multiple systems controlled by different entities. Very important. Then it's based on the cryptographic peer-to-peer network. So these are some of the challenges, right, for blockchain, for financial services. So cryptography, security. So blockchain brings that. It assures immutability and irreversibility. So someone can tell about what is immutability. Basically, you cannot reverse a record. That's the biggest advantage of blockchain. And once entered, it cannot be erased, and it has multiple copies. And the third thing is like it can be public, private, or permissioned or unpermissioned. We have seen public blockchain example is Bitcoin or Ethereum. Permission means like Hyperledger, and it comprises of any transaction which is verified, and any malfunction record will be thrown out of the blockchain. So you have seen that also using the hash functions. So it also allows participants to review the blockchain entry. So anyone can look at it. If it's a private blockchain, you know who are the actors. It's basically, it works on the virtual currency securities and all. So you can also understand the record transaction without exactly exposing the details. Yeah, this might be required for something like anonymity, but then it might be one of the use case. It actually enables real-time settlement. That's the fastest thing. You can actually, last thing is you can actually set business rules. You can enable smart contracts, and in the computer language that can be automatically executed. So you don't need a human interface at all. So you have a lot of advantages, and each one of the advantages is actually a challenge for financial companies or banks. So if you see potential uses in financial systems, commercial banking, you have cryptocurrency denominated products, and you have asset and real-time real estate tracking. You have a physical banking marketplace, syndicate lending. You have real-time loan funding. You have use case of personal financial management. You have liquidity management, cash reserve management, and interbank settlements. And you have even customer acquisition and loyalty management. So you have so much of potential users in the financial service domain. And if you take the trade and real supply chain, it includes debt servicing, insurance, factoring. That's very important in terms of LOCs, that is line of credit, letter of credit. And receivables financing is very important. If it's real time, you can cut down on the lot of inventory based financing, decentralized contracts, document preparation, and it also increases the interaction between export and import banks, eliminating the role of corresponding bank. You can actually directly correlate, So you have so much of use cases coming in financial systems. Then in terms of payments, you have micro payments, retail payments, wholesale payments, P2P payments processing, exchange services, offerings, currency exchange, cross-border remittance, and so on and so forth. So you have a whole lot of things in payments. Then in terms of capital markets, you have clearing and settlement, Hyperledger. Usually it's the biggest use case. Post-trade reconciliation, derivatives transaction, asset documentation, name it, right? It's all happening in payments, capital markets, commercial banking, trade and financial supply chain. And risk management, you can do a lot of counterparty risk, fraud risk management can be reduced, liquidity risk management, operational risk improvement. So there's so many things happening in the risk management area, and also in regulatory compliance, right? It actually automates the whole compliance. It also increases, like you have seen that AML KYC, like anti-money laundering KYC. So in India, there is a conglomeration of at least like 35-40 banks who are coming out with the common KYC. It's a tool for regulators, and it's also a regulatory reporting automation. So you can understand, right? So many use cases in financial systems. So these are some of the organizations that is embracing blockchain. R3CO, which is used by Credit Suisse, Royal Bank of Scotland, Bank of America, then DTCC, which is one of the biggest clearing corporations. They have been in partnership with IBM, then UBS. They have got Innovation Lab, Barclays. They are trying to work with a Israeli startup. So these are a bit old, but then Nasdaq has started with open asset protocols for the private platform. So you're seeing like who's of financial organizations starting embracing blockchain. So they're just not, they're doing proof of concept. Some of them are live also, but actually you will see the potential benefits, but at least you can see POCs to understand what are the, narrow down the committed projects, once you get the POC, then at least it goes up to scale up concept. So again, we have seen this already. And then not only this, right, you have regulators working on the regulators and policymakers, right? You have European Commission, you have International Monetary Fund, you have BankFin, Sweden's central bank, New York Financial Services Department, Swedish Authority, US Federal Reserve. They are working with IBM to form a new digital system. IMF is actually working on a huge regulatory framework, which actually gives you in the international monetary, European Commission, they are working on anti-money laundering directive. Sweden Central Bank, they introduced digital currency to support the country's cash. New York, they have bit license regulation. So if you see, government financial agencies are also working on the policy making and, on the elaboration that on each and every use case and business cases. And it's also easy, right? You can actually see implementation of blockchains in new segments without internal integration. Insight, you don't have to start it as a baggage, but then you can actually currently transform the whole system that you're looking to 18 to 24 months for full implementation. So without even disturbing the existing methods, you can just easily transform with the caveat, in terms of training and, proper cycle. Without containing this as a baggage, you can actually integrate into the existing systems. There are lot of consultancies that's available. They help you re-engineer, change, and implement large projects. Like I am an external consultant, so I help some of the financial organizations earlier. I have been helping. I'll be continuing to help. And basically, you need to, if you are an external or if you're an enterprise, you just have to understand the blockchain capabilities. And the other external consultants can take care of entire, running your experiments rather than you can just concentrate on your business. Everything else can be done through external consultancies. So blockchain also is like running to capital markets. You have major consortia, R3Serve and Linux Foundation. So we have seen it has started making a dent in capital markets, but this kind of accepted, rejected, we'll have to wait and watch. And there are many pivots, IT-bit, trade blockchain pivots and so on and so forth. It's all in the proof of concept, or some of them have already gone live. So there are high venture capital valuations. These are large bets. The capital markets is one of the most large valuations, and every early stage startups are getting funding, and basically VCs and private equity investors are going so that they don't miss out the huge venture capital investment for right startup. So we understood high level on how blockchain happens in a financial world and how it has been taken care by governmental agencies, banks, implementation, and what some of the use cases on deep dive of it in this entire. I hope you get a good overview on blockchain financial system after completing this session. Next, we will know more about blockchain for provenance tracking. Thank you. Welcome to this session. Here we will discuss about the provenance tracking in blockchain. Let's start then. So in this section, blockchain, let's understand how it is helping provenance tracking, right? Because it's one of the most important thing in trade finance. The current situation is you have huge complexity, right? Errors in manual work, high transaction costs, and also theft. Other things like, unsafe working condition, illegal extraction. And so the current situation is in terms of provenance, right? Moving goods from one place to another and tracking it is costly and unreliable. Not that it's a foolproof. It's one of the time tested methodology, but then you can actually correct it with a lot of situation transformation, using digital. So you need a supply chain solution, including finance, that can actually be trustworthy, transparent, and it can help supply chain goods and services on a real-time tracking, right? So let's understand how it is. The main question is, can blockchain technology actually improve today's supply chain and logistics? To operational improve efficiencies, fraud, or sometimes grand challenges such as unethical labor practices and environmental degradation? Let's see. So again, go back to the fundamentals, right? You've seen blockchain technology is adding trust to untrusted environment and actually exploiting a distributed ledger mechanism that is supported by peer-to-peer, and in order to create a record of significant events. That means that you are creating an untrusted environment so that a distributed ledger technology comes in as a technology support, and you are able to do authoritative way of managing things. And from a business point of view, it actually helps in transactions without need for a central arbitrator, right? So you have seen blockchain is in terms of highest kind of adoption, right? It's in the peak. So if you want to restate the definition, it's going back to the fundamentals, right? So blockchain is actually changing the way the supply chain can get transformed.
So if you see, this is the cycle, right? You have a raw material supplied by suppliers. It goes into the manufacturing plant, then distribution, then retail, and then customer. So see the complexity. You see the cycle, right? Manufacturer A, B, C, ship, distributor A, B, and retailer. So this is the current asset movement in supply chain. And if you see, this is kind of getting transformed. And if you really look at it, how much value it actually by 2026, as per the thing, if you take retail and supply chain, it itself is 136 billion, and 27 billion is already kind of addressable market, that is immediate. So you have a 100 billion market for just supply chain, which is very high. So what are the challenges, right? The challenges are like cooperative and establishing standards, because still there is no de facto standard. Every participant will come out with their own way of adoption. So that's kind of critical mass is not achieved. Only when when everybody comes to the same table, then you will kind of get achieved, right? Then regulatory framework. Not much regulatory framework is available on how blockchain actually can increase in the way that kind of transformation happens, right? Then there is legal framework. Regulatory includes your AML, KYC, local regulation, and so on and so forth. Legal from how trade can actually, if there is an issue, like how can we tackle that? For example, who is responsible if the smart contract goes haywire, right? There is no centralized authority. So how can you give an underlying asset by tokenizing in the distributed ledger with a legal framework? Then scalability, right? You have seen Bitcoin is scalable, but then is there an operational resiliency that can actually scalable? And then settling value in real money. All these days it's been like fiat currencies, right? How do you tokenize those solutions with a payment and settlement in terms of either cryptocurrencies or using smart contracts or whatever it is, right? So these are some of the challenges that's kind of hindering the mainstream adoption of blockchain in at least in supply chain. So blockchain in supply chain, what all it does, it increases the security of transaction. That's definite. Middlemen can be completely avoided, definite. More transparent and auditing can be simplified because anyone can actually view the ledger depending on the use case. Then smart contracts are implemented so that you have a smooth transformation or transportation of goods. And actually this can actually significantly reduce human errors, transaction costs, and delivery delays. So what are the things? You have traceability, you have smart contracts, you have transparency, you have process optimization, you have currency with including loyalty programs and including IoT integration. For example, I am working with a company which is trying to develop blockchain from farmers to consumers. So it's a kind of agricultural supply chain, including finance. That's I've been working currently in recent times as a consultant. So you see the provenance that's coming through, right? In the entire blockchain. How does it help? So it's also visible to the customer in terms of IoT integration, right? And then it reduces the risk of tampering, fraud. It also gives a lot of value added, right? For example, in one example, we can actually know, how to attach like the right fish was caught and when and things like that, right? With supply chain transparency using blockchain. So example here, like you can actually condition from a fishing how it is processed, transport, retail, consumer feedback. So entire transparency supply chain can be actually used using blockchain. So this is just an example of fishing supply chain. How blockchain applications have the potential to improve supply chain using basically for registering, certifying, tracking, and at low cost because two are connected via a supply chain and all goods are identified via tokens. So it is kind of anonymized and each transaction is timestamped and it's in encryption. And smart contracts can be deployed automatically to execute payments and other procedures. So what are the things like how we can do it? You can have an application, decentralized application that helps transform the supply chain market at low cost goods transfer. Then you can actually have a tokenization via blockchain and each transaction is timestamped. And we can deploy smart contracts basically to execute payments and work with the enterprises. So today, this is the system. Tomorrow, you will have all through a blockchain, direct relationship and visibility across a supply chain without a need for intermediary. The left hand side is today, it's a cycle. Tomorrow, it's like a direct relationship. You don't need intermediary. So potential impacts and development, several companies are actually working on
testing blockchain for the supply chains. So this is source map. This is one of the system which is working around some health and safety for supply chain. Mojix, they are trying to automate the supply chain to enable smart contracts. So the developed solution can allow smart contracts between suppliers, retailers, and logistics providers. So we have seen it here, right? So you can actually see today and tomorrow. So Mojix is one of the use case. Then Everledger, actually Everledger is a very big case study. So they have a tracking mechanism of diamonds. They actually track from mines to jewelry stores, and they also have insurance, which with documentation. So they take 40 attributes, and they generate a serial number for each and every diamond, and they've been giving digital IDs to Everledger blockchain. So this makes it establish, maintain ownership, which can help counteract fraud, support police and insurance investigators who are tracking stolen gems. So it's easy to find out, each and every step of a diamond thing, starting from cutting to, identification to finally reaching the customer place. It's all done using a digital ID in the blockchain. So it's a very big case study. So Provenance, this is another company which has developed real time that verifies an asset by assigning a token or a digital passport. This company gives you a tool to create living histories for any product. So this is another example. SKU chain, they have cryptographic principles taken from the Bitcoin network. So they are actually making next generation barcodes and RFID tags. So basically the use case is it's like an anti-counterfeiting systems. Not that the current systems is there, but here you can actually verify supply chain all the way from point of consumption, from the manufacturing. So it's a kind of a next generation hologram or copy resistant labels or counterfeiting systems. So they have a cryptographic proof of each origin of SKU, so from the point of consumption. So it's a very important use case. Cargo chain, basically they have trade documents between trade parties international. So again, you have a lot of trading companies and they just help contractual relationships. So cargo chain is doing that use case. Gate chain, they are doing, we have seen that as a trade finance, right? So they are working on electronic documents, smart contracts, payment obligations in a faster and more easier and secure way. So this is another example of trade finance in blockchain. Hijro, this is basically operating financial network. So it's like a bank powered by distributed ledger technology. You can also Google this. This is again one of the famous one. Modem. Though they are actually taking all the data and they are doing their product actually monitors the temperature of the shipment to ensure GDP regulations, and their data is on a smart contract. Actually, it seemed like in Swiss market 95% success rate. So basically, they are doing pharma supply chain, and they are ensuring the temperature of the parcel, especially the drugs like insulins and biologics, to ensure GDP, that is as per the FDA regulations or the European regulations, and they are using blockchain and smart contracts. So basically, you have seen like how blockchain can enable supply chain, provenance, trade finance in blockchain, and all and other use cases. And I have run through some of the biggest like Everledger to Modem in this entire discussion. That's it. In the next session, we will talk about how blockchain helps in asset keeping. Thank you. Hello. As we discussed before, we will know about blockchain for asset keeping in this session. So we have seen how blockchain actually helps in the provenance and supply chain finance. Let's understand how it is useful for asset keeping, because this is one of the important things in financial world, asset protection. So what is records management? Basically, it's a information management or records information management, RIM. Basically, you have to manage the life cycle of records, from organization from the time they are created till disposal. With the more and more digitization, it's important to classify, store, secure, retrieve, track, and destroy their permanent records. With regulations like GDPR, you need to have a lot of privacy also and also secure the documents. So digital world. So it's like as I already told, creating and capturing the digital records, securing the digital records, preserving, restriction access, disposing, protection from ransomware and other threats, and also protecting the from unauthorized disclosure, right? Theft or alteration or disclosure. So this is the whole digital world. So, but why do you need a secure records management? The healthcare now leads with the records compromised till date. There's so many breaches that's happened.
Like the more than 12 million records have got exposed. And if you say there are 264 incidents, and even government and military sector has got some incidents. So we need a high-end secure records management here. What is characteristics of record management? It should be having assurance. It should sit carefully on the internet. It should not rely on any network security. All data access should be well known, and it should be having a security mode of operation. And it's like a bring your own device kind of atmosphere. So you should have a complete characteristics of records management. It should support industry standard. It should be access to any way via hardware. It should have a mandatory security policy. It should support for industry records management dictionaries. No centralized access control. It's immune to ransomware. So basically, if you say the digital world, right, there is a metadata, right? So you have various kinds of metadata. You have types at least. You have descriptive metadata, you have administrative metadata, you have structural metadata. So descriptive is basically the intellectual content of the resource. That includes like indexing, discovery, and identification. The administrative is like who owns this digital resource, who will be given rights, and things like that. And structural is like basically like relationship between multiple digital files. Like if you have a page order like a library in a digitized book, that is like structural metadata. So there was one project which is called Interpares. This was one of the good record keeping project which I just wanted to quote. It basically has chain of custody and chain of preservation, and basically they're trying to create a long-term preservation of electronic records. So you can Google this. So this is one of the famous project, and this is one of the classic example how this is getting transformed using blockchain. So this is the whole thing. They are basically doing how do asset register asset, and then how do you verify who has the verification. Then the electronic record is accessible by whom, and then there is a privacy issues and who is working. So basically, this is a template that they are using. With the system. So you can see some screenshots here how metadata is being completed, and they also give a certificate of authenticity. So this is kind of used as in terms of including like for products like Microsoft, and like for passports, even for certifications, and even for security. So what is the essence is like I just want to bring, because records management is a big subject, so I just want to cover at least the fundamentals of that. And so it has high cost, it has long delays, it's permission granted, so it has high cost, it is getting long delays, it is permission granted, and it is trusted third party. So which is all the issues and challenges. And then metadata is a big example. So you have technical metadata, you need to preserve this metadata, and you have a lot of administrative problems. So these are things that is challenged, and you have a properties. It is like atomicity, you have consistency, and you need to store record properly. So what we call it as records management solution should be always immutable. So what happens is like it should be atomicity, like it should have make sure that the entire transaction is captured. That means like the atomicity in every situation, including power failure, errors, or crashes. And it should be indivisible, right? And it should have consistency. So for all of this, RMS should be written once, data stored, and it should be immutable, right, for all operational use cases. And it should be easy to isolate, whenever it's required, and it should be durable across physical, any kind of locations. So it should also be it should be free from denial of service and resiliency. So give this. So with all this, we should have a decentralized key management system. It should be useful and support for various use cases, including mobile. And in case of health records, an RMS should be exclusive control and unauthorized access. And it should be like with encryption and globally secure. So this is all possible through blockchain. So that's what we are coming, the blockchain records management. So it is based on blockchain technology. It's completely network stack. It's HSM protected keys, and it comes with cryptographic protocol. So all that last 5 to 7 minutes that what we have seen, what is records management, what are the characteristics, what are the functionalities, what are the challenges, it's all done by what we call it as blockchain records management. So here, it's all parties are identified via secure identity. So there is a SIN number, and this supports peer-to-peer, any of the encryption,
and it enforces key management system, and all records are encrypted at rest, and it's a fail-safe design. That means in a blockchain, if there's any change that is happening, they can easily recognize that, which is kind of giving non-private records. So privacy of records is the most key here, and this is a blockchain-based distributed key management system, and it runs on application datagram protocol. So it can run on any network. You can actually have short packets called datagrams. It operates in a self-contained entity, and it will be delivered to the destination without the reliance on between sources and destination. It's kind of connectionless. You don't need a session management or a special channel or a VPN. It supports stateless datagram encryption via content management syntax, and it has public keys. So this runs on application data protocol. That's a kind of programming. It sits on any network. You have short packets of data called datagrams. It is independent entity carrying capacity. You don't need any connections. It supports stateless datagram encryption via content messaging systems, and it's available, privately owned. You can have managed private cloud. You can also have SDK for client and application, and suitable for PC and mobile. So it gives all of them at a click of a button. So this is one of the blockchain record management system is one of the growing area and can help financial organizations. And you have data options. You can have unencrypted data. You have encrypted data. You can also have hash data. So that means like you can classify the data. If it's been read by every participant, you can have an unencrypted, which is like still transparent, and it doesn't have to create a resolution in terms of dispute. If it is like encrypted, if you require any encryption, so you can have an encryption point. Some of them, a third party is like you can also have a hash data. That means like a fingerprint data. You can actually hash, right? You understood, right? What is hashing? That means for every input there is a unique output, and this can be placed on the blockchain where you don't even know who are the identities, giving from using hash computation. So that's the beauty about this. So in this, we have understood what is blockchain, how it can be used in records management. We have seen some of the records management and how blockchain record management is different, what the characteristics. So this is again a big use case in financial services. That's all for this session. Next, we'll learn about blockchain for multi-party systems. Thank you. Welcome to this session. We will discuss about blockchain for multi-party systems in this particular session. So let's jump the session. So in this section, we will understand how blockchain is enabled as a multi-party aggregation. In financial world, it's a multi-party system, right? You have a lot of intermediaries, you have a lot of actors, you have a lot of relationship ecosystem. So let's understand how blockchain is trying to solve this as a multi-party aggregation. So basically, let's understand if you have two banks with two internal databases of customer identity verification, and at some point they notice that they share a lot of customers. So there is a reciprocal way of entering a sharing arrangement in which they exchange verification data to avoid duplicate work. So technically, this is called master-slave data replication in technical language, in which like you have a live read-only copy of the database, and you can run queries in parallel against its own database and the replica. So this is one of the examples of multi-party aggregation. And imagine these two banks invite three others to participate in the circle of sharing. So it's basically each of the 5 banks runs its own master database along with 4 replicas of the others. With 5 masters, 20 replicas, we have 25 databases in total. While doable, this consumes a lot of time and resources in each bank's IT department. So what is the essential? 5 masters, 20 replicas, and 25 databases. Fast forward to this point, understand where 20 banks are sharing information. So what is essential is like you're looking at 400 databases instance in total. So for every 100 banks, you reach 10,000 instances. So that means like if every party is sharing with every other party, it is like quadrupled or 8 times, or it is more than 10 times the square of it's like directly proportional to square of number of participants. At some point, it is scalable, but it is bound to break down, So what is this? Blockchain is a good solution for this. One solution is that all the banks will have a trusted intermediary, which will maintain a single master database. For example, if you are using Hyperledger,
or Ethereum, you can have single replica, one replica within four walls, and anybody can get access. So since it's a private ledger, hyperledger can be one, and so it brings in the value added benefit of redundancy and failover of the system as a whole. So this is what I say. Identity is one of the use cases in banks using blockchain. Second, know your customer. The second, because every bank, some banks will have the same customer across. So the only thing is blockchains offer a simple, cheaper alternative with shared databases, multiple copies, and it runs as a single master. So it's important to make sure that blockchain is not acting like a distributed database like Cassandra. Blockchain has nodes, so which prevents from one participant to modify or delete the data added by another. So understand that blockchain is a network. Each node has a capability to store the data, and it cannot be easily tampered because it is immutable. So any good platform will manage networks and thousands of nodes, and everybody is willing to join based on their need, and we can give guaranteed permissions. So here blockchain acts as a platform. It is just not about database. We are not just talking about database. Multi-party aggregation, I just gave an example of database because as a use case for identity solutions or a know your customer. Whereas blockchain enables the entire distributed ledger with which you can store the data across with single node, and you have multiple copies, and it just acts like with a permission way. Anyone can join, and it's completely scalable. So that's what I'm trying to explain in this, how it can help the multi-party aggregation. So see this, you have a hash value, you have a hash chains. So you have a global root hash value. So this is how you call it as a blockchain aggregation. So every data is encrypted. It gets showed as a hash value. And you have a global root hash value. And that too multiple copies. And it gets updated every second. So imagine this. So it's upward downward flow of hash chains. Completely safe, completely immutable, completely tamper proof. So this is what we called as multi-party aggregation using databases move to blockchain aggregation. And it's verifiable electronic data, right? It's a keyless. Basically, it's verified electronic data. That means all the valid transactions, it comes through cryptographic mechanisms and encryption. What more you want? So it offers a beautiful credibility functionality using blockchain. So where are it is? So what all it brings in? It brings in unique digital identity. It is a decentralized infrastructure. It has an ecosystem which is scalable. It is fraud and secure proof. It is automated. It gives you innovation. It's having a lot of data pooling opportunities, and it is technology agnostic. So I'm just reading through, especially insurer. They have so much of these, blockchain can bring in so much of capabilities. So digital identity, you can actually do a consideration using a private or a public ledger. It can complement the existing mechanism. It also has data protection. Decentralized, everybody knows. It has a multiple number of nodes. It is self-reliant. It can be used for insurers, brokers, anyone in the system. And it has a ecosystem scalability, right? Because it's peer-to-peer insurance. So this thing which I'm trying to give you, a blockchain aggregation, is for an insurance company. Then it also works as a peer-to-peer. Then it prevents fraud, right? Because it is immutable, right? So DDoS, as we've seen, should be the network should be more than 51% so that he can enter. And it's improved, safe, easier data access to all parties. And it gives automation, right? Because blockchain technology is capable of permitting real-time transaction-based services. Innovative, right? You can actually scale, and you can capture risk mutualization, more sophistication of self-insurance and things like that. Data pooling, anybody can share the data real time, whether it is buyer or a seller or a financial company, it all can, or a claims management or a government, anybody. And then it has a de facto insurance compliance because it is technology agnostic, and it suffices all the data protection laws. So if you have opportunities, you have 7 to 8 opportunities, and why you consider blockchain for insurance. So I'm just running through this.
basically opportunities for insurance companies and how the consideration, why you need to understand insurance business, especially in the multi-party aggregation as a case study. So it is resilient, right? You can actually have inventory maintenance, detection, respond, and recover. For example, in inventory, it records digital assets. Insurance inventory can be done. You can detect because you can actually have real-time alerting. Respond, you can actually do real-time decision making. And you can recover. In case something happens, you have multiple copies of the data. So you can have a blockchain-based resiliency very easily. So this is one of the biggest use case called multi-party aggregation, and I've shown you what are the advantages blockchain aggregation, and I've given an example of insurance provider why he needs to identify multi-party blockchain for multi-party aggregation, especially insurance industry, given the considerations here, and how does it bring resiliency.
Let's end the session here. We will understand how blockchain helps in asset management in the next session. Thank you. Hello. Here we will learn how blockchain helps in asset management.
So we have seen like in provenance tracking, in aggregation. Now understand asset management. So this section is actually we are dealing blockchain and asset management. Asset management is the greatest use case in financial services. Let's understand how. So you have business doesn't exert isolation, right? You have customers, your suppliers, your banks, your business networks. Basically, what is wealth? It's a sum total of goods and services, right? And the flow of goods is in the business network is open, closed. So you have a lot of open markets, you have closed markets. So see the networks, right? So completely, most of them currently is a digital asset. And what is wealth? Now we are talking about digital wealth. So what happens? You can transfer assets and you can build value. We have already seen what is an asset. It can be tangible or intangible. It has some value and it can be converted into cash. Cash is just an asset. So other asset examples are cars, clothes, bonds, securities, licenses, patent. So it goes on and goes on, right? So basically, you need to have identity, building assets and transferring assets which has value. So you have participants, you have transaction, you have contracts, right? So we have seen this. Participant is like a business network. It can be like a buyer, seller. It can be government. It can be regulated. Transaction is like when someone sells something to other. And contract is a legal obligation where somebody it is recorded under a statement of record. No? So what happens here? So in these kind of networks, in these kind of participants, transaction, contracts, you need to have it's all assets, right? So basically, private blockchains offer key benefits. It's real-time asset tracking, it's stable, it is distributed infrastructure, secure, immutable records. So we have seen this in terms of supply chain, we have seen this for provenance, we have seen this for multiple aggregation with insurance as an example. Similarly, for asset management also, this is one of the key things. And blockchain will deliver new efficiencies because you have real-time settlement, you have direct fund subscription and redemption, and it has an enhanced AML, that is anti-money laundering, and KYC, that is know your customer. We have seen this as an example because banks are coming as a conglomeration where each bank is trying to build one ledger. So we have seen if two banks have multi-party, you have becomes 10 banks, it's like quadrupled everything. So if you have a ledger, especially private ledger, it gives you scalability. It's almost like real-time settlements, and you don't have an intermediary at all, and you have an enhanced AML and KYC. So blockchain is in early stages, but it is emerging continuously. And blockchains will directly impact settlement times, fund subscriptions, and redemptions on AML and KYC. We have seen, right, in case of an import and export in a trade finance, like everything is trackable almost on real time. So that means settlement times will come down, subscription will become cheaper, and with all enhanced security and fraudulent detection is faster. So now it's a time for even asset management to identify relevant use cases and develop blockchain strategy. So asset management, like I'm not sure how many $1 trillion are there under assets for any organization in the world. So it's high time for blockchain to identify certain use cases and develop a blockchain strategy. So what is thing? You need to experiment, collaborate, and embrace blockchain technology to win the future. So it's a even in multi-party aggregation, including insurance, is just a small use case. You're talking of asset management, the whole umbrella of financial world comes in. So there should be a huge willingness to embrace. I think we are going towards that. So why again I'm emphasizing because You have a storage ledger, you have a smart contract, you have a network consensus, and you have security. And bottom, it comes with a lower cost, it has increased transparency, it has greater security and faster settlement. So why asset management should go for this? Because it has all the chronological sequences required for all the challenges in the asset management current industry. So what is it? Transactions are broadcasted through the network and it is traveling from one node to another. And distributed ledger storage, it's basically a chronological record of transactions which runs across a business network. All parties agree to a consensus. For example, in the Hyperledger, you can see which are the parties we can agree. Embeds with a smart contract, which is a simple software line of code. Then cryptography is used, encryption is used. SHA-256 example we have seen. And it comes, all the transaction is stored in the distributed ledger technology. And on the bottom down, you have lower cost, increased transparency. We have talked to a great level of how it is compliant. It increases security and faster settlement. So again, some of the blockchain is also getting used for testing, and asset management is using testing. So blockchain technology is moving in terms of the reason why there is a fast-paced tech innovations because there's not of blockchain testing experience in Slack. So currently, this is another opportunity area which can be part of asset management. So where are the things you can do a AML KYC testing, and so I've given a simple flow chart how you can do a testing because most of the asset management transparency and compliance is the key. So this is a big opportunity for any company to enter, using AML KYC testing for asset management. I'm just trying to bring this because this has been in some of the conferences, and if you just understand of the blockchain AML KYC testing, this can be easily extrapolated and they can make business out of it. So what happens? The current system is you have a data systems. So all of them lie in the blockchain network. There is a central KYC registry, and then you can do an organization intercheck. So this is a good example of KYC AML on blockchain system. And you have a lot of touch points. This is just example I just try to pull. You have 3 layers. You have a test layer, which is test delivery. You have test types. You can do blockchain platform testing on Corda, Hyperledger, Ethereum, and you have various test types. The reason I'm trying to bring is KML KYC is catching up very fast. It's already there in the market. So this is one of the key requirements for asset management, and testing is actually lacking. So being a financial services, you can always venture into any kind of thing. You can take it to transaction processing, or you can take assets on blockchain. You can also do shared ledger database testing. So I'm just trying to bring this as an opportunity area, and you can also build capabilities according. You can do a D app test scenarios. For example, you can create an import export app. You can also do blockchain event stream verification. So I'm just giving example, or you can do verification of smart contract and consensus mechanism. So it's a big thing. Basically what you have to do is align, build capabilities. So as a part of asset management, I would like to urge that this is a growing area, and if you can build libraries in the asset management using testing as a part of fintech, this will be a great opportunity area. And these are some of the McKinsey based reports, and this is already very big framework with potential of $100 million. So this is just one ABC framework, and basically what I just want to conclude is this: you can take it as a blockchain as a service for fintech, digital and regulatory information initiatives. You can deliver value, and it's a collaboration between financial organizations, banking, and digital, and all cloud and fintech. So basically, you can take any of them, and why? Because it improves market to time to market. It gives you better business assurance. It convergence between customer centricity and digital strategies, and it gets best improved efficiency and quality. So I just brought it as a part of asset management because there's a very growing area and there's a good need for this. So you can do enhancements, you can do re-architecture, you can create knowledge libraries in asset management, basically on interoperability. So again, some of the examples is like you can do tokenization of assets. That's one example. You can do consensus. You can do secure identification of assets. You can create proof of work, proof of stake for some aligned contracts. You can do auditing of transactions, and you can do anything, right? So basically you need to develop capabilities, align it with, and you can do any of the bottom down. You can use Ethereum framework, multi-chain, big chain, Factom, Repoler. So basically these are some of the financial based capabilities that you can bring in using testing. So we have seen like in provenance tracking, in aggregation. Now understand asset management. So this section is actually, we are dealing blockchain and asset management. Asset management is the greatest use case in financial services. Let's understand how. So you have business doesn't exist isolation, right? You have customers, you have suppliers, you have banks, you have business networks. Basically, what is wealth? It's a sum total of goods and services, right? And the flow of goods is in the business network is open, closed. So you have a lot of open markets, you have closed markets. So see the networks, right? So completely, most of them currently is a digital asset. And what is wealth? Now we are talking about digital wealth. Here is the end of the session. We will conclude this module with this session. Hope you will get a clear idea about blockchain implementation after completing this module. In the next module, we will cover cross-border payments, smart assets in trade finance, share trading, smart contracts, online identity in 12 different sessions. See you in next module. Thank you. Hello and welcome to the sixth module, use cases in financial services of this course, blockchain for finance professionals. This module covers cross-border payments, smart assets in trade finance, share trading, smart contracts, online identity, and we'll learn this in 12 different sessions.
Let's go into more deep dive on the financial use cases. So there are some interesting use cases, case studies, which I will just like to highlight in this section. So you see, these are the use cases. Actually, these are the financial industry matrix, that is retail, commercial banking, investment banking, markets, infrastructure, asset management, and insurance. I'll touch on each one of them in some extent. So basically, what you have is blockchain potential applications that is kind of disrupting. If you see that's in the future of transactions. So you, whether it is digital currency or smart contracts or securities or record keeping, you have most of the things like changing. So in terms of digital currency, you have remittances, you have microfinance, you have P2P lending and global payments. And similarly, you have the equity, private markets, debt, derivatives, and all on security side, and you have something called wagers and escrow on the smart contract side. This you already know about it. So the compelling use cases are like smart contracts, which we have seen, smart assets, basically, which comes in trade finance, supply chain, workflow rich data. Clearing and settlement, we have seen some of the use cases. Payment, this is I gave an example of Ripple, where the framework is shifting from ACH or Swift. And digital identity, where I have seen like KYC kind of stuff. So these are some compelling blockchain use cases that financial industry is using. So there are stack of processes, and there are financial instruments where best suited for blockchain. It can be clearing networks, international transfers, clearing and settlement, asset ownership, auditing, reconciliation, reporting. Whereas in terms of financial instruments, it can be private equity, bonds, derivative commodities, trading, spending, mortgage, microfinance, and servicing. So these are some of the best use cases that can for blockchain. So trading, clearing, and settlement functions will be automated using a blockchain, using smart contracts and oracles. So this is how it happens. In the market, you can be on the chain, off the chain, and there's simple smart contract that comes as a security contract, and oracles is like off chain, because if you are not on chain, you can still or do the integration with the smart contracts, and it can work with the existing systems and network participants, and they do not interact with oracles directly, because the most important thing is in the interaction in the chain itself. So oracles as like offline chain, basically integrating with the smart contracts. So these are the fintech landscape, some of the great companies that's coming through blockchain. You can see like Coinsetter, PS Nova, Mirror, and BitGo. So these, and bitcoins, you have something like Alpha Point, Bitpoint. So these are some of the fintechs that's kind of disruptive forces in the financial services. And we have seen this, a lot of companies from Fedor Bank to UBS to Santander to Society General, all are kind of understanding this disruption. They are doing some POCs, some of them are live, For example, I don't want to touch the entire thing, but just for self-reading. So you have a lot of things like, Society General has started with cryptocurrency expertise. BNB Paribas is using faster transaction with blockchain. If you take on the ING, they are taking for Rabobank with Ripple. So there's so many things, that's going on. And we have seen like venture capitals also, there are a lot of active investors. Where they are kind of getting is like the transaction verification services, that's a top. Then you have payment processor, financial services, infrastructure, exchange, not to leave anything like, so mostly this is a little old slide, but then the thing is like, last year we have crossed like more than private equity, for venture capital in blockchain. So why there is an investment interest in blockchain? Because blockchain has the potential to reduce infrastructure cost by at least 20 billion in a financial services. I'm talking of a large scale industry. P2P money transfer across international borders, it's already worth 500 billion, and there's at least like 1 billion investment that has gone in, and there are 4,000 active fintech startups in the New York area, and it's kind of tripling in next 1 or 2 years.
That's all for this session. Next, we will discuss about advanced financial use cases in blockchain. Thank you. Hello, we will get an idea about advanced financial use cases in blockchain in this particular session.
So what are the financial services use cases for blockchain? Let's understand a bit of it. Blockchain for banking. So first one is letter of credit. As you know, like in the export import, there is execution using letter of credit. It's a kind of a credit facility that is extended to the buyers or sellers. So you can do the letter of credit with the blockchain, and it increases the speed of execution from 4 days to 1 day. Then there is something called corporate debt. Basically, what happens is you can actually do a market capture of invoices based on the the inventory and kind of real time. So this is one of the big use cases. Repurchase agreements, because uh, there should be a frank, transparent marketplace for bids and asks. So there is a lot of counterfeiting happens here. So that means like you can use repurchase agreements using smart contracts. And supply chain and B2B contract, that's where like where the buyer and seller happens for purchase of goods, or services, or whatever it is, right? So supply chain. So these are some of the financial use cases for blockchain, especially in for banking. You have security services, you have capital markets, you have trade finance, and you also have card operations. Security services, like that's basically on the trading side. So you have settlement, post trade operations, and trade repository. So we have seen this. Post trade is like basically it reduces from 3 days to one, almost like real time. Capital markets, like you can have a derivative trading, or you have a derivative prosper trade management, or syndicate loan. And you have trade finance. We have dealt a lot in this trade finance, basically connecting between parties. And last thing is card operation, where I said like even in India there is a KYC process for almost like 40-45 banks or conglomeration. So these are for banking and banking consortia. So basically what you see is like the financial services has been increasing from 2015-16. This is just a selective ground that financial services is changing the landscape in the next couple of years. So this is one example. Securities trading between the depot and the nostro. Basically, there is a lot of time that is required and money goes into reconciling. But if you use blockchain ledger, this all comes under one ledger, and you can save cost, you can save time. So reconciliation is a very manual effort, right? And it's basically doing one cycle to another cycle, one the approval from another person to one second position, be it cash positions or security positions. And so if you just have a one ledger, right, so it's easy to transact you from entity level to no end level. So be it trading rail or security settlement or payments rail, it just happens with the banks. And now if you see global payments, see the understanding, right? You have 1 2 3, that is first process. Second process, that is transfer money. You initiate relationship, you transfer money, that you have two subsections. Then you have 3 4 5, that is beneficiary. Then you add KYC, then you have 5, and then you have 6 so what is happening is a lot of state pain points. You have inefficient onboarding, you have vulnerable KYC, you have cost and delay. It's error prone because many of the manual processes, it doesn't show the liquidity, and it's also demanding regulatory compliance. This is the current state process, but just future state process, it's like seamless. Basically the process remains the same in terms of beneficiaries, but what happens is like you have a seamless process, you have cost savings, you have sender and beneficiary, receiver, basically all under one ledger. It's real time anti money laundering or KYC, and it's reduced settlement time, it gives you cost savings, and it's automated compliance. So from verification of KYC till the distributor, all runs on distributor ledger. So it's a very foolproof process, and I guess like blockchain will actually it started transforming the way, at least in payments use case, and there are a lot of companies which have started using for their trade finance and other use cases using payments. So very good example of global payments you have seen from current state to future state. And insurance and PNC claiming, you have a manual process, some mammoth process, like you have 1 2 3 4 5 6 7 8 steps. That means from a time report loss, from an insurer that gets into the reinsurance, to loss adjustments, to claim agents, to claim approval, initiate payment. So it's a quite a long process. You have broker, you have insuring broker relationship. Some of the pain points are its undesirable customer experience, fragmented data sources, fraud, a lot of fraud happens, you never know like what is the right process, costly intermediaries, and manual claim processing. Future state, it's a 7 stage process, but then like it's all it's going to stay in the same ledger. So you have claims processing, claims assessment or loss assessment, and claim approval all in the same page. And how it is going to benefit: simplified automated claim submission, enhanced customer experience, and automated claim processing, and reduction in fraudulent claims, integrated data source, and streamlined payment processes. So the payment can be almost like real time, right? They can initiate a smart contract for payment, and the insurer can get the money in the bank. Then you have syndicated loans. Again, you have loan request, step 1, step 2, step 3, you go to step 4, member, then it goes step 5. The main thing is like it's a time intensive process, lack of technology, labor intensive, lack of integration, inefficient fund dispersal, default risks, costly intermediaries, siloed systems. So if ultimately if you require a loan syndication from many banks, there's a lot of siloed systems, right? Uh, so this entire thing will be pledged using this one. So it just runs on the same 3 processes: syndication, diligence and underwriting, and closing and servicing. So it's all in the same level, right? So you though the process may be same, but it runs on a huge foolproof like smart contracts. It helps you in servicing documents online. You have a embedded syndicate formation, you have automated diligence, you have technology integration, you have servicing intermediation, and reduced counterparty risk. Stage is seamless, right? So this is cumbersome, but here it's like everything is through smart contracts. You have the whole network lying on each other, so it's a very optimal process, right? And it saves a lot of money and time. Similarly, trade finance, you see the current process, like from the time order goods, so he has to create a LOC, he has to do the documentation, it goes through an shipment, it goes to the inspection company, then the importer bank, and finally it initiates an import bank. So many things. So what happens is like invoice factoring, manual AML review, there's a lot of duplicated bills of lading, delayed payment, multiple platforms, multiple versions of truth. We never know what is right, what is wrong. So the entire thing can be just transformed. All that you have to do is just initiate a goods transfer and provide invoice, goes through a smart contract to an import bank, go to the customs. You have all through similar smart contracts. Just hits the import bank, it just approves it, and then it comes back. So this completely reviewed into real time. Transparent factoring, disintermediation, reduce counterparty risks, decentralized, proof of ownership, whatnot, automated and settlement, reduce fees, and regulatory transparency. So we have a case study that's like Barclays. They have done live trade finance with real customers. They're very happy. Then Montego, they have used trade finance. They have also used anti-money laundering, know your customers, and capital markets. So Montego is actually IRDBT working group on blockchain technologies. Very good one. Monetego, basically that's like very good one. Oxysys is a money transfer platform between cities, and this has been taken by a lot of governments as well. and it's been tested in Asia and attracted more than 10,000 users. Alpha Bank, they've kind of used this technology first in Russia and through smart contracts on basis of blockchain technologies, and basically helped. The main objective was to check on the reliability capability of smart coin operation. Basically, S7 Airlines and Alpha Bank for service payments. Interbank blockchain. So basically, these are some of the companies. Yes, ICICI, yes, and Axis. They are Indian ones. They are also doing a pilot in this entire case study. Bosch, they have done using for trade finance, know your customer, capital markets. So how it is done is like Bosch, Cisco, BNY and others launched new blockchain consortium. So they have also set up a derivatives exchange. Yes Bank, it's basically using Hyperledger. They have used vendor financing and seamless integration with client ERP and bank systems. So it's reduced the cycle time from 4 days to real. Immutable transaction history, transaction status seamlessly and transmitted. Superior crypto key and paper transaction itself is done out. So they have done for financing Bajaj Electricals in India. Regulatory chain, this is like between Deloitte, Northern Trust, State Street. So the entire thing is like collaboration, proof of concept. And direct chain is an investment funds. So basically they are doing it for capturing transactions, managing, reporting with smart contracts and enhance compliance. So what happens is it's basically a collaboration between multiple stakeholders examining the use of blockchain to manage and monitor regulatory reporting. And they found it very satisfactory. So you have plethora of use cases, right? You have P2P, you have currency, you have gaming, trading, data. So there's plethora of financial use cases. And you have typical banking applications, Santander. There are also something called customer behavior analytics and custody services. So all these are some of the banking application that's kind of going gung-ho about it. And SETL used permission blockchain to select customers for cash and asset settlement. That's a good example. And Santander is using it for cross-border transactions. It's like a payment service provider. It's a new PayPal through banks. So distributed ledgers will support smart contracts and they will enforce with the contracts. And they have a wide variety of potential use cases. It can be trade finance, swaps, derivatives or counterparty risk. So wherever it is it's very lower rate and it reduces fraud, counterparty risks and whatnot, and it's going to sit on the same ledger. So SCTL is a permission ledger system that helps top tier banks as example. It's simple, unified and immediate. So what is the thing is basically move cash and assets immediately and achieve settlement transaction finally very fast. So that's what we have seen some of the great use cases in financial services in this section 1.
Here is the end of the session. In the next session, we'll know about use case payments. Welcome to this session. Let's talk about use case payments in this session.
So we will touch upon deep dive of use cases. We will give this the goals are like a broad set of assumptions will be developed, and you have introduction, you have current state, you have future state, what are the barriers and how do you conclude. So this entire format I have used. Actually you can do this as a self reading as well, but I will try to summarize the key points in this entire module, because this is like a standardized format which can just give you a lot of answers. It's a time tested one which I've created using basically with great experience on this. So our focus will be on like what is assumptions, what are the considerations, how technology, regulatory compliance and stakeholders alignment will be done. So end to end that with set of assumptions. But the minimal thing is like why we are using high potential, because it's used for shared repository, it has multiple writers, it has minimal trust, it has intermediaries and transaction dependency. These are the challenges for any of the financial services. We have seen this earlier. So on that you have multi-parties, you have shared repositories, you have transaction between so many entities, interdependency between transactions and so on and so forth. So we have seen this global payments, they are doing real-time settlement and they are ensuring a KYC process, bringing a legality, cryptographic hash, and they are addressing standards and interoperability. Insurance, we have seen mainly in the P&C claims processing. Basically they are facilitating for the property and casualty and to potentially reduce the fraudulent claims. And implementation conditions, a comprehensive set of asset profiles, adopting standards and providing a legal framework. So these are some of the ones they are using in P&C claims. Syndicate loans, Summary is basically they are using DLT to automate syndicate information underwriting, disbursement of funds, and reduce loan issue times. The implications are that forming syndicates through high-speed regulator view for facilitating AML and KYC. AML is anti-money laundering and KYC is know your customer. They are underwriting risk because they reduce the number of resources, and smart contracts are actually real time. So what critical condition you need to understand is it's a risk rate framework for syndicate selection, and they are standardizing the diligence and underwriting templates, and they are providing access to financial details. See, basically you need to understand where they are using, what are the critical conditions, that means if you want to use, and then how do you actually formalize the process. So I'm just giving that. This is mainly important for deposits and lending because this is the core of the bank. Similarly on the right hand side you see trade finance. So again they are trade finance, they are trying to create a new system, reduce counterparty risks and faster settlements. Critical conditions for implementation is like they need to provide transparency into trade finance agreements, enabling interoperability with legacy platforms, and rewriting global regulatory guidance and legal frameworks. And financial institution, what is the implication? Co-creation, improved facility of credit management through smart contracts, real-time transaction visibility, and eliminate of corresponding banks. Completely out. You can directly do from an export bank to import bank. Capital raising, there's something called COCO bonds. They are using smart contracts to reduce the stress test, and their implications is like it's a tokenized bond instrument and data driven decisions. Smart contracts is being used. I'm sorry because smart contracts is the one of the biggest use cases in blockchain, and they are giving provider transparency into loan. What are the critical conditions? Standardizing attributes, standardizing trigger calculations, and developing process to act on real-time notification. So COCO bonds, contingent convertible bonds, these are very important ones, and they are using blockchain to a great extent. Basically on the capital raising, investment management. Again, they are using DLT to store financial informations, get out with manual audit activities, reduce reporting cost, and deep dive regulatory oversight. Why? Critical condition means like for implementation they are providing compartmentalized access to data, automated, faster and efficient for enforcement of regulations, and enabling interoperability. And implications for financial institutions, again seamless interaction, smart contract facilitation, and storing financial information. Similarly, proxy voting, this can be for shareholder meetings. They are doing via smart contracts. They are trying to validate the votes and basically personalized analysis. And the critical code is like storing investment records and integrating legacy voting mechanisms into tokens and collaborating across actors. So again, what is the implications? Like reduce time, simple ledger, proxy statements getting out, and smart contracts can actually automate the entire voting process, end-to-end confirmation. So again, use case in investment management. So we have seen this actually going into at least a high level of what is a summary. How are you doing implications for, what's the implication for financial institutions? FI stands for financial institutions. And what are the critical conditions for implementation? So let's understand a bit of global payments in detail now. So global payment, current state is a payment refers to transferring a value from one to, for example, for exchange of goods or services. And it's a concept where basically multi-geography and multiple fiat currencies. And who are the key stakeholders? You have money, sender, beneficiary, transfer, center bank, beneficiary bank, SWIFT, loan clearing. So the entire transfers are always known as remittances. And key market participants, these are some of the roles which you can just read through. Be it money core, correspondent bank is supporting, SWIFT is supporting, local clear network is supporting, and regulator is supporting. But just see how this is going to transform. And this is the current state process depiction. They initiate a response, they go transfer money, they deliver funds and act upon. So current state is like, they perform AML, KYC activities, collect funds, they utilize SwiftNet by beneficiary is notified when the, depending on the need of the money transfer. And then there are local banks, regulators, and there is sender ID, beneficiary ID, so on, so forth. And what is the current state pain points? Inefficient onboarding, vulnerable KYC, cost and delay, error prone, liquidity requirement, vulnerable KYC, similar to 2, but then this is basically in terms of maturity levels and then demanding regulatory compliance. See, we have seen in the first earlier module on introduction of use cases. Then we went into the second level where we have seen how do you actually summarize this, and now we are going deep dive on each of the use cases, at least the critical ones in the financial industry. So this is a three tier mechanism that I've used so that you guys can actually understand a bit of how this entire thing can be used, and you can develop your own use case based on the experience that I bring in this presentation. And this is a future. You have trust between the sender and the money transfer just through smart contracts. Currency conversion is easy, and it's real time. Just verification of KYC is online, same ledger, and it's also agreed with regulator. And transaction history is available and can be continuously reviewed by regulators. So these are some of the advantages of future state prediction. The process is same, but then you cut across the intermediaries. You had so many of supporting actors in this slide. If you go back, you see these actors here, but here it's all like straight benefits is like seamless KYC, liquidity issues can be solved, real-time anti-money laundering, reduced settlement time, cost savings, and automated compliance. So this whole lot of payments future state. So we need to understand the benefits of this. So how blockchain can or distributed ledger technology can actually outweigh the whole current process and trends. But there are some critical conditions. You should be via standard KYC process, ensuring compliance and legality of cryptographic hash to exchange value. We need to understand that, and you need to adopt standards. But whatever it is, the critical conditions categories are alignment of stakeholders, technology, regulatory, and governance. So these 4 are the ones. And there are some challenges of every process but then we can overcome that. Be it a legal precedent or prioritization, levels of urgency or policies. But then the critical conditions can be mapped. There can be additional considerations like embedded solutions, cryptocurrency linkage. Again, it's a debatable point. But then these are some additional considerations that we can do with global payments. And solutions can be like, they can be in the core banking integration. And if any bank wants to actually subscribe at a later point, then that also actually should be, service levels with the leading banks. So we have kind of completed this first use case in terms of how global payments can be actually done with considerations. That's a very important aspect.
That's all for this session. Next, we will discuss about use case P&C insurance, property and casualty insurance in blockchain. Thank you. Hello, in this session, we will discuss about use case property and casualty insurance.
So similar way, we will understand how P&C claims processing happens. Current state, if you understand, insurance is a financial risk management, and it has many of the categorization. It comes from like commercial property, casualty, perfect business, in terms of loss and this thing, property. So basically, it comes with a lot of caveats and if claim kind of if then statements. But if you see, property and casualty is the second largest insurance in the world after life and health, and claims processing is a key bottleneck. So we see that you have a whole key ecosystem stakeholders: insurer, reinsurer, regulator, and let's see, DLT has the potential to actually optimize the back office operation cost whole sum. And this use case has been like very good. And you can see the market participants: insurer, insuree, regulator, broker, supporting data source. So you have diversified data sources. You have like uh, regulator who is like determining whether it's going on a right way or not, and you have insurer, insuree, reinsurer, so on and so forth. This is the current state. It's a 8-step process. You have first step as claim submission. In that you have 4 sub process. You have loss assessment. You have again 4-5 sub process, and you have finally claim approval, which is 2-step sub process. So once the claim is submitted, it goes for an approval. It identifies assessment of loss. If they require additional information, they go for it. Then they get claimed approved. claims approved, then claims agent actually initiates payment. But let's see what are the current challenges in this. The pain points is like undesirable customer experience, costly intermediaries, fragmented data sources, fraud, manual claim processing. This actually leads to duplication. We don't even know which is a valid coverage. So customer experience is like pretty bad, and you might not know, like, how this entire thing can vie out. So basically, you just need to be gung ho of the fact that there are a lot of pain points. Not that the system is not foolproof, current system is running, but then every time you come into technology, it actually disrupts. So that's the beauty of even distributed ledger technology and even blockchain. So this is the future state: claim submission, loss assessment, claim approval, all in the same page, and it all done by smart assets, automated claim approval applications, claim diligence is through smart contracts. DLT, because you automate, there is no secondary data sources, right? So you can have, if required, and a smart contract can actually automate the liability. And claim is approved, the payment is done through a smart contract. So it's a seamless support. It's a similar ledger. Approval processes like faster, seamless transfer of money, and coverage is very extensible, and it's immutable. So what is the state benefits? It's simplified, automated claim submission, enhance customer experience. I just want to throw that, it's a seamless transfer of loss information from insurer to insurer, that it eliminates the need for brokers. Again, automated claim processing, so you just need to not review everything, but loss adjusters will be very fast. So the smart contract actually eliminates the need for loss adjusters, and reduction in fraudulent claims, because you have a class of asset and provenance, enabling better identification of the suspicious behavior. It integrated with the data sources, and it has streamlined payment processes. So you see, like, most of them is like very, very properly aligned. And that's the reason you can see, like, the benefits are much. But there are critical conditions. Building a comprehensive set of asset profiles and history, challenging. Adopting standards for claims data, challenging. And providing a regular regulatory framework, is again challenging. But what's the challenge between the first one is comprehensive set of asset, because it's emerging in the markets, so convincing the whole ecosystem will be a require stakeholder diligence. In terms of adopting standards, there are a lot of company specific processes, and extensive discussion will have to go on in this entire thing. And finally, providing a legal framework, just started coming out, and then we will see that, it should not jeopardize the interest of some people, so especially the government and other stuff. So that's kind of critical condition that we need to understand. So conclusion is like, the outlook is good. There's an opportunity maximization in terms of DLT with finance, especially insurance. Why? Because it's creating immutable insurance claim records, development of asset provenance, and P2P, that is peer-to-peer insurance. So you have a peer-to-peer DLT products that's coming out. The key takeaways here is like smart contracts will be key, and loss adjustment expenses may become irrelevant. And so, but the two conclusion that you can do is, it automates claim, and it reduces fraud. But still, there are unanswered questions: profitability and pricing. Will it change in terms of overall ecosystem? But seems to be very positive. Profiling is good, and it's kind of disrupting. There are some unanswered questions which we have to conclude over time in terms of how you actually accentuate the claims processing. But property and claims after health and life is the biggest use case in business today in financial industry.
That's all. We will cover use cases in syndicated loans in the next session. Welcome to this session. Now we will talk about use case in syndicated loans in this session. Let's start then.
So we have seen the earlier section in terms of trade finance and payments. Now let's understand how syndicate loans are like, based on the framework that I have created for loans. So in this we will try to understand the assumptions, scenarios, ecosystem, conclusions, how it's beneficial, and so on and so forth. So what is syndicated loans? Basically, syndicated loans provide large-scale finance diversification, and this is for a large investor. It doesn't like one investor serves as the lead arranger, and it's actually done through loan life cycle, charging on a fee based on the complexity. So you have most of the Europe and US markets is like dominated by incumbents, and the Asia Pacific market is growing, and Latin American market is like immature. But what is the potential here is like you have a lead arranger, it's been with the regulator, requesting entity, and a syndicate. So the complexity is very huge, and DLT has a potential to even optimize the backend operations. And it highlights the key opportunities to end-to-end syndicate loan process. Let's understand a bit about how to go deep dive into this. So who are the core guys? You have a lead arranger, you have a syndicate, basically a group of investors. Requesting entity, it can be a large loan. It's a large organization. Like for example, if you have to top 500 Fortune companies, or mid-tier companies, more greater than 5 billion in turnover annually. So what's the current state process? It's a 6-step process, and large corporation requests a loan from a financial institution. Basically, it's a lead arranger, and the second procedure, he performs the KYC, and it actually also, to reduce risk, he arranges sources from funds from other investors as well, and they facilitate the lead actually facilitate to understand how to determine the corporate financial health, and it can be like risk. Then syndicate members pledge a percentage of the overall risk with tolerance, and basically last is like earlier and take them administrative. So basically till the disbursement, from the time corporation requests a loan till the time disbursement, and it is like syndication, diligence, underwriting, and closing and servicing. So you have a kind of 4 steps, and there are 6 sub-steps into it. So what are the main pain points? Yeah, the business workflow. What is the pain points? It is time intensive process and review. Technology integration is actually lacking. It's labor intensive. Even underwriting systems do not communicate with the core systems. Inefficient fund dispersal, default risks, delayed settlement time, costly intermediaries, siloed systems. So there are a lot of pain points that goes with the governance on syndicated loans. These are high level, and actually this has to be disrupted, in the way, not that, the current system is not functioning, but a technology can actually completely disrupt and then give a new way of, process. And that's where your blockchain comes in, distributed ledger technology. So future state is like, you have all of them in the smart contract, all of them pledged with similar ledger, and the process is actually almost similar, but it is like accessible data through the distributed ledger technology. Risk management comes down to a great extent, and it's a seamless KYC process. And finally, like, it reduces the overall underwriting, because it's like some of the intermediaries is not at all required here. The process is same, but it automates. Selection is automatic. Transfer of the data is between smart contracts. Diligent process templates available in one ledger, and it's like, if you have to take Hyperledger, the actors. So how the syndication process happens, and then we can agree, disagree, and then approve consensus within the same ledger. So it's like a pretty easy process. Of course, implementation will take time, but at least it's all in the same ledger. There's no disparity. There are no siloed systems. Approvals are faster. Technology integration is easy. So on and so forth. So benefits, I've already combined, automated syndicate information through smart contracts, embedded regulator, it's basically like AML KYC has become a part of the process. Automated diligence underwriting, technology integration, reduced closing time. So you don't need the T+1, T+2. Servicing intermediation, so disintermediation, you completely eliminate third-party intermediaries. Reduce counterparty risks, whether it's principal, interest, whole life cycle of syndicate loan is automated. So completely reducing operational risk. So hope you understand this process. We just define what is a use case, what are the current process pain points, then how we are using, how the entire process is transformed using DLT, and then what are the benefits. So this is a framework I've been using for all the use cases. So there are some critical conditions. Again, building risk rating framework is little risky. Standardizing diligence and underwriting templates, and providing access to financial details on distributed ledger. Yeah, What are the challenges? Let's understand each one. You should have a single standard of counterparty rating, which requires an enormous amount of coordination and governance. So it's a challenge. The myriad diligence is like underwriting collection vehicles across financial institutions will make one alignment around one format difficulty. So that's again a standardizing digitalized diligence underwriting templates. And finally, providing access to details on the distributed ledger. Whether it's liability model or mitigating the risk, all are in same thing, right? All the participation is same. Basically, again, critical condition categories are stakeholders, technology, regulatory, and governance. So that's a whole charge about it. This was discussed in World Economic Forum as well in 2016. So what is the conclusion? Takeaways is that it's loan lifecycle management via smart contracts, executing servicing in disintermediation. That means that they're completely throwing away the intermediaries to the smart contracts, eliminating the third party fees. Outlook seems to be good because it has smart contract settlement and servicing, automated underwriting, and account servicing via smart contract. The summary is you have an underwriting automation, regulatory transparency, and cost savings. All three put together. And some of the unanswered question is implication of KYC more public. Yes, there are issues. Let's see how over the maturity curve it will kind of change over. But overall summary looks good. There's a huge amount of cost savings because the process of execution and settlement sub process is completely knocked down. And second thing, intermediaries is like eliminated and third party fees is completely away from the process.
Here is the end of the session. In the next session, we'll get an idea about use cases of trade finance. Thank you. Hello and welcome to this session. As we have discussed before, we will understand use cases of trade finance in this particular session. Let's jump to the session then.
Where we are trying to understand the trade finance on the same framework to some detail, and it's basically on deposits and lending, which is like trade finance. Again, trade finance we have understood in some of the modules. So you have a lot of actors. It has importer, import bank, exporter, export bank, inspection company, customs, freights. So basically, where is the DLT is like potential to optimize the regulatory and operational cost of trade finance. And this use cases actually highlights the key opportunities in end-to-end trade finance process. So you have piecemeal concept, you have prepayment, you have counterparty performance. So everything is like current state, and financing is actually dominates world trade, because you're going to trade $18 trillion. That's a transaction. And finance is the main one. So market participants, you see so many guys which are core. There's inspection company, freight, customs, correspondent banks. All are supporting actors, and they just defined what they do. So what is the state process? It has established payment, deliver goods and settle on terms. That means buyer starts ordering, it goes through a letter of credit from the import bank, it reaches the shipment and it's verified. Or either way, it's basically an importer or exporter, sale of terms or sale of products at a future time. And there all the customs verification happens, and then the goods are received either through a seller to buyer or buyer to seller, and then payment is initiated. So this is the current state process, almost like a 10-step process. 10 sub-step process, and then at least three top tier processes. So what are the pain points? Manual contract creation, that means huge documentation. Invoice factoring, basically we don't know whether it's a short-term invoicing or long-term invoicing because it depends on the delivery of goods. Delayed timeline because the shipment of goods due to multiple checks and balances by intermediaries and numerous communication points. Manual AML review because the export bank or the import bank does manual anti-money laundering. Multiple platforms. This is a very, very problematic issue. You have one company with one ERP, you have other company with some core banking software, and so on and so forth. So fraud is very high. Duplicate bills of lading, so you don't even know some of the bills have authenticity. Multiple versions of truth. That means like one entity to another entity in terms of financials. And delayed payment. Disbursement of funds, God knows, like sometimes from the export bank or import bank, how long it takes. So future state, simple, all through smart contracts. Goes as a letter of credit as a smart contract, digitally signed. Customs origin through digital signatures. Inspection through local, through IoT based blockchain. And acknowledges goods, which again import bank via smart contracts. So this entire process is seamless, and they are going to sit on a simple blockchain platform or a distributed ledger technology, So you have real-time tracking of shipment, you have real-time tracking of finance, you have real-time tracking of invoices, whatnot. And payments and settlements actually is fast. So it will be advantageous to the bank which finances for the buyer or seller, right? Both ways. So what are the benefits? I said like real-time review, transparent factoring because invoices are real-time. Disintermediation, completely eliminating the correspondent banks. Reduce counterparty risk, bill of lading. We don't even know the authenticity. But here it is easy. Decentralized contract execution. Whoever is the actor in the entire ecosystem, there is a decentralized contract execution. Proof of ownership. There's a complete transparency. Automated settlement and reduced transaction fees. I did discuss on this. It completely needs to eliminate the correspondent banks and reduces fraud and increases transparency. And AML KYC processes kind of understood faster. So you see this, the whole chain. But there are again the conditions. The conditions are based on 4 categories: stakeholder alignment, technology, regulatory and governance. But in terms of trade finance, transparency into trade finance agreements, that is first. Then you have enabling interoperability with legacy platform because there's so many legacy challenges, and rewriting regulatory frameworks and legal, So what are the challenges? Like, the shipment, everything should be governed. And there should be transparent sharing of financial information. And then interoperability, there are multiple solutions. So you should have freights, customs, shipping agencies, exporters. So you should be able to capable of interfacing with any blockchain ledger. And then you also have a legal presidency, that should be easy to assess by maybe use of smart contract reporting, but little difficult to establish, because of multi-party systems. So again, these are some of the critical conditions, but then there is process is becoming so transparent that this is getting matured. So what is the conclusion? That means like the application of DLT exists within trade finance. So the letter of credit is encapsulated in the smart contract. There is an electronic invoice ledger, and opportunities exist for financial institution to reduce the counterparty risk and fraud by reducing the invoice factoring and reducing bill of lading. At least who are the authenticated guys. The key takeaways is like managing the whole ecosystem using smart contracts. It can capture anything, and DLT utilization is actually disrupting the role of correspondent banks as financial institutions can work directly with another. The summary is letter of credit automation, regulatory transparency, new product opportunities. Of course, this has been there for everything, but then for even incumbents, and cost savings. I don't know, at least we can save up to 30 to 35% of the cost. Then what is the impact on financing fees? We need to understand what is the level of disruption, and how does it fit to the existing trademark, with this process, current state process, how does it fit? So it's very important. So overall looks good, and we have understood bit of that trade finance as well.
That's all of this session. Hope you get a clear overview about the use cases discussed so far. Next, we will discuss about Coco bonds, and it will be very interesting. Then see you in the next session. Thank you. Welcome to this session. As we have discussed before, we will know about Coco bonds. So let's jump to the session.
So let's understand the contingent convertible Coco bonds. So contingent Coco bonds basically it's like a capital for any company, with an investor. And basically banks are responsible for calculating the capital ratio. And some of the places like Coco bonds has been flat and light, but still it is one of the extreme volatile instruments, But DLT has a potential, that is distributed ledger technology has a potential to embed regulation into business processes, and it reduces volatility and uncertainty. So basically Coco bonds is like a capital ratio that every kind of banks need to protect themselves as bonds. So you have not many things, but the reason why is like it stabilizes and it provides authenticity. These are some of the market participants. And current state process, banks determines what is the ratio. It should be like should be falling to 7.5%. Then they have a conversion of Coco bond to equity. So there is a maturity curve, basically monitoring. One is issuance, the second process is monitoring, and then loan absorption. So you have all the three processes, and it's a sub-step process. Like it's not very big, but the volume is huge. Understand the 7.5% below capital of a large bank is important, right? So that's why your Coco bond is important. And the pain points is limited participation, inconsistent trigger, ambiguity because there is no stress point of how much needs to be absorbed by a bank. Real-time reporting is further reduced. Market fear because volatility is very high, and delayed activation time. Sometimes since it's not regulated some much, maybe converted. Sometimes it's like even before the condition is met, they convert the bonds. So future state, it's similar to current state, but then they use the record keeping functionality of distributed ledger. That's where I've explained the record keeping, asset management using record keeping, right? I'm given an example in the other module, so it's very important. Then it's like a tokenization, right? So you have some trigger that there is a tokenized asset against the bond and converted in a predetermined conversion rate, rather than just unexpected rate. You can also decide, because all of them are in a maturity curve within the ledger, so it's easy. So what is the future state benefits? You have increased participations, you have improved calculations because kind of capital inflow in the distributed ledger technology, real-time reporting, reduced stress assets, and real-time activation. So all happens on a real time. But again, I have given you a kind of a critical conditions, standardizing attributes. Then that's the first condition. Streamlining trigger calculations and developing process. So all three sits on the same thing: stakeholder element, technology, regulatory, and governance. So challenge has been different. So for first challenge, each market requires different data, so not standardized across FIs, that is financial institutions. There are trigger values independently and dependent, and there is some degrees of automation that is required, and deploying processes because may significantly overhaul since they are additionally required to point access stress test. So you have a layer of why, you have a layer of what they are doing, and what are the challenges. But then it's one of the use case that it's already gone in live. So conclusion is that outlook is good, while benefits is basically the process execution, because you are using the records keeping process of DLT. So why? Because it improves monitoring and increase investor confidence, and empowered investors, and allows point in time stress test to become irrelevant. But then there are business drivers that needs to be identified and to overcome this entire contingent convertible cocoa bonds. Overall looks good. The main reason it's been like the benefits are process execution.
Hope you will get a clear idea about the cocoa bonds after completing this session. See you in the next session where we will be discussing about the investment management compliance. Thank you. Welcome to another session of this module, which is all about investment management compliance. Let's get started.
So what is automated compliance? So you have a lot of compliance, right? Can be like audit, tax, fees, security exchange, filing, so on and so forth. You have key system holders. So what are the things? Compliance costs are high and auditing costs are very high. This use case actually gives you opportunity area for distributed ledger technology in the financial system audit process to highlight the automated compliance solution. Let's understand how it helps. So you have the whole market participants, you have auditor, you have financial institution, regulator, accountant, Federal Reserve, and Internal Service Review. So basically, these are some of the actors, these are the use cases, and we had a technology embedment into this whole use case. So the key thing is like you need to identify the business process in the initial stages as a use case, and we have to apply distributed ledger technology, how it brings in benefit. So similarly, the current state process, you have auditors work with the bank, the audit team performs risk assessment, there is multiple copies, the auditors evaluate the information, and they work with the leadership team. Any errors, then exceptions are identified, and the report is formed, and then bank uses the report to populate its quarterly and annual filings. So again, it's planning, assessment, follow-up, and reporting. So there are 4 steps, and then there are like 7-8 sub steps. It's a simple thing, right? Any organization should go in terms of compliance reporting. The pain points: resource intensive, time intensive, lack of technology integration, resource intensive. Again, when you have to do audit reports, they're directly not fed into the quarterly reports, right, of the SEC. So it's a simple, complex pain points. So future state, all financial auditing thing can be done through DLT, through data extraction. And then there is a representative. So if you use hyperledger kind of a thing, they can actually get onto the data distribution. A smart contract facilitates movement of financial reporting instruments like be it And finally, DLT is actually distributed ledger is seamless executing automatic compliance such as comprehensive capital assessment, enterprise tax filing, real-time tasks for trading financial instruments, and processing information about regulatory things. So the process is same, but then automation is kicked off, data extraction is easy, audit report is transparent, and then seamless execution or automation of the compliance activities. So what is going to be the future state benefits? Data transparency, that's one. Automated review, reduce errors, integrated systems, and financial access real time. So multiple layers of this data gets knocked off. Automated review because just through software, and reduce errors because resource intensiveness comes down. And integrated systems, you don't have multi-party systems or siloed systems, all this happens here. Finally, authorize real time, because who are the guys who are kind of acting in this. Again, critical conditions, you provide compartmentalized access to data, you have automated, faster and efficient enforcement of regulations, and enabling interoperability. So these are some of the conditions which you have to understand. There are some challenges. First challenge is like for providing compartmentalized access to data. You should have access to whole, not provide the capability to partition. Like currently, you may have some auditors getting in, some auditors not getting in. Again, that's a challenge. And automatic faster, regulations. So you should have a faster process and transparency between the financial institutions and the regulator. And finally, interoperability, because legacy platform, that's always like a known fact with any of the technology use case. And finally, conclusion is there is a continuous audit process. The outlook seems good. There is an AML KYC verification and automated tax filing. Opportunities like eliminate planning and automated assessment reports. So what is the summary? It has process automation, it increases regulatory transparency, and it has cost savings. What is the continuous takeaways? It audit continuously and it extracts financial data. So overall, automated compliance is a good one. And still there is a unanswered question is like how frequently the financial audits can be done, because it can actually backfire the investor decisions, right? How frequently we have to do it is real time. So when do we have to report all the data, and then how often, how do we file? These are the process that needs to be identified. But then yeah, there can be, this technology has just started, so we will come maturity curve in this also. But this is one of the largest use case, compliance, because any financial institution has to comply to this.
That's all for this session. We will cover investment management, proxy voting in the next session. Thank you. Welcome to another session of investment management. In this session, we will discuss about investment management proxy voting.
Then proxy voting, that's one of the investment management thing. So what is proxy voting? Because it's basically very simple. You have investors. If it's a general body meeting, they have a paper format of submission for the decisions, or they send through emails and so on and so forth. But then this is a potential to use transfer value, and this basically highlights the key opportunities to improve retail investor participation. Again, there are participants here: corporation, investor, third party, and regulator. This is again distributed proxy statements, review proxy statement, cast vote. A 3-step process, but then if it has around 7 sub steps. But then it's very simple. If there is any change in the management, or if there is a financial decision that has to be taken with the independent auditors or the core team, so this entire thing has to be approved by the retail investors. So this is a process which current state it is. They send it through email, they send it through online, they send through paper, so on and so forth. So there are many pain points, ambiguity, costly distribution process, limited distribution. Some of them don't receive the communication because the address would have changed or the emails would have bounced. Misleading representation, sometimes we don't even know who is kind of answering them. Error prone, manual intensive, minimal retail investor, that's one of the key. Lack of transparency and voting discrepancies. You may even see fudging, for somebody voting for somebody else. So all these are issues. Again, future state, similar, a smart contract can run on that. Orders are executed through DLT, and investment records are like, including the number of shares, are actually lying on the distributed ledger technology. And then there is a smart contract sent to all investors. and then the investors assess the potential of value. They either vote through DLT, through a tokenized asset, and the smart contract validates these, and then results are shared. Very simple. Just that it brings in value. What are the benefits? The intermediaries are cut, streamlined distribution process, improved accessibility and participation, and automated analysis. Validation is automated, increased transparency, and improved accessibility and participation. You can even do it with native mobile, and then that too on distributed technology. That's how it's been termed around. So again, there are some critical conditions. Storing investment records on distributed ledger, very critical assessment assumption. Integrating legacy voting, and collaborating across actors. So challenges are many for each one of the conditions. Storing investment records, because again you need to validate the digital identities. It should not have anonymity. And immediately on even the legacy voting, so how do you actually integrate the process which is existing now? And finally, across actors, challenge, through smart contracts. The conclusion is good. The outlook is like basically explored by Nasdaq, and financial institutions has improved to use this use case. But the summary is it has a streamlined distribution and automated reconciliation, and it ensures voting transparency, and central authority discrimination is kind of removed. But then what is the cost versus benefit? This has to be understood. So overall, this is again a good use case for financial institutions for voting.
This session ends here. Next, we will know about asset rehypothecation. Thank you. Hello. As we discussed before, we will cover asset rehypothecation in this particular session. Let's get started.
And asset rehypothecation, this is one of the use case. So basically, asset hypothecation is a practice which ensures that any organization actually pledges their assets, and the secondary market is large, and basically the process is like you need to come out with the end broker or end dealer process. That's where you are. So you have a broker selling, buying, regulator. Again, you have a asset rehypothecation. It's a simple process, right? For us, you can have two counterparties, you have 3 counterparties, you have 4 counterparties or 5 counterparties. So depending on the asset, how much you want to pledge, and then how much cash you want to generate based on the assets, you can actually identify the ownership, and it's a little clumsy process. But the customer possessions the home. The pain points: lack of regulatory reporting, counterparty risks, lack of transparency, security value, high ambiguity, and systematic failure. The future process can be all seamless because it can be transaction history on distributed ledger technology, a smart contract which can encapsulate the entire thing. It broadcasts between the information ecosystem. Then as a fourth, they receive the history, and then regulators have a real-time access to view the transaction details, and the smart contract readily hypothecation of asset can be like rehypothecation rules and things like that are simplified. Benefit: transparency, counterparty risk, automated processing, embedded risk regulation, automated enforcement, financial stability, and disintermediation. Some of them are very common across use cases, right? And then some of the critical conditions: they are using a tokenized assets, using a standard. That's one of the condition. Fostering engagement among the financial system, again that's condition. Architecting solutions to maintain the templates. So the challenge has to be like how tokenized standard can be difficult to establish, and who are the people, and engagement with fostering with the whole ecosystem, right? Again, participation. And finally, architecting solutions. So you have to have a technology provider that can flexibly provide flexibility and minimal downstream. So again, these are same thing: stakeholder, technology, regulatory, and compliance, just hypothecated to asset hypothecation. And finally, conclusion: this can be used for gold markets, repurchase markets, asset transfer. The opportunity is basically on the counterparty risking systems, asset transaction history, regulatory transparency, and but summary is like there is asset tokenization can be good, important. It's already started. Regulatory compliance, which is cut across all the use cases. Collaboration, because you have a significant amount of collaboration and standardization. But it reduces counterparty risks and it brings in financial stability. So these are some of the key takeaways. But how do you identify an asset with a history? Value is still unanswered. And how regulators will assume, to comply with this implementation. So these are some of the asset rehypothecation. So there are critical conditions here, benefits, state process, but then the current state process is not very process oriented, but then it is like more of a participation here.
Here is the end of the session. In the next session, we will understand about equity post-trade. Thank you. Welcome to another session of this module. In this session, we'll discuss about equity post-trade. Let's jump to the session and know more about it.
And last one, this is again equity post-trade, which we know is another use case. So you have, these are the market participants and these are core and who are the supporters. This is the trade process. You have trade execution, clearing, settlement and asset. So everybody is aware of this, right? I'm doing an equity trade. I basically sell, buy, and there's a clearing corporation, there's a settlement corporation. Then there is a asset servicing also in terms of large corporates, who just acts as a brokers. So again, there are a lot of pain points. Duration between trade execution, that means like it takes T+3 days for either sell. Once you sell, it gets 3+3 days to settlement. Inconsistent data, this is a little counterparty risks, operational risks, settlement ambiguity, complex account keeping, and cost intermediaries. So again, these are some of the common philosophical pain points in this also. And future is like very simple. They will place the equity orders through an exchange, and the exchange confirms trades and processes. There is a smart contract that generates between banks, and once the smart contracts transaction happens, it ensures some simultaneous transfer, and then confirmation is stored on the distributed ledger technology, and assets are also in safekeeping accounts, right? Because the key resource management for asset management is blockchain. That's where, and servicing level agreements can be easily done. So benefits, reduce settlement time. It can be real time because this T+3 also reduce standardized data requirements, because there is a process, be it settlement, clearing, everything is standardized. Reduce counterparty risk because it's easy to operationalize. Real time confirmation, reduce account complexity, and it reduces the third party need. So again, some of them are common, but identify the thing is like settlement time is a key. So challenges, how do you incorporate transaction benefits with settlement, achieving multiple stakeholder alignment with participants, and standardizing reference data, with market trade. So let's understand what are the challenges. Smart contract executes in real time, but there are some trades which are batch trades and which may require frequency at a normal time. So that's one of the challenge. Then clearing and settlement process. How do you have a liability model, in case of technology failure? And third thing is utilization of reference data. Significant collaboration is required to standardize attributes that are not prone to constant updates. So the custodian banks need to work together to develop a standard set of data fields which matches the investor anonymity and confidence automation. So that's one of the key in this critical condition. But there are some good takeaways because it's real time. It embraces the technology confidence for investors and so on and so forth. So non-finance, you have seen a lot of non-finance, just like in IoT and other platforms, just for information. So with that, we complete the use cases in complete understanding of 9 subsections in the deep dive of the use cases.
That's all. We will cover inclusive finance in the next session. Thank you. Hello. As we discussed before, we will cover inclusive finance in this particular session. Let's get started.
So we have seen a deep dive of so many use cases in the earlier section. Let's study a bit of inclusive finance, just a run through of these case studies in this section. So there's a lot of financial institutions. So there's still unbanked people, 2.5 billion. There are a lot of availability by birth certificate, passport, etc. 1 billion have cell phones, but then these are digital, specifically mobile financial services. But then digital inclusion is a key. So digital inclusion is a prerequisite for financial inclusion. So we are having countries like Estonia going for digital residency, and some of the other ones is e-voting on Tallinn Stock Exchange. So I'm just running through some of the current examples in this, nothing more than that. So there are some of the things like collaboration between Consensus, Microsoft are creating an open source blockchain based identity system, again in very important for banks and financial organizations. It's called IT 2020, and this another project like ID 2020 conference, which is kind of identity crosses. And basically the reason is that it's a UN sponsored, and basically they want to show that everybody should be accessing the franchisee of their identity. That's the most crucial one. Basically the reason is like it's a web based or a wallet based identity management system. All data on the blockchain is public, but then there will be a determined by private keys using a blockchain standard ID. So it's a decentralized identity for all. It's called UPort. So it's going to solve the identity crisis. So Dingle digital key, it's a big proof of concept by Deloitte. So again, they are digitizing the traditional identity concept. So basically, this is important because if you need to bank, you need to know who are the digital identity, and this can solve these cross-border platform transactions, passport problems, all and so on and so forth. Again, Deloitte, they are actually componentizing the blockchain to a proof of concept stage. So basically, blockchain records in real time. So this needs a ledger of everything, be it marriage certificates, marriage licenses, education degrees, financial accounts, insurance claims, votes, provenance of food, anything that can be expressed in code. So basically, blockchain is a ledger of everything. It's a new digital ledger of economic transaction that can be programmed to record almost any of the thing of a value. So micro insurance agreements can be converted to smart contracts. How very well used to solve simplicity, easy to underwrite and adjust, and small premiums and high volume transactions. So you have seen a blockchain insurance policy, a micro insurance policy with the software code in the software smart contract. So we have seen that. What are the advantages in inclusive finance? It innovates products and growth, increase effectiveness in fraud detection and pricing, reduce administrative costs. Scalability is always there. That's a disadvantage. Security, standardization. Of course, any technology implementation will go through. Okay, and I just want to iterate that BFSI stands for Banking Financial Services. So other potential implications like automotive, financial service requirement, voting, healthcare, all are coming up. And that's it. So it's basically on inclusions and some of how it is can be increasingly effective in the current generation.
This is all about this module. We will conclude this module here. Hope you have understanding of the use cases in financial services. See you in the next module with next generation blockchain technologies, where we will cover Skyledger, distributed blocks, billion group, etc. Thank you. Hello and welcome to the 7th module, next generation blockchain technologies of this course, blockchain for finance professionals. And here we will cover Skyledger, distributed blocks, billion group, etc. And in this session, we learn more about the next generation blockchain technologies.
So we are covered like 6 modules. We have seen what is how accounting system happens, what is distributed ledger technology. We went into cryptocurrencies. We have seen blockchain basics and intermediate advanced. We have seen blockchain implementation. We have seen packages on Ethereum, Hyperledger, and Bitcoin. We have seen how Bitcoin works, mining. In this module, we will be covering the next generation blockchain technologies. For my, as a personal thing, I kind of classify Bitcoin as a first generation blockchain technology. The second generation is Ethereum and Hyperledger, and now we have a lot of next generation blockchain technology where they're kind of getting away with the mining and they're more focusing on the enterprise level integrations and interfaces and a kind of ledger. So distributed ledger technology is changing in a great way, and in this we will see some of the latest ones, even the next generation in Ethereum and all, at a high level, and understand some of them. And these will be very useful for developing any financial technology applications, for financial services. So some of technology trend that is going through is we will be looking at blockchain scalability and speed, because you have seen Bitcoin can do a transaction every 10 minutes, but the thing is scalability is important and speed is also important. So hard forking is one of great thing. They are using, this is one platform which is using their own distributed decentralized algorithm to generate coins and later mining. Then you have private ledger smart contracts. Though the private ledger like Hyperledger will actually help to increase speed for smart contracts. Then SegWit is one which is a kind of a forking from Bitcoin. So that is kind of using this. That's basically doing the increase the size of the block. And there's one new technology called billion group. It's very very interesting. We should be checking with them, the kind of transparency, the kind of, the speed, the kind of transaction that happens in this is very, very, very good. So if you really took like the how they are doing, the blockchain is actually getting scale and speed is because your first trend is hard forking. The second is more usage of private ledger. Then they are using tools like segwit to increase the size of the block, and the last one is basically on the real time group like billion group. So these are some of the methods that their next generation technologies are trying to achieve. So there are other things like, sharding is a very great example where you can actually split the blockchain transactions. So there is a example called Zilliqa. If you have time, you can go and see. This is like a very Turing process, as you say in the technology language. It actually splits the blockchain transaction to just increase the speed, and there is an algorithm that runs to split the transaction as per the requirement of the use case. Ethereum Plasma is a more streamlined verification process using Ethereum blockchain. So it uses a light networking process for transaction, and it actually updates the blockchain. The Plasma actually kind of updates the blockchain. And the last one, so Ethereum Plasma is picking up, and the last one is distributed blocks. This is based on the Skyledger. It's again a very unique algorithm, which runs on multi-parallel loops, and it's like a sky, right? There's no limit. Like it's loaded on cloud. It has various interceptions, integration capabilities. So this is one good next generation technology platform. So we have other aspects apart from forking or segwit or distributed ledger technology splitting. You have sharding, you have Ethereum Plasma, and you have distributed blocks, which is kind of a next generation technology trend. So if you really see that, there is I'm just trying to compare the next generation platforms: Zilliqa, Billion Group, Segwit, distributed blocks, Ethereum Plasma, ERC20 with Hyperledger, and SHA24 256 Litecoin Cash. So you can see the transaction speed is maximum in terms of Billion Group, and it's no mining is required. It's very highly scalable, and it's a private ledger. And you can see a security also, it's maximum 7. The second one is like Segwit, because it requires little high power, but then it's a hybrid model, but security is little less. And similar to what Billion Group is the ERC20 with Hyperledger. It is very cheap, cost effective, and it goes with very less power. And similarly, it scores high on security. The rest of the things like Zilliqa says distributed blocks, again distributed blocks is like greater than 300 per second, so it's a great one, and power is like almost null. Scalability is available, it's a private ledger, and you have scoring on 7 on 10. So these are some of the ones, and the second level can be your Litecoin Cash, and probably Zilliqa and Ethereum Plasma. The first level can be Billion Group, distributed blocks, and yes, and ERC20 Hyperledger. These can be the first choice, and the second choice can be the other 3. And finally you have a Segwit, basically dividing the blocks. That can be the third level. So I'm just trying to compare on the various parameters like transaction cost per transaction, power, scalability, ledger type, and security, just to scale up how things work in the next generation platform. So this is Litecoin Cash. They use SHA-256 protocol, which we have seen in Bitcoin. They call it as initial fork offerings. We have seen initial coin offerings, right? Similarly, they are called as initial fork offerings, and they seek to exploit the existing blockchain in terms of transactions, so that the initial distribution of a new currency is faster. And the participants should not need to be aware of the IFO. They should be aware of the fork block, and claims can be made anytime retrospectively as a private keys are kept. Fairness is guaranteed, even it's an old network, but we can upgrade it to a newer network. And potential participants, they're not to be at the launch level, right? It is like they can actually buy the blocks. And so what happens is, so basically it's like a merger between old ledger and new ledger to diverge. So these are some of the Litecoin Cash is picking up, but it's just not very popular. It's just picking up now. And the other thing is like, distribution is limited. Then IFO basically it has unlimited breadth of initial coin distribution, other than like with other approaches. And this is the traditional forms of ICOs or odd drafts will not be the natural choice for cryptocurrencies launches in the future. But the main thing in this is like it will be like initial currency distribution, which is very key. Second, it has alternatives. Third, it has more like unparalleled depth of coin distribution. Finally, it has multiple advantages with fairness and distribution extent, and you don't have that ICOs or drops or fraud kind of stuff. So Litecoin Cash is picking up for some of the initial fork offerings rather than initial coin offerings. So the other one is distributed ledger technology is like based on Skycoin is good, and it is judged as the crypto project best in 2018. And coin issuance process seems to be simplified, and the DApps can be built or distributed block. But you want to understand that you don't have a similar to smart contract, but they have a business logic in terms of they're detailing it in the white paper, but we need to ask them, they do have a third party tie up. We need to check when you're launching an ICO at least or a IFO. But the whole thing is like they have a end to end ecosystem. I'm trying to find out with them, but then they have not answered it. But this is a good launch pad for any crypto projects with decentralized apps. So it's an end-to-end blockchain plus cryptocurrency platform. That's what I can say. It's a base built on Skycoin blockchain. They have been adjusted as a best crypto project of 2018. Coin process like your tokens and coins is easy, and DApp can be built over distributed blocks. There's nothing called smart contract, but they have a business logic on that. And the whole system, they have an end-to-end ecosystem. So that's a feasible thing for distributed block technology. Waves platform, it is more of an exchange. It's like main thing is like coin listing is faster, and it has a blockchain technology with smart contract inbuilt in, and but it's a 15 transaction per second, very less, and it's open source, less secure, mining complications, and all functionalities available. But again, this is a picking up platform, but it has its own issues, in terms of agreeing to the whole exchange. Just that it's more of an exchange. It's just not about a platform. ERC20 is a very traditional one. Basically, Sky blockchain is there is a conversion of ERC20 to distributed blocks. So we can swap the blockchains, and it's possible to have many tokens. So ERC20 to distributed blocks token is very well available. And Skycoin platform, the conversion is possible, but there is not mention of the technology. But overall, as a thing, they are checking that we can swap the blockchains, but we need to check with them on the technology swap option. Some of the questions I'm trying to answer, some of the answers is not there, but I just want to bring it up, so that everybody is aware of the newer technologies. How even ERC20 can be converted to distributed blocks, because this will be one of the critical question when we are doing a large ledger, especially with the ecosystem like trade finance and stuff like that. So the other question that keeps coming is like will ICO, as you saw, most of the coins are from ERC, that is Ethereum. As of now, there are still it is the most liked by most of the ICOs are on ERC20, because the main reason is crypto exchanges can list, stability is there, and it comes with the Solidity smart contracts. But there are next best option, like for example Hyperledger smart contract, and you have the new blockchains like Neo blockchain, Stellar, Neo coins, and other stuff, which is all more of private blockchain. But yeah, it depends on the utility of the token and listing in the crypto exchange arrangements. So it may move away from ERC20 protocol or Ethereum protocol, but then it will take its time. But at least over some time, you need to understand about like how some of the reasons that they need to move to alternatives like to ERC20. But I've seen Stellar is picking up currently, but I'm not sure how far as it may be as scalable as Ethereum. So possible concerns, when you are migrating from ERC20 to distributed tokens, is like you need to look at the stability. And this is concern for everything, when you're converting from one platform to another platform, or when you are swapping. Scalability of the platform, you need to check. Listing, if it is it compatible to listing? Maybe it's a utility token or a security token. We need to understand. Smart contracts to investors, is it there or not? Is security taken care? Do they have the external cyber security tools implementation? So basically, you need to identify the concerns, and then answer them, and then see whether you can migrate from one platform to another. I'm just giving an example here from ERC20 with distributed tokens, or distributed blocks. Some of the questions I've just listed should be answered these questions, and then go ahead with checking with the clients, and then answer this, and then move the projects. So that's all about it. So basically, I just try to cover the new generation platforms, and what are the comparisons, and how they are distributing, and some of the usages, and how they get swapped in this entire lecture.
So this is all about the next generation blockchain technologies. We will conclude this module here. See you in the next module, startups in fintech space, where we will know about the startup story, blockchain learnings, challenges, success story. Thank you. Hello and welcome to the 8th module, startups in fintech space of the course blockchain for finance professionals. And here we will know about startup story, blockchain learnings and challenges, success story, etc. And in this session, we will know about the startup story.
So we have seen all the technology part, how it is used in use cases, some examples of how it is currently understood in some business, banking and financial processes, trade finance, stock markets. This is the last module of this entire lecture series. And I just thought yeah, we have understood technology, we understood business cases, we have understood implementation strategies, we understood cryptocurrencies. We have seen some of the length and breadth of some of the topics, but it will not be, I just thought it would be easy for us to even see like how you can do a startup story, or how you can engage yourself in the blockchain specifically for financial applications. So I'm trying to bring in whole research that I've been doing for last couple of years in the fintech area in various things, and I just wanted to throw this in the next couple of slides, how the behavior is changing, a story of an enterprise, a story of a startup, a story of small and medium business, and how actually financial technologies is actually embracing the technologies like banking, stock markets, anything to actually improve the business processes. So it's just a run through story, and this will conclude the end to end of the whole lecture series in financials. So banks and actually fintech startups have a strange relationship. You know, from the day one, I've actually covered 90s. They're actually been close to them. There is a symbiosis. Basically, the big companies invest in startups, and they also invest in some kind of they create startup ecosystems. They give accelerators. You have a lot of examples, right? Starting from JP Morgan to Citibank, everybody does that. So there is a strange symbiotic relationship. The reality is that which one to survive, and one is there is a common dilemma to scale, and whether they are having external innovation, the internal innovation that they bring in, can they support their external innovation to large enterprise. The reality is that you need to see if they will survive. That is the most common thing. you know so you will see in 2015 robo advice started, Apple Pay started. These are disruptions in the blockchain. These are the disruptions in fintech area, right? There was also this masters joining cryptocurrency. These are some of the snippets I picked up from headlines that I picked up from 2015, just as an example. So in 2016 blockchain technology started, crowdfunders started doing ICOs, the fintech revolution became more joinable with the online lending club. Then was a acceleration between banks like UBS and Citibank and JP Morgan to come out and then see if they can give a crowdfunding for any ledger technology, distributed ledger. So these are some of the things in 2016. What is essentially is over the last 3 years, the World Economic Forum has been deeply engaged with the drivers of fintech revolution. So they've been one of the instrumental people. So you see on the left the industry incumbent, the leading innovators, and finally the workshops. You have from most of the cities like Davos to London to Hong Kong, Tianjin, Boston, New York, where they've been doing some high-end workshops for fintech. And it's been supported by Santander to HSBC to Deloitte to Barclays and to all the capital companies. So you name the leading ones, who's and who's, including BitPay and all Coinbase, which are even the blockchain kind of technology companies, right? So it has been deeply engaged. So what is I've kind of understood this entire thing, whole framework for disruptive innovation in financial services. One, you have basic division as payments, insurance, deposits and lending, capital raising, market provisioning, and investment management. So this entire spectrum, we have seen some of them in how it happens in blockchain. I've given the deep dive of some of the good use cases that goes into this entire one-to-one consolidated framework. So fintech firms, they provide customer services, they provide value-added services, they enable technology support. So it's a spectrum. So any company which is trying to get into fintech should actually have all the three pillars. So the first one is customer experience. Some of the thing is like proactive insights. They should provide higher personalization, better functionality, interactive interaction, speed of governance. This is more towards AI and ML, like artificial intelligence and ML, machine learning, where you can use this for getting the high customer experience. And there is one innovation that I just want to mention here is TransferWise. It's one of the good apps that is like in like it meets large profit pools. So this is one of the good app that really takes care. So you need to understand the deliberation that's happening in innovation of financial services, and it really helps. These are some of the examples: On Deck, Wealth Front, Funding Circle, Crowd Club, Future Advisor. All these companies are actually platform based and data intensive and capital light. These are some of the examples that you can actually look into. There is something like even Barclays is coming in with Barclay card with just touch pay ID. So it's like competing with each other, right? It's just not about startups, it's not about banks, it's not about large enterprises, everybody. So they're leveraging the infrastructure, so it keeps going. Basically the thing is like you should have a complementary capabilities between the startup and the complement and the enterprise, so that it makes partnership logical. But it's already less difficult to implement. That's another thing. So how it is like you have just create the startup ecosystem, right? Attract the customer, provide what customer wants, do research, build offerings, product, services, and fulfill, and then probably you can even scale the support. So the symbiotic relationship is existing. There should be only one thing: you should have the right advantages between complementary partners, and it should have right collaboration procedures, and a successful requires commitment and agility in from fintech. So you need to find the right partners. So we need to identify that and then sure right partners for collaboration, and it requires commitment. So as I said, it should have advantages and challenges, making collaboration a win-win, and it should focus on the agility, and it should not have that legacy burdens of legacy systems and also regulations, and it should be like competitively advantageous and trustworthy. That's also important, and also they should be able to scale up using coming out of their challenges. That's more important. And then it should non-segmental, it should be actually having good brand name, and it should be having expertise in handling regulations. You should have the robust partner ecosystem, basically, which is having customer centric products and services. So essentially you have 4 points here. You should build the trust, you should have distribution infrastructure, and it should be not underserved by traditional financial institution. You should always look at a high growth, high scale, and a robust partner ecosystem. These are some of the crucial things that goes hand in hand for the startup fintech collaboration. And you should have a competitive metrics. These are some of the things: more agile, enhance customer experience, new product development, cost reduction, innovation in existing products, and improved data management. So we need to be very competing enough in this entire landscape to protect actually ourselves from the launch of so the collaboration is basically you should have a fintech firm, traditional financial services firm. There should be a mitigation plan. So only thing is that you on the left hand side you see a kind of collaboration hand to hand. It should have good risk management, have infrastructure. It should be able to give away with the good regulations, have customer trust, have economies of scale, brand name, and capital. That's like traditional financial services that can bring in that thing. And fintech firms, they can be agile. They have be innovative. They should look at cost reduction. They should bring that customer experience using technologies. They should be able to have viable new products and data handling. So a traditional, this is like a wheel. A wheel goes with a supplementary wheel, as a collaboration. That's how the entire landscape should be built, in the fintech startup collaboration ecosystem. And basically this is already given. Again, I think may just want to emphasize that the same thing is picked up from one of the surveys, and how each capability brings in terms of the partnership. But mainly one thing is like customer preferences should be more important, rather than self-directed financial management. The reason being, the role of the wealth advisors is changing time to time now. And the other thing is, you have retail investors have got good set of capabilities, and they are giving a lot of tempo changes, which are commoditized. So you are seeing some of the examples like Quant Connect, Quantum Pion, and Estimize, which is like accelerating the tempo at which the active strategies are emerged and are commoditized. So yeah, some of them are not customer facing, but these are some of the examples like fund apps can show. So basically, what I'm trying to derive is like, I'm just running through the slides in terms of giving you some options how fintech is changing the landscape with the enterprise versus, startup story. And it's not just starting there. You have fintech is delivering new capabilities and unexpected efficiencies. The primary objective of fintech startups should be actually, some of them say that you should have collaborating with traditional firms, but 75% of the people agree that you should collaborate with these traditional firms. 5.5 people say that person say that they have to get acquired by a fintech firm, or they have to get acquired by a traditional firm, or compete with on your own, which is 18.1. This was a survey reported in 2017. So what is the challenges? You have traditional firms sometimes lack agility, so you need to bring that fintech firm should bring that kind of compatibility, willingness of partnering. Traditional firms may not be looking at partnering. They also look at cultural fit, because they may be younger generation in the fintech firms. Regulatory burden, they will always be very regulatory oriented. IT compatibility, because they may be on legacy systems, so startup will need to work with that. Product service cannibalism, in the initial startup way, you don't even know some kind of differentiation. Then scale of business, terms of partnership, fear of losing control and distribution. So basically these are some of the challenges that every company has to overcome over course of time. So we need to identify the percentages, and then work towards this 1 2 3 4 5 6 7 8 9 10. There are 10 factors that actually helps you to build your startup. Now you have process automation and new information platforms, but this is also disrupting the whole benefits of scale in many aspects of financial services. So the traditional method of financial services actually running through very shortly because of this.
Here is the end of the session. In the next session, we will understand all the blockchain learnings and challenges. Thank you. Welcome to another session of this module. In this session, we will discuss about blockchain learnings and challenges. So let's jump to the session and know more about it.
Also, the startup ecosystem and the financial services has been automated through acceleration of many machine learning and artificial intelligence. So this will kind of automate unexpected processes, right? So blockchain is also disrupting along with AI and machine learning. The whole thing is going to bring in the transformative effects, to the whole financial services landscape. So the expanded roles is like, you actually, the role of humans will come down, but we might expect much more disruption. Actually, we have to wait and watch how the entire replacement of mundane tasks is already replaced by the machines using RPA, or robotic process automation. So as we have seen, distributed ledgers like blockchain are built on complex mathematics, cryptography, and game theory, but technology is at best when it has a set of capabilities. Yeah, they may be having a lot of theoretical thing, but it has to have a use case applications, and it should bring business benefits. That's the most important thing. So the new blockchain has the potential to redraw the whole financial services ecosystem map. We have seen that. I've explained to some of the great extent how small processes are getting transformed in blockchain. So basically, blockchain will drive efficiency and disintermediate existing players. So what is going to happen? It is going to bring in transparency in markets, transparency in lending, transparency for regulators. So first and foremost, it is going to bring in the disruptive impact of increased transparency. So we have seen some of the fintech area, how fintech and enterprise can go together, some conditions mapping. Now we are seeing how blockchain actually can enable the entire thing, in the ecosystem. Other implications can include embedded regulation, reduce settlement time. You have seen from T+3, T+4 to real time. Also reduce counterparty risks, and a shifting role for central counterparties, right? It doesn't have to be a centralized management in the blockchain, because it is immutable, it is agreeable within the ledger. You have very few participants, actors, so secure, and like data is shared, and it lies for at one stretch to all of them to watch. But again, building the distributed financial infrastructure will be long and complex process, but it remains to identify who are the winners and losers. It's like you toss a dice and you see what's the probability of choosing, right? It may be 5C2, 5C3, or factorial 5. Similarly, we'll understand whether what process is important, what process is not important, and then we'll develop and scale the blockchain financial infrastructure. And then cryptocurrency exchanges are coming up. This is a new generation investment pattern. They are placing a role used for whole consumers today, because at least a lot of people are investing in cryptocurrencies. And but yeah, how banks will merge with them, or they will become a bank, or they already having a bank kind of stuff. We have to wait and watch in future how the entire things shape up. As of now in 2018, there are a lot of exchanges, at least one per country. Then there is also brokerage ones. Again, this is something similar to like centralized asset database, and there is a brokerage similar to stock exchange brokers. Again, these are happening because of the decentralization ethos. We need to wait and watch, how the entire thing is holding on. But the thing is, they're tied up to exchanges, so they have to have a brokerage kind of stuff. Wallets is picking up. There are many choice of wallets. You have a smartphone, you have web-based. You can hold the currencies in fiat form, cryptocurrencies. These are some of the new generation things that's coming up in the fintech area, right? Hardware wallets are also there. So basically, it should when you have a private key, and then you can hold it in any of the wallet like Trezor or Keep Key and things like that. Microtransactions are happening. You saw like platforms like Kasha, which is transferring the cash from one foreign country to another within seconds, and the transaction cost is also cheaper, right? So innovative use cases are being developed with publishers, and basically the cryptocurrencies may with microtransaction exist. Yeah, we need to identify, we need to check how it fits to the how the fit for the blockchain has actually being scalable with the entire microtransactions. Investment and loans is changing. You have some robo advisor startups, and they're challenged by blockchain ones. Basically, they need to add blockchain to their offering. So it's a whole fledged. We have seen this, right? How loan syndication is happening on blockchain as a use case. Money services. This is again simple, but even how non-cryptocurrency companies like many companies like Western Union may not exist after some time, because they're charging huge hefty amount as brokerage. So the global corridor has actually shrunk, and this will actually the global remittances will become more and more accessible for many people, right, at a very affordable cost. Capital markets, we have seen this. Even companies like Nasdaq and others are actually looking at, and what volume of transaction is actually flowing, so we need to identify this and go ahead with how this can impart, the changes in the whole ecosystem of capital markets. Trading platforms, again, you have new kind of trading. You have derivatives, bonds, stocks, all on cryptocurrencies, and you have fiat cryptocurrency changes also. Their market liquidity is changing because of these trading platforms. Merchant services, they are kind of e-commerce companies, and some companies are just based on Bitcoin e-commerce. The integration with websites are still tricky. Will traditional merchant processors add Bitcoin to their arsenal? Right. These are some of the questions that we need to answer using these merchant services. Compliance, exciting space. We need to check. There are a lot of startups who are developing their products basically to just protect anti-money laundering on blockchain. The trend is moving towards compliance, and then will traditional anti-money laundering integrate these blockchain offerings? I've seen some of the companies I've listed here. So it's again changing the way it happens. Financial data analysis is very embryonic, but cryptocurrency doesn't bother about money markets. So is there any Bloomberg of crypto emerge? In 2018 it started, but then we have to say again, these are some of the companies which are focusing on that financial data. Trade finance doesn't have to repeat again. I've seen end to end. I've given you as an entire thing. We have spoken in length about Everledger. We have spoken about provenance. So these are some of the companies which is trying to transform the whole way of authenticity, reducing the supply chain frauds, whatnot. This is a game changer, definitely. ATMs, you have Bitcoin ATMs, you have cryptocurrency ATMs. So it's just not about just going and buying the fiat currency from bank ATMs. They're completely now ATM manufacturers are kind of shifting to the alternate services, including virtual currencies. Banks. So you are getting a lot of banks serious about blockchain. They're funding accelerators. They have some internal committees. They have some thought leadership programs going on. They're investing in leading consortia. But then again, how fast it will permeate using blockchain is wait and watch. Payroll and insurance. You have seen some of the insurance at least, but seed ideas are percolating in the insurance space at least. Payments, several use cases, both B2B and B2C. But then how to embed with the existing popular use cases is what we need to see how it can get scaled up. So even services is picking up, blockchain services. It's like potential upside for banks. Like they don't have to wait and watch. They can just give it to the consultancies and they can do outsourcing. So this also is started with blockchain services like your legacy services or service management. This is also started. This is one of the big games. Software development. Many companies are coming out with the software development. Each company can develop their own blockchain apps, and no big winners yet, but then standard development packages will be there and it will emerge over time. So some of the companies are OpenChain, Blockstack.io, Manifold Technologies, Blockstream, and stuff like that. General APIs, this is started, but then we will see how Bitcoin programmability it's been extended. We have to see how other platforms are as scalable as for general APIs using their API infrastructure. That's all for this session. We will cover success story in the next session. Thank you. So, as we have discussed before, we will cover this success story in this particular session. So, let's get started. So, we have seen some general APIs. There are some even specialized APIs. You don't have to build the entire thing. There are open asset APIs that you can actually work around to create digital assets, tokenization of assets, verifiability of data processes using blockchain. So there are a lot of companies like Tyron, Colored Coins, Bitcoin.io. These are some of the companies which are actually giving specialized APIs. So if you are an enterprise, you just have to plug them into your enterprise and then start working. Basic thing is to identify the use case and then see which technology can help them based on the use case. So apart from this, we have seen nitty-gritty of cryptographic constraints, and there are a lot of blockchain platforms. You have Hyperledger, you have Tendermint, you have Monetas, you have Applied Blockchain, you have Counterparty. So basically, these are the protocols. Actually, they don't have to do anything; just have to use them and then compete, and then just do mass adoption, of the blockchains. Be it Hyperledger, they have their lot of use cases. Like Blockstack, it has got a lot of use cases. Applied Blockchain, I personally use in many companies. Zero Coin is coming up. So you name the platform, right? It's just basically make sure that you have a critical mass of adoption. That's the only thing required. Smart contracts are a big promise of blockchain. They are still hard to master for an average developer. This is just not about basic Ethereum smart contract. There are other. You have Ethereum blockchain as a service. Completely. The other companies which is going up is smart contract. You can look at is CoinSpark. Excellent company to see. Tembusu systems also growing. These are some of the great startups. Public blockchain. It started. You start with Bitcoin, but then you have Ethereum. It's a viable blockchain alternate. So let's see how this entire thing is growing, and 2019 will be a good year for this. Special blockchains, we have seen some of the other ones. Example like private blockchains, you have Ripple and Stellar, and they might make sense as private blockchains because more and more public blockchains actually crowding the mechanism and transactions are getting slower. So we need some special blockchains to make sure that there is a longevity of the purpose that what we are building for blockchain. So Ripple is growing, Stellar is growing, alternate to Ethereum. Payment protocols, they basically carry the monolithic to microservices based native macro transactions on the blockchain with flexible programming capabilities. That's what I said. It's from moving from monolithic to microservices. And there are some of them like Lightning Network, Monero, and other payment protocols, including Kasha, which is a great example. So we have to see how this entire story develops. Miners, I've seen like it started in 2009 where a laptop and desktop, actually you can mine a Bitcoin, but now it is not the same. You need 1000 kilowatt of power per hour. So there are, as I said, you can join any of the mining networks. Basically to just make some money using the nodes and create proof of work. And it's just not about Bitcoin, but you have other blockchain mining, example Ethereum. So these are some of the companies like Antpool, BTCC, Bitfury. These are the 21 INC. These are the companies where you can actually take your share of Bitcoin. Bitcoin is still trading at $4,000, so it's not a small amount. So you have some of the most funded companies, blockchain, and this is as of 2017. Yeah, but it's like increasing day in and day out. So you have Coinbase, Bitfury, Digital Asset, Bitmain. Some of them got some second, third generation funding as well. So what are the challenges? Good intentions to develop blockchain based things not enough. You have to get your hands dirty. Don't outsource the learning. Get your minds dirty. Try some ideas even if they fail. Failing is okay for startup, but can banks learn to fail? Yes, maybe not. Integrations will not be easy. Blockchains or applications are different, but they must be written. So the challenges are there, but at the end of the day, whether it's a startup or even an enterprise, the reason why I'm bringing is this is just not restricted to large enterprises. not restricted, sorry, my apologies, not restricted to startup. This is like creating a new startup inside the law organization, like even Santander Bank or JP Morgan, because the blockchain is going to be web 3.2 as they predict. There is going to be a lot of implications. Applications going to be transformed, intermediaries are going to cut, immutability is increasing, data nodes will change, multiple records, system records are going to get away, and it's just centralized, decentralized processing. So you can fail. What I'm saying is, you need to take blockchain as a step by step baby, and it should be written properly, to execute. Opportunities are heavy because everything that what blockchains can solve, and it also co-creates opportunity because it is going to take a paradigm shift. It's going to start in the new fields. I think a bank without a blockchain is going to be laggard. So there's going to be opportunities area, and forget about integration, other stuff, but just focus on use case shifting and how it's going to help. I guess like a blockchain strategy has to be a part of every organization. So recommendations: invest in blockchain technologies, learn how to write smart contract, create tokenized assets, data process in the blockchain, interact with the blockchain APIs, program a blockchain. Don't outsource these tasks or you will be outsourcing your learnings. So pair a business manager with a technical person to uncover innovations. So these are some of the recommendations based on what we have seen in the past and currently when I'm interacting with a lot of folks. So this is the innovation cluster which I've already shown you. The various segmentations. It's a 6-path segmentation, and you have some companies. It's already coming through. So you have advanced algorithms to P2P lending, to virtual exchanges, to smart contracts, to retail algorithmic trading, to emerging payments, to everything. So this is very important. These are some of the startup companies in 2018 based on some of the use cases: mining, exchanges, wallets, payments, infrastructure, blockchain, innovate, gambling, services, financial services, not. So identify the right people, use funding, have early traction, and build to scale, and do a scale up rating and certification and get hands dirty, and then make this company as a successful company. So commitment is important. There is no one size fit for all approaches. There is no one size innovation aspect, and most work through incubators, accelerators, hackathons, and venture funds. And most fintechs importance of CXO level because it has to be buy-in at that level. But have a co-creating vision and objectives for a successful collaboration, and have a white labeling model, in-house solutions, and leverage APIs. And basically get out of the struggle and make sure that you can always look at how do you innovate and keeps both financial services and technology together with a successful collaboration. So there are some Berlin-based blockchain startups which I just wanted to bring in. You can just read it for yourself. So basically, I'm just reiterating areas to consider: and ensure leadership buy-in, establish business objectives, align expectations at the start, gain access to incumbent firms and infrastructure, ensure cultural compatibility, and have defined ownership of intellectual property. And on the other side, during collaboration, we have contingency plans, monitor continuously, have dialogue with stakeholders, and develop monitor indicators. So areas to consider, very important. I'm not saying from a startup point of view. Even you are creating a new blockchain team, please make sure that how you viably sync up with the senior management inside the organization. Or if it's a startup, then make sure that if you're a part of incubator, you want to sync up with the financial services organization. These are the things to consider before and after and during collaboration. Bring focus into blockchain related activities, removes obstacles to blockchain implementations, shares what every department is doing, lubricates best practices, project managers across various implementation, paired with IT and external and internal as evangelists, and identify what banking operations and technology implementations, and experience in re-engineering and blockchain enthusiasts. So this is what I call it as a blockchain SAR role, and his entire focus is on role, and this is qualification that is required. So this will be a more sought role in future. It's already started with some companies, but I just want to see institute the blockchain SAR role. Very important. I've listed the role and qualification. This just identifying things, but this is just not restricted. You can keep growing this role and qualifications. So I've covered the entire startup ecosystem. Startup ecosystem for me is basically identifying what is there in the business process, and what should go as a part of the blockchain, how the use case will bring value, or how do you overcome the challenges, and innovate in the innovation, and finally identify and commitment, and cut this entire area of consideration, and have a blockchain SAR role. That's all it is. So a startup again means, I mean to say, starting a new unit inside the large organization, or a actual real startup. So both exist together in this entire blockchain. So overall, we have seen 8 modules in this. We started with how financial system starts. We started what is distributed ledger technology. Then we moved on to the basics of distributed ledger technology and blockchain. We had advanced and intermediary concepts on cryptocurrencies. We saw some of the terms like initial coin offerings. We have seen what are the various technology platforms that support business financial organization, that is Ethereum, Hyperledger. We have seen some of the great use cases in simple, in advanced stages. We identified what are the use cases, or how this use case generates challenges, and what should be considered. We also went in completion with the new technology platforms end to end, and finally we saw how you can enable a startup within a enterprise, or actually inside the organization, or as a startup company. So end to end, I've tried to cover the most critical aspects of blockchain technology, distributed ledger technology for financial services. Hope you had good learning out of this entire lecture series. Thanks a lot for my patience listening.
Wish you a happy learning. Thank you.